Good morning, everyone, and welcome to the first trade on Yahoo Finance for this Monday, September 14th. I'm Alexis Christoforous, along with my co-host Brian Sazi. The stage is set for a nice big rally on Wall Street this morning. We have got stock futures higher across the board, and tech stocks are bouncing back after their biggest one-week slide in about 6 months. Right now, we have got Dow futures on the upswing, up now 250 points. NASDAQ futures rallying about 165, and S&P futures climbing 40 points. The two top trending tickers on the Yahoo Finance website this morning: NVIDIA, it is on the upswing after the chipmaker agreed to buy ARM Holdings from Japan's SoftBank in a $40 billion deal. We're going to have much more on that monster deal in the semiconductor space in just a few minutes. And Treasury Secretary Steven Mnuchin has confirmed the White House has received Oracle's proposal for TikTok and says the Trump administration will be reviewing the proposal this week. The tech giant reportedly won the bidding for the U.S. operations of the Chinese video app TikTok, but the deal may be structured as a partnership rather than a buyout. Our tech editor, Dan Howley, is joining us now for more. Good morning, Dan. So I guess the question at the end of the day is, does this deal keep TikTok alive in the U.S.? Because we know President Trump has threatened to ban it.
If it's going to the White House and Larry Ellison, Safra Catz both have connections to the White House to a degree, then it looks like it would continue to function in the U.S. just as it has. It'll depend now on obviously the approval process, China's approval. Don't forget that's a huge issue that's been going on behind the scenes with TikTok, whether or not China will allow the algorithm that is basically the secret sauce to the app to be able to be moved to the U.S. That's still a major component, and we still haven't heard from China. Basically, what we've heard now is Microsoft and Walmart say, we're not involved anymore. Our bid's been rejected. So that really leads everyone to believe that, yes, it's Oracle saying that they've talked to or sent the proposal to the White House, but we haven't heard anything on the China angle yet and what they're thinking behind the scenes. So if China decides to pull it, then they could pull it. And that's why you may be hearing about the partnership rather than the straight up buyout.
Dan, what would this deal mean for the future of Oracle? But also, what does it mean for Microsoft and Walmart, who appear to have lost out on this?
For Oracle, it gives them more of a foothold in the consumer side of things. Obviously, they're not, a consumer facing business to the degree that Microsoft or obviously Walmart is. So it would give them more exposure there. I think really it would help them kind of brush up on their cloud chops, right? The idea that Oracle is a cloud company, but they're not nearly as large as something like a Microsoft or an Amazon, not as big as Amazon. But it would give kind of Oracle a leg up and let them demonstrate how they're able to power the cloud and what they bring to the table for an app as large as something like a TikTok. For Microsoft and Walmart, it's definitely a gut shot. Microsoft could have used this a lot to kind of ensure that the younger generation is aware of Microsoft or more aware of Microsoft and doesn't see it as just this stodgy company that builds, an operating system and the Word software that they do their homework in. But Walmart obviously would have benefited a lot from the e-commerce aspect of this. So I think it's a big blow for the two of them.
But Dan, this morning we've got Walmart coming out in a statement saying they're still in talks with ByteDance's leadership. They're still interested in some sort of a partnership with TikTok. So maybe Walmart is not out of the game completely because this isn't a buyout and a partnership with Oracle. Maybe there is room for some other players.
Yeah, I mean, it definitely seems like Walmart could play some kind of e-commerce role, but it doesn't seem like they would have the kind of control that they were looking for originally. I think basically they're just saying, hey, obviously that didn't work out. The bid didn't work out, but we still want to play ball. We want to make sure that we have access to the market that TikTok brings, which is the up and coming generation, the Gen Zers. Make sure that Walmart's name is in their heads and that, they're thinking of them as an option whenever they go buy things, not just Amazon or, something along those lines. So I think really what this does is twofold. It gives companies like Walmart access to that marketplace, but then it also provides them with the name recognition that they need for the younger generations.
Huge deal, I think, for everyone involved. Dan Howley, thank you. The other big headline this morning, NVIDIA, that stock is moving skyward after it said it would buy SoftBank's chip division ARM. The $40 billion deal is the largest ever in the semiconductor industry, and Yahoo Finance's Emily McCormick is on this one for us this morning. So what are the details of this deal, Emily?
Well, good morning, Alexis. And Merger Monday continues with a massive deal here for NVIDIA and SoftBank's ARM unit. Now, this is, as you mentioned, the largest ever deal in the semiconductor industry and by far the largest purchase made by NVIDIA so far. Now, this is also a win for SoftBank, which paid $32 billion to acquire ARM 4 years ago. The terms of this new deal are for $40 billion. And looking at the details here, we have NVIDIA agreeing to pay SoftBank $21.5 billion in shares and $12 billion in cash. It may also give another $5 billion in cash or stock to SoftBank based on ARM hitting certain performance-based targets. And it will issue another $1.5 billion in equity to ARM's employees. Now, just taking a look at these businesses here and what these companies stand to gain from a tie-up, we have NVIDIA and ARM until now really having been operating in separate lanes in the semiconductor space. We have NVIDIA, known for its graphic processors used in video games like the Nintendo Switch, and it also has chips that go into data centers, and it's been a leader as well in the artificial intelligence chip space. Now, if we take a look at ARM, though, NVIDIA will now get a major inroad into the smartphone chip space specifically. The Wall Street Journal this morning cited a statistic that ARM designs and licenses chips used in about 90% of global smartphones. So it's a huge player in the space that NVIDIA will now be getting a huge part of. Now, I want to point out here that we are seeing NVIDIA shares on the rise this morning. Shares are trading higher by about 7%. So clearly Wall Street seeing some upside here with this deal. Alexis?
And Emily, talk to us about what this means for Japan's SoftBank. We know they've made a lot of bets, big bets that have gone south. I would imagine this $40 billion will come in pretty handy for them.
Absolutely. So we have seen SoftBank, of course, struggling over the past year or so with some of its deals, of course, with the Vision Fund and some of the investments that it made in that space as well. But if we think about its acquisition of ARM back in 2016, had really struggled to get that off the ground. As I mentioned before, it purchased it for $32 billion. So getting a little bit of a premium here with this deal now with NVIDIA. But I do want to point out that while Wall Street right now and investors seem pretty upbeat about this deal, not everyone is on board with it. We had Herman Hauser, one of the founders of ARM back in 1990, calling the deal a, quote, disaster in a media interview earlier today. And he noted that before the acquisition by SoftBank, ARM had been seen as one of UK's, quote, technological jewels, and approving its sale to an overseas buyer was politically sensitive. Now, he's saying that similar scrutiny could now come into the realm here when we have NVIDIA, a US company, purchasing ARM, which is still based in the UK. Although I do want to point out that NVIDIA's Jensen Huang did say yesterday that ARM would stay headquartered in Cambridge and that NVIDIA would allow it to continue its research and development overseas. Alexis?
All right, Emily, thanks for that.
All right, let's head overseas and check out Yahoo Finance's Tom Belger. Tom, how are European markets doing this morning?
Yeah, we had some big news lifting the mood in Europe this morning and Asian stocks overnight. That was AstraZeneca and Oxford University resuming their world-leading vaccine trial. Clearly, there's a lot of relief that one of the most advanced trials in the world is back on track. The European stocks have those gains have tailed off a bit now. There's not a great deal of detail about what happened to the participant who fell ill, hitting stocks last week when the trial was paused. But Oxford University, who are working with AstraZeneca, they said in any trial with 18,000 participants, it's to be expected that some people do fall ill. And AstraZeneca still think it's possible to get a vaccine over to regulators for sign-off by the end of the year. As I say, giving the mood in Europe a bit of momentum today.
You know, Tom, in recent weeks, we've seen some improving data on the UK economy, but the trade chief is now coming out and saying today, no, don't get too excited.
Yeah, that's one of the leading trade unionists in Britain, Frances O'Grady. She's warning of a tsunami of job losses looming. There's been a chorus of voices from businesses and economists saying similar things in recent months. That's because the UK's job protection scheme, subsidizing wages, is being gradually wound down, just as our European neighbors in France, Germany, Spain are extending theirs into next year. At one point, that was propping up 1 in 3 jobs Another forecast out today says without it, almost 1 in 10 of the workforce will be jobless in Q4. There's also some separate data out today suggesting that official figures, official data companies have to submit to the government saying that they're going to get rid of more than 20 employees. Some smart journalists asked the government to release that data, and some analysis by a think tank suggests almost 500,000 workers could be in line to lose their jobs this fall. And the reality is we're seeing that furlough scheme being wound down. That could be even higher. They think that could make 700,000 in a worst case scenario. And obviously, proportionally here is a chunk of the workforce compared to where you are. That's a big, big proportion of UK workers. Brian.
Big number indeed. Tom Belger, thank you very much.
And still to come on the first trade, a monster deal in the pharma business. Gilead buying Immunomedics in a deal worth $21 billion. We're going to speak with the executive chairman of Immunomedics right after this. Welcome back to the first trade. We've got shares of Immunomedics more than doubling here in the pre-market this morning after Gilead agreed to buy the company in a $21 billion deal. Let's break it down now with the executive chairman of Immunomedics, Dr. Behzad Aghazadeh. Doctor, thanks so much for being with us. So I see what Gilead's getting in all this. They're going to be getting your coveted cancer treatment drug called Trodelvy. But what is Immunomedics getting out of this deal with Gilead?
Yes, good morning, and thank you for having us. Obviously, we're partnering with one of the foremost global organizations in human therapeutics, groundbreaking medicines in HIV and hepatitis C, more recently entering the oncology space. And this, I think, is going to be a flagship product, a foundational medicine around which they can continue to build out their oncology presence. And we're very fortunate to be at the very forefront of that with a drug that across multiple tumor types has shown promising efficacy, approved in one indication and multiple indications hopefully to come thereafter. Obviously, we have a responsibility to patients globally, and this affords us the opportunity to bring this medicine to other parts of the world. We're currently only commercializing in the US, whereas Gilead's global presence can ensure that we reach patients across the world who are waiting patiently, but unfortunately don't have a lot of time. So we could not be more excited about partnering with Gilead.
Doctor, maybe perhaps you could alleviate any concerns by Gilead shareholders. What's the IP runway for Trodelvy?
So Trodelvy has IP through 2033, but beyond that, it's an antibody drug conjugate, which brings with it a tremendous amount of complexity. So it is very much our expectation, I believe also Gilead's, that the constructs will be very difficult to genericize. And if there will be generics, the erosion curve is quite different to other therapies, in particular small molecules that have immediate erosion. These chemical entities of these constructs, these biologics, are much more difficult to genericize, and there's really no clear path of how we would even see generics one day. So I think, despite the fact that the IP from a headline standpoint is 2033, I think there's substantially longer runway with these agents.
Doctor, we see your stock up better than 100% here in the pre-market. Gilead's coming under a little pressure, down about 1.5%. There are some on the street who are saying that perhaps this $21 billion price for your company is a little rich. I think it's something like 108% premium to where Immunomedics closed on Friday. What can you tell Gilead investors right now who may be concerned that this price that they're overpaying for your company?
Yeah, certainly from a headline standpoint, the total value consideration of the deal does stand out relative to the other deals. I think what is not necessarily entirely clear or well understood at this point is the numerous types of indications, the potential to advance, not just in those settings, but also move up in lines of therapy, capture more patients, the potential for the long IP protection that this warrants, and the ability to make this a foundational therapy around which a lot more work could be done and more developments could occur, in particular combination therapies with other agents that have shown promise in the cancer setting. Over time, if those combinations bear fruit, you could see significantly larger adoption, longer time on these therapies. And so from a return standpoint, I think the shareholders of Gilead will over time come around and appreciate this was a very good deal for them as well.
So Doctor, the deal is supposed to close in the fourth quarter of this year. Can you give Gilead investors what are the key data points in early 2021 regarding Trodelvy?
Actually, I wouldn't even ask them to wait that long. In fact, as early as this coming Saturday, the European Society of Medical Oncology, the ESMO conference, will take place, where we will share what will, I think, be groundbreaking data, very rarely seen across any indication, but in particular in triple negative. This will be the first time the full data presentation will occur of the late stage phase 3 study of Ascent in of our drug Trodelvy in triple negative breast cancer patients. And I think there'll be a lot of takeaways from that. Not only that this is a foundational therapy in triple negative breast cancer, but that it certainly will open doors into other tumor types that significantly enlarge the market opportunity. Beyond that, we'll also show data in urothelial cancer, which is a second indication we hope to be able to be in a position to file for later this year. In 2021 and beyond, there'll be other tumor types in metastatic breast cancer, different subtypes of breast cancer, and non-small cell lung cancer, and in combination therapies, all of which are looking quite promising, but the data presentation for that in 2021. And then finally, European filing for registration is going to occur sometime in the first part of 2021. And so I believe with Gilead stewardship, we'll be in a position to start commercializing across the European marketplace, perhaps towards the end of 21 or early 22.
And when do you expect full FDA approval?
Well, the drug is already approved in the US under what is called Subpart H, or accelerated approval. And that is basis of early data that was presented to them. And we received the approval in late April and has been commercially available since the very early days of May. We will file for full approval, which just adds additional data. But I think after this weekend, when the data is disseminated to the medical community, the benefit that these patients derive by being on Trodelvy will become even more clear to them. But certainly we're excited to be able to file this data, and we haven't been clear about when that occurs or might have already occurred. But I would not think that the FDA will take very long to put the full data into the label and have the full approval out there for triple negative breast cancer. The other subtypes we have to submit for urothelial and metastatic breast, those would be events that would occur potentially either late this year or in the first half or in the first half of next year.
Doctor, I know that Immunomedics has been operating without a CEO for a few months now. You're the executive chairman of the company. What will your role be once this acquisition is completed? Do you know?
I tend to believe I do know that. So yes, in fact, I have held this position for actually 18 months now. This has been a position that I took over as being the chairman, and when we separated with our prior CEO, I stepped in to ensure that we navigate the period ahead. What I believe I can with certainty say is that there will be one role that will be a synergy as part of this deal, which is the elimination of a potential opening of a CEO. I have a separate job that I've been running in parallel. I'm a fund manager, and so I will be going back to that once this deal closes.
All right, Dr. Behzad Aghazadeh, Executive Chairman of Immunomedics. Congratulations on the deal. Great day for your shareholders.
Thank you very much. Thank you.
The pandemic has changed how a lot of CEOs think about their workforce. And the new book from Netflix co-CEO Reed Hastings unveiled a different approach to keeping and getting rid of talent while building a successful business. Our editor-in-chief, Andy Serwer, is here with us now. Happy Monday morning to you, Andy. A lot of CEOs, I guess, reveal their secrets in this book. Did anything in particular stick out to you?
Well, you know, it's interesting because Reed Hastings has sort of quietly been known, Alexis, for someone with some very serious management chops. And he has something called the Netflix Culture Deck, which has been out on the internet for about a decade, that is a widely read document in terms of how to run a company. And Netflix is a little bit different. They believe in some very radical transparency. They believe in not having a vacation policy. There's no talking behind coworkers' backs. And also, no matter how good you are, if you're just good and another better person comes along, you are out. And that applies to just anyone across the board at the company, Hastings says, including himself.
Andy, how does Reed Hastings' management style compare to, let's say, perhaps one of the biggest legends in management, Jack Welch, or at least he was once one of the legends in management?
Yeah, you know, it's interesting because these kind of CEOs who are gurus come and go a little bit. And I was saying that right now, you know, he's someone people really look to, as well as Jeff Bezos, of course, and Ray Dalio from Bridgewater. Jack Welch used to be that guy, right? Say 20 years ago when he was running GE at its heyday, you know, he could do no wrong. He was writing bestsellers. And then he retired. And then ever since then, the stock was at $60. It's about $6 now. Ever since then, we've been learning more about Jack Welch and his time there, the late Jack Welch. And really, he wasn't all that. And, you know, he ran it with GE Capital, was kind of a black box, and set up his successor, Jeff Immelt, for a very rough patch. And so you have to be careful if you're a CEO putting this stuff out there, that you're really walking that talk.
All right, Andy Serwer, very insightful. Thanks for that.
Thank you.
And still to come here on the first trade, Delta Airlines comes up with an innovative way to raise some cash. And we've got a big rally underway here in the pre-market with 7 minutes to go before the opening bell. Stay with us. Stocks higher across the board here in the futures market. Let's check in with Jared Blickery. And Jared, I guess tech stocks are back in favor with investors, at least for today.
Yeah, it seems to change day by day, even hour by hour. We'll have to see what happens into the close. But looking over the world right now, the world indices, sea of green. Except for India, we do see the Dow is up about 0.8 of a point there. That's up 226 points. S&P is up over 1%, and the NASDAQ just flying high once again, up over 1.5%. And just looking at the Wi-Fi Interactive here, tech is in the forefront. We see Apple, one of the leading stocks of this rally, if not the leader, up over 2%. Amazon up over 1%. Alphabet and Facebook also up over 1%. But the chip stocks really flying high. We talked about NVIDIA and that ARM deal. That's up over 7% in the pre-market, up 38%, not including overnight gains over the last 3 months. And looking at the Dow, we see looks like Procter & Gamble is up 0.5%, and even the financials are fairly strong this morning. JP Morgan up about 0.9% right now.
And also, it looks like Delta is going to use its frequent flyer program as collateral to secure some new loans. And I guess it's not the first airline to do this during the pandemic.
No, pretty interesting situation. If you think about it, the rewards program, a very valuable asset. So Delta is trying to raise $6.5 billion, and it's using as collateral its loyalty program. And it also says as part of the filing that it's not going to go to the government for another loan. And that's after entering into a non-binding letter of intent with the U.S. Treasury for $4.6 billion under the CARES Act. Now, we do have Delta up about 2% in the pre-market. It's been kind of a rocky road, as we know, for the airlines, but other airlines doing fairly well as well. American's up about 0.9%. JetBlue is up 1.6%.
All right, thanks for that, Jared. We're about 3 minutes away from the opening bell. Stay with us. That plus our first trade front page headlines right after this. Stock futures are higher on this Merger Monday on Wall Street. Here's your opening bell at New York Stock Exchange. And a new trading week underway on Wall Street. Major indexes each up about at least 1% heading into this market. The Dow Jones Industrial Average going to start the day on the upside after rallying about 1%, as we said, into the market. Here are the headlines making the first trade front page. At least 35 people are now dead in the wildfires that have burned millions of acres across the West Coast. Forecasters are warning weather conditions could continue to fan the flames this week in California and Oregon. President Trump is set to visit California today to survey some of the damage. And it appears Oracle has won the bidding for TikTok's U.S. operations, beating out Microsoft for control of the service. Multiple reports say the deal won't be structured as a sale, but as a partnership. Walmart separately says it's still in talks with TikTok's owner, ByteDance. Any deal is subject to review by the Trump administration, and Treasury Secretary Steven Mnuchin says they will be looking over Oracle's proposal this week. And AstraZeneca has resumed its trial of a COVID-19 vaccine in the UK. You'll remember it had been paused after one participant developed an illness, but the company did not disclose any more details on that illness or what led regulators to give it the okay to resume. By the way, AstraZeneca's vaccine trial here in the US remains on hold. All right, let's get back to one of our top stories this morning. Treasury Secretary Steven Mnuchin confirming that the White House received Oracle's proposal for TikTok and that they're going to be reviewing it this week. For more on that, let's bring in Kareem Hijazi. He is the CEO of Prevalion. Kareem, good to see you as always. So what do you think of Oracle coming out the seeming winner here of this TikTok bid, and not a buyout so much as a partnership from what we're hearing?
Yeah, good to see you, Alexis. Yeah, it's interesting. It's another turn of events that I don't know that I would have predicted. Oracle's not the de facto standard for a company you'd think that would be interested in a social media play, but now that it's in play, it's not a terribly surprising thing that they may have some really interesting things planned. They don't have anything like Microsoft had, with LinkedIn and games. So this is a nice play for them. Although the deal, as you've indicated, isn't really satisfying from the outset what the Trump administration has asked for, which is control of the data that could potentially get into the Communist Party's hands in China. So it is a little concerning and interesting. So I'm not quite sure what the play is here. There is no apparent outset or delivery of the algorithms of ByteDance or TikTok to Oracle in this deal. It looks like just simply some sort of partnership. That's the terminology that's being thrown around right now. So a lot to be figured out.
Kareem, in the best case scenario, how does this acquisition, or not acquisition, this partnership change the next 5 years for Oracle? Does it help them sell more cloud services?
It does. It's certainly, if you look at it from purely a consumption and bandwidth and collection and harvesting and cloud computing play, it's an amazing opportunity for Oracle. Think about the terabytes of data that they'll effectively be able to hold on to and bill for effectively. So I do think it's a huge uptick, and we saw it in the futures. I think with Oracle too, everyone kind of saw that as another influx of data going into Oracle's cloud computing environment. Again, I think it's all speculation. We're not quite sure how Oracle's going to be working with TikTok, but that's really one area where they could win. And if they go take it the next step, as I mentioned a little earlier, where they get into the actual social media game, just like some of these other big giants, it's one that never even came up in our last few conversations. So it's an interesting play for them. Not to mention the ties with the Trump administration and Oracle as well. It's pretty interesting.
Yeah, I mean, what do you think the likelihood is that the White House signs off on this? If President Trump's biggest concern was security with regards to TikTok, users' information not being given to the Chinese government, do you think Oracle satisfies that for them?
So the juxtaposition is what the Chinese media is saying versus what we're hearing and what we're talking about right now, which is we're saying, hey, there's a partnership. There appears to be some level of control over the TikTok environment. China is saying something very different. They're saying no sale, no algorithm, no source code, which by definition, from a technical perspective, doesn't solve any of the problems at all, because you're not able to control what the app's collecting and effectively where the app is sending data to. The beauty and the curse and the blessing of the internet both is that it can be sent to two different places, right? So if they're going to continue to send the data to what they call their main server cluster for the US that is in Singapore, while sending it to the Oracle environment, it doesn't solve any of these problems at all. So to answer your question, there's a lot of hurdles to get over, I think, to actually, when people start to tick the boxes and say we've actually achieved what we went out to do, I don't know that it'll pass the sniff test as it stands today.
And maybe Walmart, we shouldn't count them out here because Walmart coming out in a statement today saying they're still in talks with ByteDance. I mean, they're not a software company, a tech company in the way that Microsoft and Oracle are. So could we still see Walmart be part of any partnership deal, and what role would they play?
Yeah, I mean, Walmart has its big nemesis of Amazon. So they're doing everything they can to sort of compete in that area. And social media by design is the perfect marketing mechanism. We see this with Chinese apps like WeChat. It's tightly integrated with social commerce. So I wouldn't be surprised if they make some seriously interesting plays there as a competitive move there. And I wouldn't be terribly surprised if we see some sort of consortium situation happen where Oracle handles the collection and databasing of some of the information, while Walmart handles the sort of social app side of it if they can get there. That'd be really interesting. That's total guessing on my part, though.
Kareem, I felt for years, Oracle has been able to fly under the radar. It sells its cloud services, puts up disappointing earnings growth, sales growth. Larry Ellison does his yachting. But doesn't this deal or partnership now put Oracle on par, let's say, with a Google and a Facebook, and getting scrutinized for how much data it holds and how it uses it?
Yeah, absolutely. I mean, the big thing that shocked me seeing this was Oracle doesn't kind of hit the radar for anything consumer. They're a B2B play. They've always been a very big business play, databases, management, cloud services for businesses. Most consumers don't even know who Oracle is, to your point. It's an under the radar type of environment. So this does put them in the crosshairs effectively of people looking at them going, wow, you're taking on something that couldn't be more whimsical and sort of consumer focused with teenagers all over TikTok. I mean, it's a really strange combination, but from a data perspective, it does make sense. But from a marketing and leveraging it as a capability, it is going to be new to them if they're going to take that on.
And since we have you, Kareem, I want to ask a quick question about the 2020 election and hacking and deep fakes. They continue to create a lot of buzz. How big of a problem is this as we near the November 3rd election?
It's a huge problem. Every day these deep fakes are coming out where they're incredibly powerful. Unfortunately, even if they're not perfect, people will look at things at first glance and make an assumption of what they're seeing and hearing. And now deepfakes are moving into audio. They're changing voices around. So it's not just simply the visuals, it's the voices. So you could technically hear a radio broadcast that never happened in theory at this point too. So that combination is extremely dangerous. And it feeds this whole disinformation campaign risk that we've all been worried about and talking about. Yeah, I mean, every year this gets more and more complicated and difficult. So I absolutely think that at this point, the nation state actors that have an intention to disrupt this election have a lot of tools at their disposal.
All right, Kareem Hijazi, CEO of Prevailion. Thanks so much for being with us.
My pleasure. Thank you.
Taking a look at the markets here, about 8 minutes into the trading day, up across the board. Dow up about 180. We've got the Nasdaq rallying about 150 points. The S&P up about 32. We want to talk more about the markets and also Verizon's big push into the prepaid phone market with its latest acquisition. All that coming up. Well, it's feast or famine on Wall Street, right? Pretty busy M&A Monday here. We've got Verizon, Yahoo Finance's parent company, just announcing it's acquiring TracFone, the leading prepaid and value mobile provider in the U.S. The price tag on this deal, $6.25 billion in cash and stock. Joining us now to talk about it is Ronan Dunn, Verizon Executive Vice President and CEO of Verizon's Consumer Group. Ronan, good to be with you, and congratulations on the deal. But let me ask, typically you've got postpaid subscribers and customers sort of being the bread and butter, the more lucrative customer. Why was it so important for Verizon to play in the prepaid phone market?
So we've had a relationship with TracFone now for about 15 years, and we really saw the opportunity to grow that relationship further. And the best way to do that was to acquire the business. Our core business is built around America's most reliable network, but that network serves the entire country, and not everybody is cut out to be a Verizon wireless premium customer. So we have the opportunity to leverage the scale and capability of our asset base, our most awarded network, our strong capability in distribution and in customer experience, and bring that and partner with the deep knowledge of the sector that already exists inside TracFone. So it's a brilliant partnership that allows us to grow, but more particularly allows us to accelerate innovation on behalf of customers in the prepay and value segment.
Ronan, how important is TracFone's relationship with Walmart to this deal?
It's a very important relationship, as is our own relationship with Walmart, where we distribute both postpay and prepay today. TracFone has been awarded as a #1 supplier in Walmart a number of times over recent years, has a very, very strong working relationship. And I've already spoken to colleagues in Walmart about our excitement of working more closely together as soon as this deal is closed. So very important for both Verizon and for TracFone.
Ronan, I know TracFone's got about 21 million customers, 850 employees. I'm curious if there are redundancies there, and do you see the need to have to cut payroll at either company as a result of this buyout?
Far from it. This is very much from a position of strength. We already work closely with TracFone, so we know the quality of the business that's there. So we're looking forward to welcoming 850 employees to join the V team in due course, and really use that, as I said, as a platform for growth. They have a deep knowledge and understanding of this segment, where Verizon has traditionally, as you indicated, been focused in the premium category. This allows both employees and customers the best of both worlds. We have the strength of Verizon, its financial and technical capability, and the deep knowledge and understanding that TracFone already has to allow us to bring innovation and improved experiences to consumers all across America. A genuine win-win and a growth story, no redundancies.
Ronan, how long before lower income consumers who use TracFone, how long before they will start to access 5G? I think we could all agree 5G is now mission critical to learning, to getting work done. Very, very important post-pandemic.
So it's a great question. And one of the things that this allows us to do as a wholesale partner, we had already started our conversations with TracFone around 5G. But one of the things that we can do is bring more of the 5G portfolio. So I've committed that during the course of this year, we will launch 5G nationwide. But we also have a 5G home product, and very recently introduced a 4G home product. And I'm excited about the prospect of actually bringing those products to TracFone's customers. Today in the US, about 7 or 8 million homes use wireless exclusively and have no wireline access. And while that's a small portion of the total households, it's significantly represented in the value and prepay segment. So I'm really excited about not just bringing 5G mobility, but also bringing residential broadband offerings to this segment as well.
All right, Ronan Dunn, Verizon Executive VP and CEO of Verizon's Consumer Group. Good luck with the acquisition.
Thank you very much.
All right, let's take a look now at the markets, shall we? We're about 15 minutes here into the trading day, and a nice rally underway. We've got the Dow up more than 220, NASDAQ now up 200 points on a percentage basis. The NASDAQ is outperforming the rest of the market, up about 2%. We've got the S&P up 1.25%. Let's dive into it now with Nancy Tengler. She is CIO at Laffer Tengler Investments. Nancy, good to have you with us. So we're seeing tech stocks taking off here. Do you think that this is the beginning of a rebuilding for the tech sector, or is this just going to be more wild swings for the rest of the year?
Oh, thanks for having me, Alexis. Listen, I think the tech sector is going to be subject to volatility going forward, but I think the medium and long-term trend is still much higher from here. When you look at some of these companies like a Microsoft that's trading at a price earnings to growth ratio of 2 times, that is not egregious. And this is not 1999. I was investing money then. This is not then.
Nancy, what's the catalyst to get this tech sell-off stabilizing and then back on the right track?
Well, hi, Brian. I do think we need to have institutional investors stepping back in. When you have an interest rate environment like we're facing now, this is not original to me. You have investors willing to pay more for a multiple for growth. And if you look back to 2000, we were at 6. We just come off of 6 rate increases, and that sort of sparked the tech sell-off. I think what we'll see here is once we get through the noise of the election, we get some of the Robinhood traders back to work. The options trading dies down modestly. I think what you'll find is investors are looking at fundamentals, and these are still some of the best companies in the U.S. economy.
But do you think, Nancy, we're going to be cherry picking these tech stocks? You talked about Microsoft not being egregious in terms of PE, but there are a lot of companies out there that are, and a lot of folks consider them overvalued. I'm talking the FANGs most specifically. So do you think we're going to see a rotation within tech over the next few weeks and months?
I do think that, Alexis. I mean, if you look at some of the stocks that have powered this higher, this is growth at any price. We're not advocating for that. We're advocating for growth at a reasonable price because tech CapEx is growing significantly as a portion of total CapEx. Software has overtaken hardware CapEx for the first time ever, above 50% of total CapEx spending. So I think you want to be selective in the group. The chips stocks as well are an area where we're overweight. Look at Lam Research, which recently raised their dividend. Those are the kind of signals from management that tell us that the management team is optimistic. So we're looking for companies that have pretty pristine balance sheets, are still growing, and are raising their dividends.
Nancy, what's your latest thinking on the markets ahead of the election? Certainly, I think the last time we talked, since then, things have changed a bit, not just in terms of the tone of the election, but also the tones in the market.
Yeah, it's been an exhausting year, to be sure. So I think what we know about the market historically is that it tends to telegraph what the result of the election will be. And that usually begins in August, accelerates in September and October. This is a year that is unlike any other year. So I hesitate to draw any conclusions from market strength or weakness, frankly, in the near term. But if we were looking at the economy and took the election noise out of the mix, we are seeing really material growth. The global PMIs and the US PMIs, which measure manufacturing and services activity, are not only expansionary, but they're also growing and strengthening. And so when you see that as a leading indicator, you have to have faith in the US economy. I don't know if it's a V, I don't know if it's a W, we've called it a stair step, but I think that stocks will begin trading off of fundamentals as the election becomes clearer and certainly as it moves into the rear view.
All right, Nancy Tengler, CIO at Laffer Tengler Investments. Good to see you this morning.
Thanks for having me.
Coming up next, we're going to speak with the CEO of the Vitamin Shop, so don't go away. During the COVID-19 pandemic, many have turned to the supplement industry, looking to everything from immunity boosters to probiotics to CBD products to help cope with the uncertainty that the virus has brought on. Joining us now to discuss how exactly the industry is faring is Sharon Lighty, the Vitamin Shoppe CEO. Sharon, good to see you. You know, I know from personal experience early on and even somewhat recently, I've had a tough time finding things like vitamin C. I like to take elderberry to boost the immune system. What's demand been like for those products, and what has supply been like at the Vitamin Shoppe?
Hi, Alexis. Well, thank you for having me this morning. Well, certainly all of those products have been in hot demand, and we certainly had our challenges in the supply chain early on in the pandemic. Since that time, things are back to normal, and we are well in stock in a lot of those products. And as you've seen through the pandemic, and as we've, from the very beginning, from March through the period of today, the thinking on that and what is helping you through this to boost immunity has continued to change. And so certainly we're seeing not only zinc continue to be very strong for us, but even Dr. Fauci even just recently said the importance of vitamin C and vitamin D to boost immunity. So that trend continues. But in addition, we're starting to see things around stress, around sleep, around people that have been cooped up in their homes and they're wanting to get back outside. Fortunately, the summer months has helped some of that. And so we're certainly also seeing changes in terms of getting back into the sports nutrition side of the business with sports nutrition and proteins and other products to kind of help you get back on track and get back to your fitness goals.
Sharon, full and fair disclosure, I'm in your stores pretty much every weekend. And I've been noticing a lot more different products, almost like a product innovation boom. What are some of the newest food trends you're seeing? I see protein chips, different types of bars, that these things were not necessarily here before the pandemic.
Yeah, healthy snacking is really important because, as we all know, getting out and your normal routine of going out to eat, and people are getting fatigued, potentially, cooking at home. So the ability to get healthy snacks is certainly important. And so we've really certainly leaned in on those types of categories so that we can provide options for our consumers. You'll certainly see a lot of that. We also, you mentioned CBD at the top of the segment. And, CBD, we just relaunched our CBD HQ. We have 20 of the best CBD products out there, all very focused on high quality. We are the only national retailer to sell ingestible CBDs in all of the states where we can. And so those are certainly additional trends that you're seeing in the marketplace today.
Sharon, we know that during this pandemic, one of your competitors, GNC, filed for bankruptcy. Now, they did have a very heavy debt load, so different than what Vitamin Shoppe has. But what does that mean for your business, the fact that GNC is going to be closing a bunch of stores?
Well, certainly, whenever you lose a competitor in the industry, you certainly want to do everything you can to try to bring those consumers into their fold. And so we hope that we can, we've reached out to the consumers in the local communities that we served, and we really hope to earn their business. So you'll see us continue to reach out to them. We've made some inroads with some of their suppliers and some of their vendors to be a new partner, to be able to, carry some of the products that GNC maybe has carried exclusively. So again, that we can be there for that GNC consumer in their local communities.
And Sharon, you recently launched same-day delivery with Instacart, right?
Yes, we've been doing all kinds of different things with, meeting the consumer where they want to be, whether it's BOPUS, which we've done a tremendous amount of work around click and collect and buy online, pick up in store, curbside delivery. And just in the last couple of weeks, we did launch Instacart. We are one of their, we have an exclusive relationship with them. And we're excited to be able to compete with Amazon and be able to do same day delivery now.
Sharon, have you had to close any of your brick and mortar stores? I think you had something like 720 of them not long ago. Because of this pandemic, have you had to close any?
Well, through the pandemic, we closed stores like many retailers did. Fortunately, we were considered an essential business in many states, but there were some states and some municipalities where we were expected to close. So at the height of the pandemic, we did have 90 stores closed, and we had, very reduced hours. But in terms of our real estate strategy, we look at real estate throughout, throughout the year. We have closed approximately 30 stores in the year. That was planned for. But just as recently as this weekend, we just opened 2 new stores in the New Jersey area, both South Plainfield and we're very excited to also be opening stores. We've opened 6 stores since the beginning of the pandemic.
All right, Sharon Leidy, CEO of The Vitamin Shop. Continued success to you and the company.
Thanks very much, and you guys all stay healthy. Appreciate your time.
You too. All right, big rally underway. Dow now up about 300 points. NASDAQ up better than 200. We've got the S&P rallying 50. We're going to wrap up the day's M&A activity. There's plenty of it right after this break.
Welcome back to the first trade. Big deals and a rebounding stock market are on everyone's mind this Monday morning. Worries about what the Fed may say at its meeting this week. Well, that's clearly on the back burner as of now. Let's get right to Yahoo Finance and Inez Ferre for a look at several stocks. Inez, Oracle, still halted this morning.
That's right. Oracle shares halted for news pending, and Oracle may have won the bidding for the U.S. operations of the social media app TikTok. Treasury Secretary Steven Mnuchin confirmed that the White House has received Oracle's proposal for TikTok. The Trump administration will be reviewing that proposal this week. We know that over the weekend, Microsoft had confirmed that ByteDance, the owner of TikTok, would not be selling the app's U.S. operations to Microsoft. The U.S. in this case would have to approve of this deal. Also, Beijing, China has said that it would need to approve any deal. We're also watching NVIDIA this morning, up more than 7% after NVIDIA said that it is buying chip designer ARM Holdings from SoftBank for $40 billion, the largest acquisition for NVIDIA. ARM is a company which designs the architecture for smartphone chips, so it is a huge player in that space, which will allow NVIDIA to tap into the smartphone space. Back in July, SoftBank was exploring the sale or partial sale of the British chip chip designer ARM's holding. And also, it had bought ARM for close to $32 billion in 2016. So certainly this is positive also for SoftBank. And we're looking at Gilead this morning, up more than 2%. Gilead said that it is buying the biotech company Immunomedics for $21 billion or 88 cents a share. And it is one of our trending tickers. Immunomedics up more than 102% this morning. Gilead will be acquiring a drug called Trodelvy, which was approved earlier this year for triple-negative breast cancer, a very challenging type of breast cancer to treat. Analysts are estimating that this drug could be a $4 billion drug in the future. Brian?
All right, let's bring in William Platt, Momentum Advisors managing partner. William, good to see you this morning. So what are your Monday money moves here? Do you throw a truck at some drug stocks off that Gilead news, back up the truck on NVIDIA, because clearly it's going to dominate Intel, AMD, many other chip makers, or you just stand pat?
Yeah, so I like the direction that things are headed in the tech space generally. I think that that NVIDIA is going to continue to appreciate over here, and so we like that position. We're going to continue to hold on to it.
You know, in your note, William, you talked about the market being overpriced at the moment, in your words. What areas are overpriced and where are you looking for value right now?
So we feel like the market's way ahead of where the economy is generally. And say that consumerism certainly is, that there's an anticipation that consumerism is ahead of where I think the reality is. I think that there's two separate sort of segments of the market right now. There's people who have, and then there's people who don't have. And I think that if enough of people who don't have are not able to spend, then we're going to have significant issues in the economy. So I just feel like where we are in the market, where we're just NASDAQ trading at market highs and other indexes very close to those highs, we're way ahead of where we should be when you look at the economic hurt that's actually happening in the country.
William, let's just air it all out on Monday morning. What's the biggest downside risk you see for the markets ahead of the election?
Yeah. Well, I think the election is less important than the pandemic, because I think that the differences between Biden and Trump aren't that great when we talk about whether or not the country could shut down or reopen. And when I talk about shut down and reopen, I don't mean just rules saying that that parts of the economy are going to shut down or not. What I'm talking about actually is whether or not people feel comfortable going outside, whether or not people feel comfortable traveling and spending and that sort of thing. So whether tax rates go from 5% one way or the other, or trade deals or environmental deals, and we have a different perspective from the federal government, what I'm much more concerned about is whether or not people are outside and spending and feel freely to be able to take risk. That to me is the bigger concern. Right now, Biden is ahead on most polls. So there is an anticipation there's going to be a change in administration, but that can really change. And the reason for that change could be that people blame, who do they blame if things are shut down for an extended period of time, for instance. Right now, you know, I'm a dad, right? So I have two kids, they both play sports. Right now, people are really upset in Democratic New York that we don't have high school sports. That is a big deal for the state. And people can change from blaming Trump to blaming Democratic leaders for the shutdown and for overreacting to what they see as not as big of a deal because we're kind of past a lot of the worst of the pandemic. So who's going to win? I think that's very much up in the air, even though Biden is ahead on most polls. But at the end of the day, I don't think it makes as much of a difference because the bigger deal is whether or not people feel comfortable spending money.
William, how are you playing the vaccine trade at the moment? Are you involved in any of the companies that have these vaccine trials for COVID-19? And if so, which ones?
Yeah, that is a rapidly changing environment. So I've been more going into ETFs as a firm. We've been going more to ETFs just because week by week, day by day, people are coming out with new vaccines and new technologies. Frankly, the vaccine could be important, but it could also be about treatment. It could also be about the technology of more rapid testing and cheaper testing. So there's so many dynamics to that whole scene in terms of which is most impactful. So I've preferred to go the more ETF route, and then and just hope that that the company that's in there is able to that I have exposure to that company.
All right, I'll leave it there. William Platt, Momentum Advisors Managing Partner. Good to see you.
President Trump is
Thank you. Good to see you.
President Trump is touting a new executive order that he says will bring down prescription drug prices. He signed it yesterday, and the drug industry is already firing back. Our healthcare reporter, Anjali Kamlani, is with us now. So, Anjali, what does this order actually do?
So this order is a little different from what was signed in July, because he's looking at not just Medicare Part B, but also Medicare Part D, and so that expands the government, programs that can be controlled by this executive order. So what the order really looks at is giving Americans the discounted prices that we've seen in other countries where governments do in fact negotiate pretty strongly with these pharmaceutical companies. There's been a mixed reaction to this, largely a pushback from the drug industry saying it's not going to achieve the level of savings that's anticipated, as well as the regulatory burden that it faces this order in terms of changing things in time, before the end of the year, likely before Election Day, is not going to happen. And that seems to be one of the biggest reasons behind this push. In addition, some of these companies are also saying that it could cut back on innovation if companies are forced to just arbitrarily lower their prices. So really, an interesting look at what it could potentially mean, and waiting to see really how it all pans out.
And Anjali, Pfizer's CEO certainly making some noise over the weekend.
Yeah, so the company is looking to expand its phase 3 clinical trials. We know that they've already committed to that 30,000 number. That seems to be sort of that standard number for this late stage trial. That's going to indicate just how well the vaccine candidate performs. But we're looking at the larger trial to include participants as young as 16 years old. So that's leaning into that sort of pediatric territory that has not been really touched on just yet, as well as those that have HIV. And so that really expands the number of people that this vaccine could be useful for. As we know, all the vaccine candidates face a number of obstacles in terms of how effective they can be, how long they will last, as well as who they'll be most effective in, whether it's an older age group, younger, or just across the board. So that's something that will be discovered through this expanded trial, if approved by the FDA.
And Anjali, we have to ask you about AstraZeneca resuming its trial in the UK, but still on pause here in the US. What's the latest?
Right. So basically, the company has to go through a larger investigation of what happened in the UK. So right now, a UK trial is back on track. The company does look like it's looking at that by the end of the year, a sort of timeline. So everything on track for that, and looking to see what that means for the US, in terms of continuing that trial.
All right, Anjali Kamlani, thank you.
All right, I do want to quickly get to some breaking news here. Oracle has confirmed it is part of the ByteDance proposal to the U.S. Certainly a situation we will continue to monitor here at Yahoo Finance. But one of the country's most well-known gym chains is now bankrupt. We'll tell you who on the other side of the break. Welcome back to the first trade. The COVID-19 pandemic continues to wreak havoc on gyms. Town Sports International, the owner of New York Sports Club, filed for bankruptcy today. Nez Ferrer is back here with the details. Well, Nez, looks like a lot more workouts for me on my Peloton bike.
Yeah, you and many other people that are working out from home, not going to the gym. The owner of New York Sports Club, Town Sports International, has filed for bankruptcy. Right now, the stock is down more than 14%. It's trading at 23 cents a share. Last week, the company had said that that talks had collapsed for financing that would have helped it really to navigate COVID-19. It had warned recently that it may have to file for bankruptcy protection, as some gyms across the U.S. are still closed, saying the scope and duration of the interruption to our operations has substantially reduced our cash flow. And to preserve cash, the company had laid off as many as 7,000 workers. It stopped paying rent. The company had said that it didn't have enough cash on hand to pay back a loan that was due in November. Now, for now, Town Sports says that it won't permanently close any of its gyms, but really the fitness industry has been just hammered by the pandemic. Gold's Gym, 24-hour fitness, also filed for bankruptcy during the pandemic. And even as gyms are starting to reopen, they're reopening at limited capacities, and some members are just too nervous to go back to the gym. Year to date, this stock is down 86%, Brian.
All right. Thanks so much, Nez.
Well, the wheels keep on turning for Peloton after the company's blowout earnings report. And Brian, I know you had a chance to speak with the CEO and co-founder, John Foley, about their very ambitious goal of wanting to have 100 million subscribers. What did he tell you?
Yeah, Alexis, I asked him what does he see for the next 15 years of Peloton? Here's what founder John Foley told Yahoo Finance.
Yeah, so we have I call it a BHAG, a big, hairy, audacious goal of having 100 million members, 100 million subscribers, and a net promoter score of 100. To our knowledge, there's not a company in the world that has a 100 net promoter score, and certainly 100 million subscribers gets us in that rarefied air of some of the FANG stocks. And we think that Peloton has the opportunity to be one of those special companies, and we have thousands of people at Peloton who are marching in that direction every day, and doesn't look like we're slowing down anytime soon.
Now, Alexis, to be fair here, Peloton ended its most recent quarter with 3.1 million members, so they have a long way to go. Also here, let's keep in mind, Netflix has close to 200 million subscribers globally. You can make the case that Peloton is well on its way to that 100 million goal, but 15 years is a long time from now.
Do you think maybe they'll have to make some acquisitions to acquire some of those subscribers along the way? Did Foley talk to you at all about acquisition opportunities?
We did. I asked him about acquisitions, Alexis. Peloton ended its quarter with $1.8 billion in cash, virtually no debt, excluding about $500 million they have for their over 100 retail stores they have open. Very clean balance sheet. I think you're going to see Peloton get a little more active on the acquisition front. It may come in content, it may not be hardware, but I would expect over the next 12 to 18 months they pull the trigger on something. All right, we'll leave it there for right now on all things Peloton. Now, Nikola's shares are getting pummeled again today as investors still digest a short seller's fraud claims. But Nikola has responded to the allegations. We'll tell you what they had to say coming right up. Welcome back to the first trade. Pressure continues on shares of Nikola following a strongly worded short seller report late last week. Nikola is returning fire today. Inez Frey is back with the details. Inez, I don't know about you, but I'm getting very captivated by this story. Strongly worded press release out of Nikola this morning. The release they put out on Friday didn't cut the mustard. Stock fell 15%, but it's still under pressure this morning as well.
It's still under pressure, but not as much as it was on Friday after releasing that initial statement that you're referring to. It was a statement that didn't have many details in it, and that left investors worried. This was in response to the Hindenburg report, the short seller report, which claimed many allegations against Nikola, also claiming that the company was a fraud, basically. This statement that Nikola has put out this morning, much more detailed. It says also, Nikola says that it's alleging that the report was designed to provide a false impression to investors and to negatively manipulate the market in order to financially benefit short sellers. But it really goes a little bit more line by line on some of the allegations. Nikola's response in part states, for example, that the short seller alleges that in 2016, the Nikola One was not a real truck and was in fact a pusher. Nikola says the Nikola One is a real truck and sits in Nikola's showroom. Its batteries were functional, inverters were functional, power steering, suspension. It also talked about this third-party video that the Hindenburg report was referring to, where it says that the Nikola One was rolling down a hill. Well, Nikola says that it never stated its truck was driving under its own propulsion in the video, although the truck was designed to do just that. Also, it says this is a 3-year-old video, and it says that Nikola has real working hydrogen fuel cell-powered semi-trucks. It also talked about some allegations regarding a Bosch employee that had spoken to the Hindenburg report, saying that Bosch stated that specific instances in the Hindenburg report, quoting a Bosch employee, were taken out of context. So quite a bit of a rebuttal here. Investors seem to be more pleased, at least, with this more detailed rebuttal to that Hindenburg report than what was released last Friday, Brian.
Inez, what are you seeing in Tesla this morning? I would argue the past week, these two stocks have traded in tandem.
Yeah, that's true. Right now, looking at Tesla up more than 5%. If we just take a look at a 4-day chart, up 18% over the last 4 days. Really interesting that Elon Musk on Friday, when Nikola was just being hammered, tweeted many exciting things will be unveiled on Battery Day on September 22nd. So a lot of expectation on this upcoming Battery Day, a lot of speculation over a possible 1,000,000-mile battery that may be announced on that day. A lot of anticipation going into Battery Day for Tesla. Brian?
Thanks so much, Inez. Okay, Paris Hilton is no stranger to the spotlight and apparently also no stranger to identifying potential winning investments. Let's bring in Yahoo Finance West Coast correspondent Melody Hom. Melody, you had the chance to speak with Hilton about her investing style. What did she have to tell you?
Yeah, and Brian, of course, Paris Hilton can be seen as the OG influencer, right? So in many ways, she was always able to use whatever social media platforms, whatever outlets that she was given to kind of push a brand. So I asked her about some of the investments that she's made over the last couple of years and what the common thread seems to be as she looks across her portfolio. Take a listen.
I love investing into entrepreneurs that I believe in products that are sustainable, in health, wellness, longevity. And also, I love getting advice from my boyfriend, Carter, because he has his VC fund, M13. So they have just so many amazing projects being sent to them every single day. So anything that is interest of that would work with my brand, Carter and I are always talking about things every single day. So it's amazing to have a businessman as my partner and the love of my life, because he just inspires me to even want to be an even better businesswoman than I am.
Wow. So in the future, do you anticipate carving out sort of more of your money into the VC space? How do you think about how that portion of your life will continue to grow?
Yes, I think it's really important just to invest into projects that I believe in, put my name behind them. And I don't know, there's just so many amazing projects out there. If they have the right funding, they could really just blow up.
And just to call out a couple of the names that she's behind, Sazi, I'm sure you're familiar with Daily Harvest, those prepackaged smoothie sort of freezer combinations. M13, the VC fund she mentioned, is behind that. They raised their seed round through M13. Then, of course, there's Glam app, which is very much like the Uber of all the 24/7 glamifying right now. She actually was using Glam app prior to our interview, so you know that she does test out the products that she invests in. And of course, the latest one is the plant-based seafood company called The Good Catch. So across the board, she's starting to dabble, right? And it helps that M13 is a very consumer-facing portfolio. So in many ways, they're products that would be very familiar to her and that she could get behind.
Yeah, she definitely gave a nice shout out to her boyfriend Carter's VC fund in there, Melody. But I know you also had a chance to talk to her about TikTok, and we know that Paris herself is a big influencer. So what did she think about the saga surrounding TikTok?
Yeah, let's think about the context here. So Paris Hilton is 39 years old. The Simple Life, that smash hit show that debuted, was in 2003. So she was 22 years old at the time. And there was no social media, right? There was no outlet. So now she's so bullish on this app TikTok, of course, that we've been covering at length, mostly for the geopolitical ramifications and the way that it has become a punching bag between the US and China. But she specifically said it is her favorite app, bar none. Instagram is kind of a distant second, but mostly it's because of the variety, because of the sort of rawness and vulnerability that creators are able to show, perhaps in a way that she wasn't able to, right? When you think about the way that she had to really curate and craft her life, the reason I actually spoke with her in the first place was because she is out with a documentary today that's supposed to kind of recreate her legacy, because she feels like a lot of her life was a caricature in many ways, whether it's the "that's hot" phrase and a lot of the sort of blonde bimbo persona that she felt like she had to exemplify and show the world in order to be popular. I think TikTok is the polar opposite, right? There's a lot of sort of silliness, fun, people looking really, really disheveled and not really glamming up in the way that Paris Hilton has been used to. So I think it's just augmenting that part of her life, perhaps, that was missing. I do also want to point out that she is reportedly the highest paid female DJ in the world. So not only on TikTok, but on Triller, she participated in their virtual music festival earlier this year during the coronavirus pandemic. And that seems to be a sort of activity that she's really passionate about pursuing in the years to come.
Wait a second, Melody. Simple Life was 2003. It feels like
Yes.
yesterday.
17 years ago, Saz. Where were you when The Simple Life aired? I know I was glued to my couch, sort of binging, even though I was a grown adult. I could not stop, covertly watching the show because I knew it probably wasn't good for me.
I don't know. Maybe I think I was outside 7-Eleven trying to scrub an Old English or something, but we'll leave it there. Melody Hom, really great stuff.
Thank you.
All right, do stick around. Up next, we'll look at how wealthy sports stars are investing their money during the pandemic. Welcome back to the first trade. Let's get back to Inez Ferre for a look at several stocks. Inez, Amazon continuing to gobble up human beings to work in their plants.
That's right. And Amazon now planning to hire some 100,000 workers in the U.S. and also in Canada as e-commerce just continues to surge during the pandemic. Amazon says that it will hire full-time and also part-time worker at dozens of locations. The jobs will start at least at $15 an hour. Remember that Amazon will be holding a career day this Wednesday. Last week, it had announced that it was going to hire for some 33,000 job openings for corporate and also tech positions in the area of Alexa, AWS, and also Prime Video. I want to mention Viacom CBS, up more than 1.5%. Viacom CBS is going to be selling CNET to Red Ventures for $500 million. Last month, the Wall Street Journal had been reporting that it was in talks. The two companies were in talks last month for this deal to go through. CNET was acquired by CBS in 2018 for $1.8 billion. So you can see the valuation of the company that just went down from there. It was at one point one of the most popular digital networks in the US. I want to mention also an anticipated IPO that will be happening this week. Snowflake, the cloud company, it has raised its price range to $100 to $110 a share. That's up from 75 to 85. And it's offering 28 million shares, hoping to raise some $3.08 billion. It will be trading under the ticker symbol SNOW. And one last mention, Brian, that I just want to note that Oracle shares have started trading again. They were halted for trading for news pending earlier this morning. The stock is up more than 6%. Oracle has confirmed that it is part of a proposal to acquire the U.S. operations of TikTok from ByteDance, or a proposal for a deal, I should say, with ByteDance. And the U.S. will be reviewing that proposal. Brian?
The NFL season is underway, though this time around it feels a little different, with nearly 70 players opting out due to the coronavirus pandemic. They're giving up their usual salaries for a $150,000 stipend. But could these NFL players who choose to sit out this season actually increase their wealth in the long run? Joining us now is Justin McCarthy, an advisor at Mariner Wealth Advisors who works with pro athletes. Justin, good to see you this morning. What are you telling these athletes right now? Justin, you might be on mute.
It's not so different, Brian, in terms of what we're typically telling NFL players in other environments, in the sense of it's a very volatile career path. So, managing both the short and medium term cash flow needs, along with kind of what their long-term goals might be, is really critical for a player in this position. And now it's even more highlighted by the fact that not only with the decision of opting out of the NFL season, but also the potential of the season being shut down. Obviously every week it seems to change on the likelihood of that, but it is a potential. So it's been different for every player, whether you're a young rookie or a 10-year vet.
Are they foaming at the mouth to get involved in the stock market? The market has had a tremendous run, has defied a lot of odds this year. Where are they allocating their cash?
I think the short answer is yes, especially the young guys who maybe haven't experienced some of the down periods. So you get a rookie who's recently drafted, first coming into money in the last 3 or 4 months. Yes, they see certainly a 30% rise in the markets, and they start chomping at the bit. Typically what we're telling guys in their rookie seasons is get through the first season, figure it out come January. Let's not try and make short-term decisions just based on what's happened over the last couple months. The veterans, that we've been working with for a long time, who we spent a lot of time kind of educating them on the potential risks and rewards of the markets, they're a little bit more savvy at this point about kind of what to expect, especially with the elections upcoming. So again, it's managing the cash flow and what might change for them if the season were to get shut down. There's not a lot. I thought more people would opt out, honestly, because believe it or not, there's not just the health concerns, but there are certain situations with players where the way the contracts toll from one year to the next, it actually might be financially beneficial for certain players to opt out.
Yeah, Justin, I wanted to ask you about that, because you actually say that opting out could actually increase a player's wealth in the long run. Connect the dots for us there. How do you see that?
So it's kind of a very select circumstances, but you have contracts, and especially everybody talks about in the NFL how there's guaranteed money and a lot of unguaranteed money. If a player is, for example, in a long-term contract already, and what happens if the season were to get canceled midway, let's just say, for example, any guaranteed money that they had this year rolls forward and essentially becomes guaranteed in the year that they first don't have guaranteed money. So just as an example, let's say I have a player who is in a 5-year, $25 million a year, $25 million total contract, 5 a year, and they play half of the year. Let's say the first 3 years are guaranteed, they play half of this year. That $2.5 million that they didn't get paid this calendar year because the season got shut down would roll forward into that 4th year. Now, depending on how a contract might be structured, you could have a player who has a implied guarantee, so to speak, where let's say that year that it rolls forward to already has a large portion of it guaranteed. Odds are the team's going to want to pay that remaining unguaranteed piece because they're not going to pay a large sum of money and then let a player walk away for a fraction of that year's pay. So a player that has that kind of money, if they only play a portion of this year and that rolls forward, it actually could turn into a net negative cash situation for them, obviously depending on a lot of variables. But, the few players that we had that we highlighted those situations to, I'll tell you, all decided to play, whether it be because they were in the first year of a big contract and they didn't want to, show their teammates and coaches and all this that, hey, I don't want to say they were guilted into it, but they themselves chose to kind of be a team player and show up and play. They weren't individuals that were concerned on the health side of things.
Right. And also, your shelf life in a sport like football could be somewhat short-lived. So I'd imagine they want to get out on the field if they can at all. But how do you help them time big investments, given all the uncertainties about regular cash flow for a lot of these players? I mean, if they want to buy a house, a car, et cetera, how do you help them time out those big purchases?
It's really about communication, so to speak, where we're showing them, not just saying, hey, this is a concern, that's a concern, and why, but actually showing them the different scenarios, modeling out cash flows in terms of worst case scenarios, maybe even best case scenarios, but maybe highlighting more of the worst case scenarios. That way, the individuals, the players in this case, can make decisions on their own. They don't just need us to say, hey, yes or no to something. It's really more a function of letting them see what we know, so that they can help themselves make the best decision for whatever their situation is. But again, and there's some things that they might not figure out. Like, for example, you might have a veteran player looking to purchase a home. We might actually, that player's finances dictate they could do that with or without this season's pay. We might want to do that sooner rather than later so they can qualify for an optimal mortgage based on their income requirements and things like that. Whereas obviously a younger player, less financially established, we might want to kick the can down the road for some of those kind of bigger ticket items so that they're not in a cash crunch in those worst case scenarios of the season getting shut down.
All right, let's leave it there. Justin McCarthy, advisor at Mariner Wealth Advisors. Good to see you.
You too, guys. Thanks.
Okay, don't change that channel. We have Kroger's chairman and CEO on with us shortly to discuss his firm's blowout quarter. Stay tuned. Welcome back to the first trade. Investing in collectibles isn't exactly easy. I mean, where are you going to store a $3 million Ferrari Enzo or a $2 million Honus Wagner card? Ezra Levine is the CEO of Collectible, a new site that aims to make investing in collectibles much easier. Ezra, break this down in the simplest terms. How does this work?
You got it. So we're on Yahoo Finance, of course, right? So most of your viewers, I'm sure, are familiar with the stock market. We're applying very similar traditional stock market principles to the memorabilia and cards industry. We do this through something called fractionalization. The only other way to invest in the best sports collectibles of all time previously was to acquire an item outright via auction, via eBay. But here's the are too far out of reach for the average sports fan.
Alexis, looks like we're having a little technical difficulty there with Ezra, but it's a pretty fascinating concept.
It is, because what you can do is, I think one of their first things that they're going to be launching is this $2.5 million Mickey Mantle Topps card from 1953. And you'll be able to buy a fraction of that card. So you can invest $25 in that $2.5 million card. You don't get to keep the card. You don't get to have the card on display in your home, but you are having a piece of it. You have a little skin in the game, so to speak. Let's see if we have Ezra back. Are you there, Ezra?
I'm here, guys. I'm here.
Okay, awesome. I've got a question for you. I just explained a little bit about how folks can get in and buy a fraction of the collectible. Are you buying these collectibles outright and then sort of becoming a market maker, so to speak? And if so, where are you finding the capital to do that? I think we lost Ezra again. All right.
But it really is, Alexis, so many people want to invest in collectibles, but where do you store the stuff, right? Where are you going to put it? I have no garage for a Ferrari Enzo.
Yeah, it's funny you mentioned
sports fans of every income bracket all across the country.
Yeah, we're gonna try to get Ezra on again, because I think there's a lot of interest in this topic. It's similar to what Rally Road does. I think they're now called Rally. I had interviewed the folks a couple of years ago when they first started, and that's when you can actually own a fraction of a classic car, even though you're not going to have that car in your garage and be able to go out and ride it. They got into sports memorabilia as well, but the difference here is this company, Collectible, only deals with buying fractions of sports memorabilia. So again, we're going to try to have Ezra join us at a later date, so we'll let you know when you can tune in for that.
All right, let's stay on the consumer here. Walmart is no stranger to testing out drones to help move around merchandise. But now it's becoming even more serious in the space. Let's bring in Yahoo Finance correspondent Julia Roche for more on this. Julia?
Yeah, more news from Walmart around on-demand drone delivery and their testing efforts there. Of course, just last week, they were talking about testing or piloting a program with fly trucks in Fayetteville, North Carolina. And now they're teaming up with Zipline to do a trial run in Walmart's home state. They're basically their home base of Northwest Arkansas. Let me give you a little bit of context about Zipline. This is a medical drone delivery company. It was founded, I believe it was founded officially back in 2014. They garnered a lot of attention back in 2016 for a lot of their work they were doing in Rwanda, specifically delivering critical medical supplies, including blood, to some of these hard to reach medical clinics. In a span of 3.5 years, they went from 100,000 product deliveries to 200,000 across thousands of medical facilities across multiple countries. And they've had a lot of success. This company's garnered a lot of attention, a lot of big investors, including Andreessen Horowitz. And a recent valuation put it at $1.2 billion just last year. But aside from that, here they are partnering with Walmart to trial this in Arkansas. They can go from about a 50-mile radius from a store to deliver product. So that's about the size of the state of Connecticut, to give you some context. And they're going to be delivering to start select health and wellness products. It really fits along with a company known for delivering medical supplies, as well as eventually moving into more general merchandise. So, of course, this is really what the future of delivery will look like. If this is something that really takes hold. It sounds promising based on what Tom Ward, who runs customer product for Walmart, was saying. Is this is the kind of company that really has the scale here, referencing some of the work that they were doing in Rwanda, as I was just talking about.
Hey, Julia, who has the upper hand here when it comes to drones and delivery with drones? Because I know Amazon recently received FAA approval to test its own Prime Air delivery drones. So with this deal with Zipline, does Walmart sort of have an edge over Amazon at the moment?
I think it's too early to say, Alexis. And I, of course, Walmart is not the first company to look in this space. You're just referencing Amazon. I believe UPS as well. But this could potentially be what the future looks like. And I think when you think about Walmart, 90% of the U.S. population lives within 10 miles of a Walmart store. I certainly was one of them growing up. I actually grew up 12 miles from a Walmart store, but effectively they could act as mini warehouses here. And if this company that's done more than 200,000 deliveries at this point, and when you think of Rwanda, I mentioned it was a very hilly and mountainous country. To get successfully medical supplies to these hard to reach clinics, that's something that's going to be really, really interesting to watch. Again, I think it's too early, but this is a space that's going to keep getting heated up and a lot of excitement's going to be focused on it.
And Julia, it looks like Walmart has lost out on TikTok.
That's what it seems for now. Although my read from that statement that I sent around, they had their 8K filing that came out last night. Sounds like they're still interested in a deal, even by partnering with interested parties. So I don't know. Maybe it's still a little bit too early here, Brian.
Fair enough. Julia Roche, thanks so much. Okay, coming up, we have Kroger Chairman and CEO Rodney McMullen. Stay tuned. Welcome back to the first trade. Kroger is fresh off a big second quarter as the country cooks at home during the pandemic. That was most evident in Kroger's digital sales, which spiked 127% in the quarter. Joining us now is Kroger Chairman and CEO Rodney McMullen. Rodney, always good to speak with you here. Have to start with the digital sales, up 127%. That was not necessarily the case pre-pandemic. What changes are you seeing amongst consumers? They just appear to be shopping much differently than they were.
Thanks, Brian, and thanks for the question. Good seeing you again as well. There is no doubt people are shopping differently. People aren't going to the stores as frequent, or the digital is frequent, but the basket size is significantly larger. And one of the things that, as part of Restock Kroger, we had made significant investments on our digital and technology platforms. And when COVID started, our business doubled overnight. And everything was able to support that because of the investments we had made. And I'm so inspired by our associates. If you look at our pickup business, we hired over 40,000 associates to take care of over 100% growth in demand. And the customers are telling us they appreciate it, they find it helpful, and it allows them to not physically be in a store if they don't want to be. And that's really what we're out trying to do, is just take care of the customer any way they want to be taken care of.
Those digital sales were certainly impressive, up 127%. But then, you look at the competition, they're doing pretty well too. Digital sales at Target up about 200%. Albertsons up nearly 300%. How do you compete effectively? What resources are you putting into digital, and how do you differentiate yourself, Rodney?
Yeah, for us, if you look at differentiation, we're really focused on fresh products and personalized experiences and keeping that direct connection with the customer. And one of the things that we've done for years is making sure that each customer, the offers they have, is personalized for them. I think it's always important to remember where each company is starting from a base and looking at the growth. We're super proud of the, well over 100% growth. Customers are engaging with us. We're still getting a lot of new customers that hadn't engaged in Kroger at all, and a lot of customers converting to digital. So we're really proud of the whole digital team and all our stores and supports facilities in terms of taking care of that 127% growth. And we would expect to continue to serve those customers.
Ronnie, are you preparing for another surge in pantry filling? Maybe not to the extent we saw back in March, but are you preparing for another fill up ahead of the winter months? There's a lot of concerns out there that we might see a new spike in COVID-19.
Yeah, well, I think it's always important to plan for the worst and hope for the best. And we have we've gone out and leased incremental warehouse space, certain hard to find products. We are starting to stock up on those to be ready for the customers. And if it doesn't happen, obviously that's fantastic for society and for the U.S. But we want to be there for the customer, and everything we do, we try to always plan for the worst and hope for the best, because hope isn't a strategy. Our customers tell us they expect another wave, but they really aren't behaving yet as if there will be another wave.
Certainly when we were at the height of things a few months ago, we saw a lot of food price inflation, lots of prices going up for those hard to find products on store shelves. Has that food inflation started to ease now?
Yeah, inflation in the second quarter still was reasonably high, and the retail inflation that our customers experienced was less than the cost inflation we had. As you look in the third and fourth quarter, especially in the meat area, we expect inflation to be back to normal. There's plenty of supply out there. A lot of the higher inflation in the first and second quarter was because so many plants were offline. But those plants are starting to come back online now. So we expect a little bit of inflation, but not significant inflation.
Ronnie, I know a lot of investors are focused on that partnership that you inked some time ago with Ocado. What do you have coming down the pike with them? How many of these automated robotic distribution centers will you open up over the next 12 to 18 months, and what will they help you do?
Yeah, if you look at Ocado, Brian, they've done an incredible job of having an incredible efficient process of serving customers. And if you look at England, where they're most developed, their business, significant increase, very efficient from a cost to serve a customer, both from a picking an order and delivering that order. We expect to get two sheds, as they call them, open up early next year, one in Florida and one outside of Cincinnati, Ohio. And by partnering with Ocado and learning from some of their other partners, we think those will be incredibly important on serving customers that really, it takes digital to the next level. And if you look, I think we have 6 or 7 facilities we've committed to. We would expect as you get later in the year to open 1 or 2 additional sheds as well. And we have several under construction, several in different planning, but those 2 will open up in the spring of 21.
Rodney, I know that you're bullish on the future. You actually raised your outlook for next year for your business. But this morning, you got an analyst at Bank of America downgrading Kroger from buy to neutral. This particular analyst telling clients that the pandemic-driven food at home trend will continue to decelerate. What would your response be to that analyst call this morning?
Yeah, well, we respect all the analysts that follow us. We're really focused on taking care of our customers. One of the things that we shared with our investors is if you look at 2021, we would expect 2021 to be higher than what 21 would have been without the pandemic. And we thought it was really important to give that insight. The other thing that when customers are telling us, what they're telling us is they enjoy cooking at home, they enjoy eating as a family, and it's starting to become a habit versus something that's just temporary. And all of those things give us incredible confidence and expectation for the future. We certainly hope the country isn't in a situation where people feel like they have to do, panic buying, and they're able to, continue to get back to normal in terms of what the new normal is. But for us, the thing that we're always super excited when we're able to support families to eat as a family. And that's really what people are learning how to cook, and they're telling us they enjoy it. And we don't see that changing.
Rodney, real quick before I let you go, 15 seconds. Do you have any plans to roll out a Walmart Plus type subscription service?
We do. We are testing a subscription service and have been for several months. And we're really focused on being there for the customer, whether it's a membership. And we've had fuel rewards and a membership program for several years that a customer didn't have to pay for.
Mm-hmm. Well, good stuff, and definitely a good quarter. Kroger Chairman and CEO Rodney McMullen, look forward to speaking with you again soon.
Thanks, Brian. Thanks, Alexis.
All right, let's get back to Inez Ferre for one last quick hit and look at the markets. Inez?
And Brian, tech is leading the gains today. Apple up more than 1.5%. Apple will be hosting a big event tomorrow. It's expected to be the Apple Watch 6. The event is called Time Flies. We're also taking a look at Oracle shares up more than 5% after Oracle confirmed it is part of the proposal for ByteDance's TikTok operations in the U.S., in which Oracle would serve as the technology provider. And we're watching NVIDIA up more than 6% after NVIDIA said it is buying the chip designer ARM Holdings from SoftBank for $40 billion. Brian?
Thanks so much, Inez. All right, On the Move is up after the break. They'll be speaking with Olympic gymnast Ali Raisman to chat about the state of the sport in Tokyo 2021. Do stick around. On the Move is coming up next.
It's 11 a.m. here in New York City on this Monday, September 14th. We are 90 minutes into the trading session, and stocks are trading higher to kick off the trading week. We've got the S&P 500 up more than 1.5%. The Dow is up more than 300 points, about 1.2%. And the NASDAQ is up more than 2%. It's up about 250 points. The last dance, Oracle beats Microsoft in the battle for TikTok, but the deal is not what many originally thought it would be. Going all in, NVIDIA makes a massive deal in the chip sector, agreeing to acquire ARM Holdings from SoftBank for $40 billion in cash and stock. And charging forward, Nikola fights back, lashing out at Hindenburg Research after the research company, the short seller, called the company a fraud. Welcome to On the Move. I'm Adam Shapiro along with Julie Hyman. Joining us this hour on the panel are Yahoo Finance's Julia LaRoche and Brian Chung. But right now, we've got a lot of deal making in the news this morning, and it's apparently no deal for Microsoft and TikTok. Oracle confirmed within the last hour it is part of a proposal submitted by ByteDance to the Treasury Department to become a, quote, trusted technology provider. Now, Microsoft issued a statement saying it would not be buying TikTok, and this is a quote from Microsoft. ByteDance let us know today they would not be selling TikTok's U.S. operations to Microsoft. We are confident our proposal would have been good for TikTok's users while protecting national security interests. The Trump administration, remember, has set a September 20th deadline for ByteDance to essentially sell its U.S. operations or risk being blocked here in the USA.
You mentioned NVIDIA as well, Adam, and I just want to run you through the details of that. NVIDIA shares, by the way, about more than 6%, more than 6.5% right now. This is one of the largest semiconductor deals ever. NVIDIA is going to be buying ARM Holdings for $40 billion from SoftBank. It's a cash and stock deal, $21.5 billion in stock, $12 billion in cash. There's the potential for an additional $5 billion payment to SoftBank if ARM hits certain financial targets. And NVIDIA is also going to be issuing $1.5 billion in stock to ARM employees. Masayoshi-san bought ARM for SoftBank 4 years ago for $32 billion, so not getting much of a premium there. And he struggled with operations at the company. NVIDIA, remember, is a graphics chip maker. ARM makes chips more for smartphones. And there are some questions here about what this is going to do to ARM's client relationships if NVIDIA is a competitor to some of the companies that it's also supplying.
And then, of course, Gilead Sciences. They are buying biotech company Immunomedics. It's a $21 billion deal that will help Gilead expand its cancer treatment portfolio. Now, Immunomedics, they make a drug, Trodelvy, which is an FDA-approved treatment for metastatic triple-negative breast cancer. About 15 to 20% of all breast cancers are triple-negative and tend to be found in younger women. Gilead Chief Executive Daniel O'Day issued a statement saying, quote, "This acquisition represents significant progress in Gilead's work to build a strong and diverse oncology portfolio." Gilead Chief Executive Daniel O'Day saying that in a statement the company issued this morning. But the real news is TikTok, because the deal's not done yet. It still needs essentially regulatory approval from the U.S. government as well as from China, which had been essentially slowing down any kind of deal. Let's bring this to the panel and start with Brian. What do you make of this? Would the Chinese agree to perhaps not a sale, but a trusted technology partner?
Well, and that's the thing, Adam, that you quite rightly point out, which is that, yes, we know that Oracle is going to be TikTok's dancing partner here, but we don't know what that dance is going to look like. So when it comes to this TikTok deal, we don't know if it's going to be an outright sale. Reporting makes it sound like it's not going to be a direct purchase of TikTok assets. Instead, it might look something like a partnership. We haven't heard from either TikTok or from Oracle exactly what that setup is going to be. Keep in mind that something that developed over the weekend as all of this was moving pretty quickly was the news that the TikTok algorithm, which, for example, decides what types of posts you might see on your feed first, will not be part of that sale, and that ultimately TikTok would be holding on to that under whatever holding company structure they have in China. The argument is that that significantly waters down the value of TikTok to any sort of U.S. buyer, which could be behind the reason for Microsoft ultimately bowing out as the final potential suitor here. So I think there are a number of details that we need to see here. And you also rightly point out, Adam, that this does need to go through the requisite approvals here in the United States. Steven Mnuchin, the Treasury Secretary, saying earlier this morning on CNBC that the CFIUS committee, which kind of works with these U.S.-China dealings, will have to review that. But he said that there will be a meeting this week to discuss that. So a number of details to hammer out, but we know it's going to be Oracle. Again, the real tell here is going to be what the final details of this transaction ultimately look like.
Yeah, Adam and Brian, I think that's key is the details, and it's still very much too early here to really make a proper assessment. But you are starting to see the sell side, some of the sell side research analysts come out with notes as to what this deal could mean. I just want to reference one that came out just moments ago from Bank of America, and they're basically saying that this partnership structure could be much better than an outright acquisition. And they specifically say a partnership structure where Oracle does not acquire the underlying algorithms and instead takes a stake and handles cloud services, security, and privacy would likely be more palatable to investors than an outright acquisition. Elsewhere in the note, they talked about hypothetical TikTok monetization. They said that the base case here could be $630 million in revenue, up to $6 billion, according to this note. And they were referencing just kind of a comparison to the average YouTube revenue, I guess, for making their base case here. But they certainly say Oracle could generate $630 million in revenues in their base case. So pretty interesting when you start to see the sell side step in here and start to kind of assess what does this mean and what could it mean financially for Oracle should the deal go through.
I think the should the deal go through is still a big and interesting question. Even if it does go through, I think that the sort of assessments of how this was handled and what it means for future deals and other future sort of government intersection with this kind of private transaction. As we know, Larry Ellison is someone who has donated to President Trump's campaign and had been a supporter of his in the past. So there's been speculation about whether this was a factor in Oracle winning this partnership. So I think that's something that deserves further scrutiny here as we continue to assess this deal, partnership, whatever you want to call it, whatever it turns out to be.
Okay, so M&A is a big part of the story today. Markets are enjoying whatever because we are in the green. Let's bring in someone who makes their living watching these markets. Sarah Kitterer is Causeway International's Value Fund Portfolio Manager, joining us from Los Angeles, California. Wanted to ask you, before we jump into these markets, the broad picture, all of the news of M&A that's taking place, is this a reflection of COVID realities and having to get stronger and more efficient? I realize TikTok is CFIUS related, but what we're watching in the other M&A activity, what do you think?
I think this is another byproduct of tremendous amount of monetary liquidity and also a huge speculative wave into equity markets that liquidity is inspired. Think about some of these companies, they almost believe their cost of capital is zero. Like they can raise free capital. They have already, many of them in technology are flush with cash. So making acquisitions now makes a lot of sense because you can't necessarily achieve that gigantic valuation multiple you have with organic growth. You have to do some acquisitions. And of course, the acquiring company loves this too because they get some enormous premium paid for their share price. So everybody wins. The question is, will the investor win?
When we talk about it, go ahead.
Sorry, Adam, I just wanted to chime in on whether maybe the companies that are counseling on M&A are going to win too. I know you're looking at the financials, Sarah, and so investment banks might fall into that category. These financials have not been very loved as of late, right? We've seen a lot of money flow into tech, and perhaps that's why you like the financials, but what is going to be the catalyst that's going to get them to catch up with the rest of the market?
Well, I'm glad you mentioned M&A because they too, and this is interesting, probably the epicenter of pain in financials globally is in Europe. The region isn't particularly liked as a place to invest, and the financials there are considered moribund. I mean, uninvestable, I've heard. Yet they have started a merger process. Even today, two Swiss banks were rumored to be merging. The mergers are welcomed by the local regulators who are encouraging this actually for the first time in memory and providing very favorable accounting treatment, which bolsters capital even further. That it leads to another layer of significant cost cutting, which strengthen these organizations So when there is an economic recovery, they come out of it more profitable. It's not a sexy story, but you can get the same sorts of returns you can in tech in some pretty boring companies.
Talking about something that may not be sexy, with all of this liquidity out there and interest rates so low, real estate, would that be something that people might be looking at if they're long-term investing? Because you can buy right now at bargain basement prices, right?
Yes, and I think the key is to be quite careful. Like, we haven't looked at real estate in years, and maybe we should have as rates were plummeting, but now nobody seems to want to own these companies. And part of this is the concern that we're going to move into a post-pandemic world where everyone will remain working from home, or office will get very little traffic, and thus there'll be massive vacancies and rents will plummet. But we totally disagree, which is why JLL is a very interesting investment, capital light, well managed in a global network. So they've got a moat. And if you want to actually own property, I would go for grade A, absolutely, like a Boston Properties. Our financials research group found those stocks in particular because they're not only undervalued, but they're very high quality.
Sarah, one of the things I noticed in your note was that you like to look to invest in uncrowded areas. And I would just like to get your take with the kind of proliferation of exchange traded funds, the rise of passive investing, even the more recent retail boom that we've seen in the last few months. How do you discern and look for some of these undercrowded names when we have so many, different players in the market and different funds that could be overlapping in some of these names?
It's not difficult to find the unloved because they're laggards. They're just doing a performance attribution year to date. You can see, starting in August, some of the cyclicals, the economically sensitive stocks are beginning to move up. But there is a portion in that group, namely financials, investors still remain very skeptical. Some of these stocks have moved off the bottom, but there's so much room to go. Whether you're looking in the US, a beleaguered bank like Wells Fargo, or overseas, there's probably one in every country nobody cares about, but they're considerably better managed now. They have to be. They're in the throes of the biggest challenge they'll face as a financial institution. And even though some of them have suppressed their dividends, they've suspended them and or buybacks, those are coming back. We'll see those again next year in very well-capitalized institutions. And the final point I'd make on behalf of the Causeway team is institutional clients want to own these stocks because they can't have all their eggs in one basket. And retail investors should remember this, that there's a wave of investors who recognize they can't put it all on red. They can't have it all in tech.
Hey, Sarah, it's Brian Chung. So I wanted to ask on the point of financials, you made your thesis pretty clear here, but what is the time horizon for that type of investment? We saw that post 2008, 2009, the bank stocks did indeed lag the broader market over the, let's say, 10-year period, at least up until this crisis here, where the dynamics have indeed changed again. So is it a long-term play to be holding on to some of these banks, even if dividends and buybacks do come back, as you were just mentioning?
I don't think any cyclicals are long-term plays. I think that's the whole idea. You want to own them when you're at the bottom of the economic cycle, before the market has recognized that we're moving into GDP recovery mode. That's when you accumulate them, when they're on their back. I mean, these bank stocks trade in Europe on average at 40% of their tangible book value. So that's book value less goodwill. That's practically a gift. In the US, it's not much higher. And some of the great insurance companies in the world, particularly in property and casualty, they're going through a price strengthening cycle, but they're not priced for it. I mean, they're 60% of book value in many cases. So this is always the good time. And you can see this in past cycles. We've looked back at the past 4 down cycles and then recoveries in markets. In fact, banks coming out of the GFC, as you know, had a fantastic 4 years post 2009. They went up and up and up. So it doesn't have to be a quick trade, but I wouldn't hold them forever. Just take advantage of the cyclicals when you can, when they're being handed to you on a silver platter.
All right. It's good to see you, Sarah. Sarah Ketterer is the Causeway International Value Fund CEO and Fundamental Portfolio Manager. Please come back. We're going to turn our attention to Washington, D.C., because when we talk about markets, we often hear people say markets are not the economy. So what's going on in this economy, especially without a stimulus deal coming out of D.C.? We invite back into the stream Douglas Holtz-Eakin, American Action Forum president, former director of the CBO. It's good to have you here, Doug. And I'm just curious, this whole discussion about no stimulus coming out of Washington, even with the House returning today, is there any chance both sides would say, danger, danger, we need to do something, or is it not going to happen until after the election?
There's always a chance. It would be a mistake to rule it out entirely, but certainly given what we know at this moment, it's more likely they will go home to campaign without passing something new than they will get to business. So that really comes from the mechanics of the deal. No one is getting hurt politically by failing to reach agreement. You know, they check their polls weekly, if not daily, and voters aren't blaming one side or the other. Given that, there's no reason to change positions, and they are so far apart, you can't get to a deal without some significant changes in positions.
Hey, Doug, it's Julie. It's good to see you. Why aren't they being held responsible? Because from what we see in the economic data, people are still suffering. Sure, fewer people are suffering than they were earlier on in the pandemic, but a lot of people are still out of work.
An enormous number of people are still out of work. More than half of those who lost their jobs remain unemployed. And I think the reason they're not being punished is that people were told that this was a huge recession and that some people were going to be out of work. And so expectations were set that there would be some unemployed for a while. So that then in the larger environment, that's not a penalty. It's also true that compared to the past recession, you know, back in 2008, we've got the unemployment rate lower now than we did early on in that recession. So in terms of recoveries, it doesn't look that bad. And so the sense of urgency seems to have diminished everywhere but at the Federal Reserve. I'll just point out that every time a Fed official opens their mouth, they're calling on the Congress to do something more. And I think that's an important warning about the legs on this recovery. It just makes sense to do something as opposed to do nothing.
So let me ask you this, because you've advised presidential candidates in the past. You were there on Capitol Hill for several years. What do we miss in the press? Because we focus, the news cycle tends to last about 1 week, then we're on to the next splashy headline. What are we missing in all of this about the stimulus discussion?
I think we're missing two things. First, the economy will recover. And, you know, we know that economies will recover from recessions, and this economy will recover from this recession. And so the real way to think about this is, how much do we gain by having it recover faster? Give it more help, get there quicker. How much suffering do we reduce? If it instead gets sort of portrayed as, well, we got to do this or we go back into recession, that overstates the case. People look at it and they think, nah, that's not true. So, you know, you get a jobs report, you get a million more jobs. We're not going into recession. We're fine. So I think there's a sort of getting the terms right that goes on. And I think the second thing that really gets missed is that the average politician doesn't understand this phenomenon. This is unlike any recession we have ever had. It's the depths and the speed that we went down and now came back are unprecedented. The source is unprecedented. And they're really afraid of making a mistake. They're really afraid of doing something wrong and being held accountable a year or two from now. So it tends to make them extremely risk averse and unwilling to move out of their safe ideological positions. So the Democrats are locked in at $1 trillion for state and locals and $600 a week in unemployment benefits. Republicans are locked in at the other end of the spectrum. And that there's a fear of moving from that just comes from not being able to diagnose the correct response.
Doug, it's Brian Chunks, but you mentioned the Federal Reserve has made it clear on their end that they see the need for more fiscal support. We've heard that from a number of Fed presidents. But what does the interaction between the monetary policy side of things and the fiscal policy side of things tell you about whether or not the response has been appropriate from both ends so far? The Fed's launched those bazookas. It's got those liquidity facilities up. The uptake hasn't been so great. They're still saying there needs to be more support out there. So is it really Congress that's dropping the ball here, or has the Fed maybe lifted some of the onus on fiscal policy to do even maybe more?
I don't think the Fed is to be faulted in their response. I mean, they've been fantastic as a monetary authority. They quickly got to the right monetary policy, so they got rates down and went to some QE. As a financial stability authority, they intervened and set up facilities to generate massive amounts of liquidity. All of that's been fine. Where things have not gone well has been when the Treasury designated them as an agent for what is really fiscal policy. That's the Main Street Lending Program. That's the Municipal Liquidity Facility. Those things have not worked out well. I tend to think the Fed understands the problem and thinks it needs to get fixed, and that the Treasury really bears the onus of not getting that money out the door. And so if you go back to the question that Adam was asking, like why can't we get this deal done? There's a $500 billion sitting unused at the Treasury. The airlines are asking for money. There's $25 billion sitting for them at the Treasury. There's an enormous amount of unspent funds, and a lot of elected officials think, well, we did this enormous CARES Act. Why don't they use it? And why are they asking for more if they're not using it? And I think, all roads lead to the Treasury as the intersection of the Fed and Capitol Hill that's not getting the job done.
You just said that the airlines are seeking more money. I can tell you for a fact, Delta told us this morning they will not seek the loan from Treasury, although they are pushing all the airlines for the additional stimulus. But we have to say thank you to Douglas Holtz-Eakin, American Action Forum president, and want to let everybody know, too, that there's more on the TikTok story. Now, we have not been able to confirm this yet with Walmart, but TikTok's cooperation with several companies such as Oracle, should that deal be approved, apparently there are sources citing ByteDance executives that Walmart may actually partner with TikTok in some kind of e-commerce. So we're going to keep on that, but also want to take a look at stocks on the move, not only Delta, but also Viacom. Let's start with Viacom CBS. So those shares were trading higher, and this was on news that Viacom CBS is going to sell CNET to Red Ventures for $500 million. Keep in mind that CBS bought CNET for $1.8 billion in 2008. The current CEO at Viacom CBS had floated the idea of offloading non-core assets once that merger had taken place. The merger was December of last year. So right now, CBS shares 1 month up about 10%, but since the merger, they're down almost 30%. Then, of course, I want to bring back Delta. So this morning, we learned that Delta is lining up $6.5 billion in borrowing in a new credit facility. They're going to underwrite this with their Sky Miles program. The airlines do this. United did this to the tune of $6.8 billion. But Delta shares have been trading higher. 1 month, by the way, they're up more than 10%. We're going to have much more for you on the move right after this. Welcome back to On the Move. We're watching a market rally to start the trading week, and want to let you know right now that shares of Amazon are up about 1.6%. They're up $50 a share. Part of this might be on the news that Amazon is going on a hiring binge in the United States and Canada, 100,000 people. Let's bring in the team on this. And Brian, it's more than just hiring 100,000 new people. It's $15 an hour plus benefits.
Yes, absolutely. And keep in mind, this is not the first wave of hiring that they've done. Earlier in this pandemic, they hired 175,000 warehouse workers. They said that 125,000 of them, a lion's share, would end up being permanent jobs. And yes, or rather last week, they also announced about 33,000 new job openings in their corporate and technology positions. So Amazon hiring on all fronts here. The question, of course, is going to be, is this going to reshape the workforce? When you have a company this large hiring this amount of people, and by the way, for scale, we've heard that about 50,000 people have been laid off in the airline industry. So this is massive for one company to be doing all of this hiring. And you wonder, where are these people going to come from? If they're coming from Main Street jobs, if they were formerly baristas at coffee shops or working at small shops on Main Street that have gone bust, if they go to Amazon and these end up being permanent jobs, this really underscores the drastic changing in the landscape of American workforce, from these small mom and pop shops to large corporate conglomerates like Amazon. Whether or not that's going to change the ultimate composition of our economy is one thing, but I think we need to understand that there could be some pretty large ramifications from this.
Yeah, I mean, it certainly makes you wonder, at what point, Brian, does Amazon become the United States' largest private employer? As of right now, that title is held by Walmart. Just to add on to a few more things related to Amazon, keep in mind they have that career fair happening on Wednesday. And that's basically for the 33,000 positions that Brian was referencing, those higher paying tech and corporate roles that average about 150,000 in salary. And I was told that within less than 12 hours, they already booked up all of the career one-on-one career sessions. They're doing 20,000 of these sessions. So it's interesting to see the demand. Obviously, we know that the job market is just in a pretty dire situation, but just to see the demand, and then ultimately to Brian's point, what does the future of the workforce start to look like, especially when you often hear about some of the tech roles in particular, how it's difficult to find some of that talent?
It's not just the future of work, Julia. It's also the future of delivery. For instance, you've got UPS teaming up with CVS to deliver product. You've also got Amazon with a drone delivery program like UPS is. And now Walmart. Tell us more about their teaming up with Zipline.
Yeah, so just last week, Walmart announced that they were piloting a drone delivery program for select items in Fayetteville, North Carolina. And that program was with Flytrex, an end-to-end drone delivery company. This week, they are now trialing with Zipline. Let me give you a little bit of context about Zipline. It was founded, I believe, and officially founded in 2014. And this is a company that is known for making medical supplies drops, specifically blood, in Rwanda. Back in 2016, they were delivering, and I believe still continue to deliver, critical medical supplies in hard-to-reach areas. We're talking about very mountainous terrain, very poor roads, very few roads that are paved, and again, windy roads. So using this drone delivery technology, they've delivered more than 200,000 products to thousands of medical clinics across multiple countries. So it's interesting. Walmart is going to be trialing with Zipline in Northwest Arkansas, which of course is Walmart's home base. And Walmart's Senior Vice President of Customer Product, Tom Ward, put out a blog post. He said, look, this is pretty cool technology that Zipline operates, and that they can operate from a store in a 50-mile radius. And to give you some context, he said that is about the size of Connecticut. And again, referencing the work that this company has done around medical supplies deliveries in Rwanda, he basically made a case that this is something that could have the potential for national scale. Maybe it's a little too early at this point, but this is something that will be really interesting to watch. For now, they're going to start with health and wellness products with the plans to extend into more general merchandise. So pretty exciting area, whether it's Walmart, Amazon, the future of on-demand delivery, guys.
It's very cool, that is for sure. But as we take a break, I want to let you know markets are trading higher right now. When we come back, September may be the 9th month, but 12 billion is the number you should pay attention to when we talk about September. $12 billion in IPO issuance volume. It's the highest since September of 2014. That's the expected capital to be raised this month. And our guest coming up is going to tell you why the IPO market may be getting stronger. Welcome back to On the Move. When we talk about IPOs, everyone gets excited about the big names like Airbnb, but there's a lot of activity going on, and there's a way that small investors like most of us can get in on this through, for instance, the IPO ETF. Well, joining us right now to talk about the state of the IPO market and that ETF in particular is Kathleen Smith, Renaissance Capital Principal, joining us right now because we should point out that that ETF is up over 50% year to date, but there's much more going on because the IPO market, as you pointed out in September, is going to be pretty strong. Is that accurate, and where is it headed?
Right. It looks like we're going to see about 12 billion raised, and that'll make the September IPO market as good as any September since 2014 when Alibaba went public. So there's a chance by the end of this year that we will have, records we haven't seen since 2014 in terms of dollars raised and number of deals. So it's a very active period. We are seeing the kinds of companies that play into the digital economy, which is kind of standard for many IPOs. Half of the volume for September is going to be made up of a number of very interesting high growth software companies. And then we have health related companies as well. So there'll be a lot for investors to choose from.
Kathleen, it's Julie here. It's good to see you. I want to ask you about SPACs and that option that a lot of companies have been taking to come public these days. Is that a threat at all to the traditional IPO? I know we've asked this similar question with direct listings over the past couple of years, but do you think SPACs are going to kind of eat into the market share of IPOs, so to speak?
Well, it may be, but just to put some numbers around it, so far this year, there have been 36 billion raised in 115 or so IPOs. That's before we get to the September rush. And with SPACs, there have been 80-some SPACs raising 30 billion. So SPACs in and of themselves have been quite a big number, but it hasn't really held back IPOs. What we think is happening is that the SPACs are enabling companies that could not go public for a variety of reasons. I think probably the major one would be, how do you value Nikola, which doesn't have a business yet? And they're able then to be purchased by this blind pool and have an IPO that doesn't go through the full scrutiny of a regular IPO, where investors can be pretty baffled about valuations for money-losing companies. And I think WeWork is one of the best examples. There is a lot of locked-in private capital that needs to get liquidity. So SPACs are just a sign of a way to try to get these companies out. I will note we have studied this segment, and it doesn't look good for, if you look at all the SPACs that have had their mergers, the returns on those are negative compared to the returns on over the same time in the aftermarket for IPOs. So they can be pretty tricky. You have to be very quick with determining whether you want to stay in when a merger happens, because many of them, on average, the returns are negative.
Hey, Kathleen, it's Ryan Chung. So on that point, should people be concerned then about the amount of SPAC activity, especially given the scale of it? Not only in number are there more SPAC transactions being done, but the volume of these types of deals are being huge. Airbnb is one that not necessarily that is going to be a SPAC, but these are large, high-profile companies trying to go public here. Is there a concern that this could blow up in some investors' faces?
Well, we told you the data already on the ones that have made acquisitions. The thing is, they don't make their acquisitions until about a year and a half, typically, after they raise the money for the SPAC. So you don't know right away. I think that time will tell, and it really is all about the returns. And your returns get very diluted when you're in a SPAC because of the percent of what the sponsor owns and the cost. It's a very costly process. It's not only the original IPO, but there's a proxy and a lot of heavy overhead costs. So there's a lot of money being made by Wall Street and accountants and lawyers and everyone else that have to have a hand in on doing these rather complex transactions. I think on the direct listings, I would add, they have the same issue. Companies want to try, we're trying to figure out, I don't like the first day pop either, but we need a process where the pricing's good for investors. Not just the companies themselves. Investors have to make money, which is, you are saying they have when you look at our ETF. Those are aftermarket returns. on those who have bought IPOs in the aftermarket. But for the direct listing, the ones that have been done, those returns, at least a year after they've been priced, have been negative in the aftermarket. So that hasn't worked out too well either. So we'll have to see whether these attempted alternatives, I'm thinking that with the SPAC and the volume there, that it has helped offload maybe some really speculative companies that might have wanted to tap the IPO market. So this maybe keeps the regular way IPO market with a little more quality associated with it when we are seeing a lot of run up in valuations, a little bit reminiscent of 99, 2000.
Well, what Brian brought up, Airbnb, I'm just curious if there are red flags because of the COVID-19 pandemic and what's happened to them in their potential to go public in the next couple of days or weeks. What would you tell people who are watching this as far as caution or proceed with care?
Well, I wish it was an easy answer. I think the main thing is it's all about valuation. So, Airbnb is an interesting business at the right price. And that's true of just about everything. So investors have to try to put aside maybe the excitement and take a look, because these stocks have to find a place in the overall marketplace. So if they get too bid up initially, they don't do well for investors. So that's the point. It's about the valuation. I certainly think Airbnb can successfully do an IPO. They just won't do it at the valuations that were given to the company when it was private.
I think at one point they were looking at a $30 billion valuation. Now it's around $18 billion. We have to say thank you, Kathleen Smith, Renaissance Capital Principal. Thank you for being here. When we come back, are you ready for this? There might be life on Venus, the latest news breaking event coming up. News on the move. Police in Lancaster, Pennsylvania fired tear gas on a crowd of people protesting this morning after an officer shot and killed a man yesterday. Now, the police were responding to a report of domestic violence. They released body cam footage as they arrived at the house, which shows 27-year-old Ricardo Munoz chasing the officer with a knife over his head. The officer fired several shots, striking Munoz. Nobody else was injured.
Two storms are threatening the southeastern U.S. coast less than 3 weeks after Hurricane Laura caused widespread damage. Tropical storm Sally is forecast to hit Louisiana tomorrow morning as a Category 1 hurricane. Hurricane Paulette hit Bermuda this morning with maximum sustained winds of 90 miles per hour. Rough seas from that storm are expected to affect the entire East Coast, triggering life-threatening surf conditions.
Yoshihide Suga overwhelmingly won an election today to lead Japan's conservative Liberal Democratic Party, which clears his path to become the country's next prime minister. The Japanese parliament still has to hold a vote in the next coming days. Current Prime Minister Shinzo Abe confirmed he would be stepping down because of health problems.
And possible signs of life have been detected on Venus, or more precisely, above Venus in its atmosphere. Researchers have spotted an explosive gas that's called phosphine in the atmosphere of the planet. It's a gas that's almost exclusively associated with life on Earth, raising the possibility, at least, that it could be a sign of microbes floating in Venus's clouds. Researchers, though, say there is more work to be done on this question.
Protecting life on Earth is the goal of several companies trying to develop vaccines to prevent the COVID-19 disease, the coronavirus. Let's bring Anjali Kamlani, because we've had some news over the weekend that everyone should be paying attention to from both AstraZeneca and Pfizer. What can you tell us?
That's right, Adam. So from AstraZeneca, as we know, last week, there was a pause on that late stage trial, that critical one that will bring us information on whether or not this vaccine is safe and effective. That was put on hold based on a participant in the UK having some unrelated illnesses as a result. They have resumed that trial, but unfortunately it triggered sort of a global pause until they had figured out what was going on. And so that we're waiting. I know the CEO has said that they're in touch with all of the other sites and are looking to restart trials elsewhere as well. This does not affect the timeline too much, still expecting a vaccine by the end of this year. Meanwhile, Pfizer, as we have come to know, is one of the more aggressive ones, predicting that they will have efficacy results by the end of October, but recently said that they will not have it in time for an independent group that is going to be discussing vaccines with the FDA and others on October 22nd. So it's, in that last week, it looks like they're pushing for.
Okay, Anjali Kamlani, thank you. We're going to go to commercial break, but first, want you to pay attention before that break to the interview that Brian Sawsey conducted with Peloton CEO and co-founder John Foley. This is part of a Yahoo Finance Presents.
One of the biggest goals, Brian, is to address the affordability opportunity for Peloton. We think that everyone who wants fitness in their life should be able to get Peloton platforms into their home. Interestingly, there's close to 200 million people worldwide that have gym memberships. We think those same people don't want a gym membership. We think those people want to be fit. You're paying money to be fit is really the psychology. And so when you think about our lower price or lowering the price of our original Peloton bike, which we were happy to do this week, and then bringing a treadmill to marketplace that's dramatically more affordable, we're super excited about that, to your point, product positioning and pricing so that we can get more products in more homes and welcome more members into our community.
Is all of this to say that, you know what, you just don't want to necessarily be dropping lots of hardware on the market? It was also noted on the call that you'll have a prune product portfolio. So, I mean, I shouldn't expect Peloton to have a rowing machine.
Well, we've talked about it in the past. We are innovating on all kinds of new platforms that you're going to see in the coming years.
And of course, Peloton had a blockbuster earnings report. Shares today are down about 2.5%. We have more news on the move for you. We're going to address the issue with Nikola. They have responded to the claims that part of their business is a fraud. That's coming up right after this. Welcome back to Yahoo Finance on the Move. Want to draw your attention to the stock price of Nikola Corporation. Remember last week there was the news that they had done a $2 billion deal with General Motors. They haven't even built a truck yet, but then you got the blockbuster report from Hindenburg Research, a short seller, which essentially said that the company, Nikola's discussions of creating a hybrid fuel, electric fuel motorized vehicle was somewhat of a fraud. This is what Nikola said today, quote, Nikola has contacted and briefed the U.S. Securities and Exchange Commission regarding Nikola's concerns pertaining to the Hindenburg report. Nikola intends to fully cooperate with the SEC regarding its inquiry into these matters. Again, the stock today is up almost 7%. Let's bring into the discussion someone who watches the total automotive sector, Jeff Schuster, who's LMC Automotive America's Operation and Global Vehicle Forecasting President. I realize that you can't do a deep dive on Nikola, but does this have any ramifications for the larger auto industry as a whole as it tries to create a larger portion of electric vehicles and electric hybrid vehicles or fuel cell vehicles?
You know, I think certainly you've got a lot of attention in this space right now, not only in the market itself, the stock market, but in the auto sector. A lot of people are trying to be the next Tesla, and I think this certainly is the tie-up with General Motors, and obviously then the allegations that came out shortly after that certainly had a bad mark on on that deal. But overall, I think the industry is moving in this direction. The question is how fast and how will consumers respond? That's really what's unknown at this stage.
Jeff, I do want to ask you a little bit more specifically about Nikola, although I know you can't necessarily go into a lot of detail, but just in general terms, how do you figure out if something is legit, right? I mean, these allegations coming from Hindenburg actually remind me somewhat of Theranos, because some of them involve allegations that Nikola has used products from other companies to sort of make it look like they're further along. So as somebody who analyzes this stuff, is it just a matter of getting in the vehicle, driving it, opening it up, looking through it? I mean, how do you figure that out?
Yeah, it's considerably a challenge, I think, and I'd even take a step back when you look at just the number of companies right now that are in the startup space and wanting to develop EVs, and we really go through an assessment of where's the funding? Do they have funding? Do they have legitimate engineering operations? Where are they in the development? Does the prototype move on its own propulsion? Is it is it a shell? Is it real? So I think you've got to look at it in those terms. But then following on that is, can they even build it? Do they have a plant? What are their plans for service, for manufacturing, for developing the brand and selling it? So there's a lot that's involved with moving from wanting to build a vehicle to actually following through with it.
And Jeff, it's Brian Chung here. Something that also complicates all of that is Nikola's relationship with the traditional OEMs and their partnership with GM, for example. I mean, it's no secret that a lot of these, storied automakers would want to partner with companies that have this type of new, exciting technology. But does the story that we're watching right now complicate the traditional OEMs' efforts to create these partnerships? And would you expect maybe the automakers to be a little more hesitant in future partnerships and just try to defer to maybe in-house type of engineering ventures?
Yeah, it definitely complicates it. I think when you look at this news coming out, again, just on the heels of the announcement of the deal or the tie-up with General Motors, that's obviously not what you want to happen if you're General Motors. And I think looking at that, obviously they've got to do due diligence. I'm sure they did. I wasn't on the inside of that deal, but I'm sure they looked at Nikola very closely, had to come to their own assessment on where is Nikola and what can they get out of this. And I think that's why we saw the deal. It may prevent any near-term announcements, but I think the end game, everybody's kind of going in the same direction down this path. And it, again, whether you're a traditional automaker moving into this space or moving out of internal combustion engines, or you're a startup, it's a massive cost outlay. So I think these tie-ups are a way to defray that and share technology.
Jeff, I am curious about the auto industry as a whole, and that's what your company does so well as you look at the trends that are coming. You might even see the Studebaker poster over here, even though they're out of business. Car manufacturers are setting up for really some good times, aren't they? Because, I mean, essentially, you even have an article on your website that our car is going to be the new PPE. Is that where we're headed? People are going to want cars again?
You know, I think so. I wouldn't say people stopped wanting cars, but there was a pause. I think a lot of question. It's more around ownership, and as you look at different models, and I think one thing obviously coming out of the pandemic is people wanting the flexibility and wanting to have their own transportation. So there's definitely a move back toward that. Now, whether that's has a long-lasting impact that we don't know at this stage, but I think there's definitely a shift back towards wanting your own vehicle in your own space as a result of this. And I think the flexibility around that, when you move to a shared model, and that's one of the things that we've been looking at as you move to an autonomous shared model, which everyone says eventually is our future, that has to work seamlessly and instantaneously. People don't want to wait for something. So I use an example, waiting even just for an Uber in New York City while there's 7 to 10 taxis that go by you, that seems kind of silly. So I think when you've got multiple vehicles in a household, you've got that flexibility. If you've got people moving and going in different directions at the same time, it's going to be a challenge in a shared environment. So I think that, along with now this need for personal safety and wanting your own things, certainly could have some long-lasting implications.
Jeff Schuster is LMC's Automotive America's Operations and Global Vehicle Forecasting President. Thank you for joining us on The Move. All the best to you and your team.
Thank you.
When we come back, we're going to check markets again with Jared Blickery. And we're watching a rally on Wall Street. So is Jared Blickery. Tell us the latest as to what's driving these markets higher, especially after what we experienced last week.
We have tech leading, and we've seen this handoff happen just about every other day. So we'll see what happens into the close. But tech is leading along with real estate, and then communication services not far behind. And we can see in the NASDAQ 100, the big FANG names largely in the positive by a large amount. Apple, Microsoft, Facebook, Alphabet, all up over 2%. Chip stocks doing well. NVIDIA's up over 6% after announcing its deal to buy ARM. And then Tesla up 8.5% today. Well, let's take a look at the VIX because that is trending lower. And in fact, this is the lowest we've seen since that sell-off that began about a week or actually into 2 weeks ago. Also taking a look at the 10-year T-note yield, that is down just 1 basis point. Now it's time for our Yahoo Finance premium investment idea of the day, and that is Lululemon. And this is a fundamental report by Argus Research, and they're saying they have a target now of 380. Specifically, they're saying our financial strength rating on Lululemon remains medium high, the second highest rating on our 5-point scale. Company added the second quarter with $523 million in cash and equivalents, down from $624 million in the prior period a year ago, to reflect the negative impact of the coronavirus over the next 2 quarters, lowering their EPS targets. And finally, they're saying with substantial opportunities to expand outside North America, particularly in China, a strong brand and growing e-commerce sales, we think Lululemon's prospects are among the best in the apparel sector. Adam?
All right, when we come back, more on the TikTok Oracle deal.
It is noon here in New York. We're about 2.5 hours into the trading day, and the rally has resumed on Wall Street. We've got the Dow up about 1.25%, the S&P up better than 1.5%, the Nasdaq up 2.25%. Oracle may have won the dance battle, but what exactly is its prize? The tech enterprise giant beats out Microsoft for TikTok, but it doesn't look like an actual acquisition. A growing threat to the American economy as wildfires rage out west, a new report highlights the massive risk that climate change poses to the U.S. financial system. And stability off the mat. Olympic gold medalist Aly Raisman joins us to discuss the state of U.S. gymnastics and her new project emphasizing mental health. Welcome to On the Move. I'm Julie Hyman, along with Adam Shapiro. Joining us this hour on the panel will be Yahoo Finance's Jared Blickery and Dan Howley. And we are going to start with what is happening with TikTok. It looks like that Oracle is indeed the winner. Microsoft coming out with a statement saying that ByteDance rejected its bid for the company, but it's still unclear what exactly Oracle's partnership with TikTok is going to look like. It doesn't look like an acquisition. Meanwhile, there is a Chinese news service, Cakesin, that is reporting that Walmart will still be working with TikTok in some capacity in China. Dan Howley, what do we make of all of this back and forth, Oracle being the winner of a sort?
Yeah, it's very strange because the only thing that we know, and this is exactly how it's phrased, is that Oracle is going to be a trusted technology provider for TikTok in the U.S. And we don't really understand what that means other than they'll probably use Oracle's cloud service. Now, I think this doesn't really make too much sense because Oracle is kind of the back end company that consumers probably don't even know about, really. And I think what this does is allows them to essentially prove that their cloud services are as capable as the likes of Microsoft and Amazon for large scale clients. And I think that's kind of where they were trying to go with this. It's also, by the way, a nice shot in the arm to Oracle after losing out on the bid for the Pentagon's large JEDI contract. That's a $10 billion, 10-year contract to bring a cohesive kind of cloud system using AI to the DoD. Oracle lost out on that because they simply didn't have the capabilities to satisfy the DoD's requirements, but Amazon and Microsoft did, and Microsoft ended up winning that bid, much to the consternation of Amazon. So I think this is really kind of a way for Amazon to both prove that it is able to handle large-scale clients in the cloud, but also a way for them to kind of dig at Microsoft after winning that contract.
Dan, I had a question about Oracle, and everyone's pontificating. The different analysts have different takes, but one is saying that, look, the Oracle Data Cloud is the world's largest advertising data, marketing data consumer marketplace out there. So could this be a play with TikTok to jump in to the territory of Facebook or Google using TikTok as the user engagement to become the third largest advertiser or platform for advertising via Oracle?
It could be. It really is just a strange kind of tie-up here, and that would be a way for them to really kind of maximize the revenue possibility for something like TikTok. It just seems to me that, you wouldn't necessarily have thought of this about a month ago, Oracle teaming up with a social media app built mainly for teens. But that's where we are now. And I think, if they're going to try to win a name this large and coveted, obviously, they're going to get as much as they can out of it. But again, this is still them considered a preferred technology provider, not a partner, not an acquirer, just a technology provider. So we don't really know what that stands for Oracle yet.
Dan, I also want to ask, first we have Reels, now we have something called Shorts. YouTube is introducing a new competitor to TikTok. Have any of these started to, Reels has been around, what, has it even been a month now? Has it started to gain any traction?
Yeah, I think Reels is, definitely gaining traction, but not as much as, it's not a TikTok yet, right? And it's not an Instagram Stories yet, where Instagram Stories initially came out as basically Mark Zuckerberg's way of crushing Snapchat. This is Instagram's way, or Mark Zuckerberg's way, rather, of using Instagram to crush TikTok. And, if you look at the Reels that are available on Instagram right now, a lot of them have the TikTok watermark because creators are just uploading their stuff to TikTok and then importing it away to Reels. So it's not having that effect of drawing people fully away. That means that people are still using TikTok. They're also just using Reels to get larger exposure to a larger fan base, which makes sense if you're a content creator. As far as Shorts goes, that's going to be something that launches in India as a test program and then expand to other countries. And it really is, kind of Google's way of hedging against the fact that short form video is doing incredibly well right now. YouTube isn't necessarily known for short form video, but it is the dominant player in the video industry. So they want to make sure that they have their hands in all of these kinds of buckets to make sure that they are still the leader in video. And I think that's basically where they're going with this.
So let's switch to one of the other big deals that we're watching today. And this one is an actual acquisition, right? We know the details of this one. NVIDIA is buying ARM Holdings from SoftBank for $40 billion. It's NVIDIA's largest deal. NVIDIA, by the way, already surpassed Intel in terms of market cap this year because the stock has really been skyrocketing. Jared, NVIDIA known primarily as a graphics chip maker, but it's adding more smartphone chips with this acquisition. And it's an interesting deal for the company.
Yeah, it is on a number of fronts. It would be the largest deal in the chip space to ever get done. And there is some, it's not a done deal that it does pass regulatory scrutiny because that has to be done not only in the US, but in China. And given the present tensions, especially just talking about the US ByteDance and TikTok deal, it remains to be seen whether we will actually see this. But yeah, so NVIDIA is the biggest player in the data center space. It also gives them some synergies with their GPU business. And overall, I mean, the analyst commentary has been somewhat positive, but not all around. Basically, the biggest downside here is probably the antitrust regulatory concerns. And Raymond James is saying there are two justifications for the deal: an assault on Intel and AMD's server business, and adding NVIDIA's intellectual property to their arms licensing business. So synergies around, we'll have to see if it gets done.
Yeah, Jared, this is a deal that could really crush Intel in the long run, because what they're trying to do at NVIDIA is move companies away from using CPUs, or at least Intel and AMD CPUs, and then use NVIDIA GPUs in their data centers, especially when it comes to AI. Now, they don't make CPUs, but they could with ARM's technology. And that's kind of where it goes, because ARM is a CPU maker, not a graphics processing maker. And the reason why graphics processing is so coveted for AI is because it can simply do more than a CPU can. And that's something that NVIDIA jumped on after researchers kind of found that out. So I think in the long run, what you'll see here is obviously more NVIDIA products getting used for licensing, which would be a huge business for them. But we could also see an increase of NVIDIA in the data center space. And that in the long run would be so detrimental to Intel.
All right, thanks, guys. I want to move on to the various sort of natural disasters, or perhaps not so natural disasters in some cases, that we are watching around the United States. President Trump is actually in California today. He's expected to be briefed on the fires that have been raging there. And already we have seen a record amount of acreage burned this year in California as a result of these fires. This, as we're seeing yet another tropical storm bear down on the coast of Louisiana, and another one over Bermuda right now. I want to bring in Bob Litterman. He is the chairman of a panel that just produced a report that came out last week called Managing Climate Risk in the U.S. Financial System. He is also chairman of the Risk Committee at Kipos Capital. He's joining us from California, coincidentally enough. And Bob, this report that you all produced was commissioned by the CFTC. And you basically come to the conclusion that climate risk is indeed going to potentially infect the U.S. financial system. We don't tend to see that much of certainly an equity market effect when we get the fires, or we have gotten various hurricanes in the past. What was your finding in terms of how that could change?
Well, first of all, I think that there have been significant impacts on valuations of companies. The energy sector for many years now has been underperforming. And you've seen companies like PG&E that went bankrupt a couple of years ago after forest fire. So there are definitely impacts. And when we brought together financial market participants ranging from banks, insurance companies, oil companies, ag companies, as well as academics and NGOs in the environmental space, we all agreed. There was no disagreement on the reality of climate change, the risks that it poses to society, and the actions that we need to take. So we were able to create what I would call a roadmap for, not just financial regulators, but all the participants in the financial markets. And significantly, the first recommendation, and I would say the most important, is that we need to create appropriate incentives to reduce emissions. We don't have that now. That's a fundamental flaw in the financial system. And what the participants in the financial system recognize is that we can't create those incentives on our own. So we can't solve this problem without collective action. And you mentioned what's going on in California. It is just, we've had 3 weeks now of hazardous air. This is this is real. This is affecting people's lives, and it's something that has to be addressed urgently. There's no disagreement among financial market participants about that.
Bob, as I understand it, you're about 17 miles south of San Francisco. You're along the peninsula. I'm here in Los Angeles. I get notifications every day not to go outside. Of course, coupled with the coronavirus pandemic, where we're kind of have been forced to be indoors during this time. When you think about the lack of disagreement, you're saying, especially among the people that you, of course, spoke with for this report, but also, of course, Democratic governors, there is a leadership vacuum, though, right? When it comes to the top, when it comes to Donald Trump, who is going to be in our state today, how do you reconcile that, right? Because I understand that a lot of these organizations can act sort of independently, but at the same time, if the vision is not there, if we're pulling out of the Paris Climate Accord, if we're pulling out of a lot of these things, and the incentives are not from a national perspective, how do market participants actually see this as a priority here?
Well, it is absolutely a priority. And, we've been seeing the COVID crisis and the other impacts that have very similar lessons for us about risk management. And one of those lessons is the importance of acting quickly. One of the things about risk management is that time is a scarce resource. If we have enough time, we can solve any problem. You saw with COVID the impact that just a short delay made. There was a Columbia University study that estimated that the number of deaths was double in March and April and May because of a few week delay in addressing that crisis. Similarly, with respect to climate, we have not addressed it yet. We absolutely need to address it, and addressing it means creating the incentives to reduce emissions in this country and globally. We need a globally harmonized response. And so I would say right now, what you're seeing in Europe is a much more proactive approach from the government. You've also seen that in Asia. Another lesson from COVID is how we're so dependent on each other. Our own action, it's a collective action problem. That was true with COVID. It's also true with climate change. And it's a global problem. We can't solve this on our own, and we can't build barriers that will protect us. And so we absolutely, and all of those mean that it's a political problem, as you suggest, and we need a political solution. Now, how that happens, we need to move forward, but we haven't done it yet, and we absolutely need to do it, and we need to do it quickly. One of the things that I will highlight is that you can think of the maximum temperature that we're going to reach, 5 decades down the road or more, as being a good metric of risk. And each year that we delay, that maximum temperature goes up. In fact, in 3 years, you can push that maximum temperature up about 1/10 of a degree, which centigrade. And that is a big impact. And it means there's more risk and so on. And we can't turn back the clock. We should have addressed this 20 years ago, but we've got to address it now before it gets too late.
Yeah, Bob, one quick question here. When you think about the implications, one of them is home values, right? And the prices here in California that have been extraordinarily high, even amid this economic crisis. When you think about, even the interview with former Governor Jerry Brown, he said, tell me, where are you going to go then? Where will these people who are seeking and flocking to California for innovation and for these opportunities going to go? How do you see this actually having a long-term consequence, especially perhaps as COVID has accelerated this work from home phenomenon and this ability to be remote?
Well, boy, I'll tell you, that's a big question, and no one knows what's going to be the impact. I will tell you that this year we've now had 3 weeks in a row of hazardous air, as you know. In fact, that has now spread not just from the Bay Area and a few areas around fires, the entire West Coast. Many of us are becoming very familiar with an app called Purple Air, which we look at on a regular basis to see what's the particulate and, is it safe to go outside? One thing I'll tell you for sure, home values are not helped by having hazardous air multiple weeks, maybe even months this year. We're just at the beginning of the fire season here in California. 2 years ago, when we had the Paradise Fire and 2 weeks of bad air, that was in November. And here we are at the beginning of September, and we've already had 3 weeks of bad air. So I don't know where this is going in terms of, all of the different changes. People say that the COVID, virtual working from home has accelerated a lot of trends. One of those trends is lack of travel. And I must say, for some of us who are spending a lot of time on airplanes, being able to do things like this virtually is very helpful. But, is the long term where it's going? We don't know.
Well, hopefully you can come back and join us virtually once again and talk about all these very important issues. Bob Litterman is Kipos Capital Risk Committee Chairman and also the head of a panel that came up with a report looking at the risk of climate change on financial markets. Thanks again, Bob. Appreciate it.
Thank you. My pleasure.
Let's talk about what's going on in markets today, not just here in the US, but also around the globe. I want to bring in Rupal Bhansali, Ariel Investments, CIO of International and Global Equity. She is joining us from Chicago. Rupal, thank you for joining us. We learned today that Japan would be getting a new prime minister. We knew that they were getting a new prime minister. We learned that the new prime minister would be Yoshihide Suga. And I'm just curious, as you look around the globe and compare the attractiveness of various markets to the United States, how Japan looks to you, particularly amidst this leadership transition?
Well, Japan, like most markets, are actually very expensive, in particular because the market's valuations are pushed up by flows, not by fundamentals. The GPIF, which is the government arm that buys equities and has been buying ETFs in the market, in my opinion, rather indiscriminately, is supporting the market artificially, so valuations are quite excessive. Now, like in any market, there's always a handful of opportunities. You don't need hundreds of stocks, to make good returns, and those exist in Japan just as they do in other markets. But by and large, since your question is on the markets, I think they're very rich and not for my blood for sure.
Good to see you again. It's Adam here, and I'm curious. Everyone talks about the world being awash with debt, and you actually say, like a dam that will burst because of the sheer pressure building up. I'm the generation that absolutely believes what you've just said is true. The sky is falling, and yet it hasn't. I mean, we can go back decades where we've talked about debt's going to destroy us, and it hasn't. So why is this going to be different?
So I think the difference is that things tend to be cumulative, and we reach debt levels to GDP, debt levels to EBITDA. All the metrics that we should look at are in territory that can represent the tipping point. So a dam can hold off a lot of pressure building up. I mean, that's what a dam is supposed to do. But if you overflow it beyond a point, beyond what its capacity is, it's definitely going to burst. And my, approach to investing is you're better off evacuating before rather than trying to escape after. So the Fed has just given us an enormous backstop on all sorts of, distressed paper and indebted paper. Take advantage of it, get out of, highly indebted companies or indebted stocks and go into net cash companies.
But as you've said, the Fed is there as the backstop. I never want to see the day when we find out that the Fed can't keep printing and buying. But that's a long way off, isn't it?
So investing is a marathon, not a sprint. So you're right. You sometimes have to lose the battle to win the war. This is the argument people made in 2000, when Greenspan printed a lot of money and took the NASDAQ up to levels that were completely unwarranted. And then, of course, that dam burst to the detriment of a lot of investors who piled in exactly for the wrong reasons, the fear of missing out. So I think we've seen these playbooks before. I've covered markets for 30 years around the world. If money could end all problems, we wouldn't have problems.
Jared Blickery here. Just kind of continuing the conversation about debt, I want to talk about the US dollar and its impact on your valuation thesis for global stocks here, because we've seen it depressed, but really just kind of trading sideways against a basket of currencies over the last 6 weeks. Still a crowded trade to the short side. What are your views on the dollar here?
I think, currencies are a fool's errand to call in the short run. But in the long run, they have to purport to arithmetic of current account deficits. And the US perpetually runs a current account deficit, which means it needs to attract capital into the country. In the past, it did so because it was still inflation and interest rate differentials. And now those have converged to extremely low levels, which creates pressure on the currency to adjust. So I think from a secular basis, I would see the DXY continuing its downward trend. I think the peak has already been reached and is behind us. And I would say that also should actually help international markets perform better than US markets, because that tends to be a big source of dollarized returns. History has shown that, and I see no difference in the future compared to the past.
Rupal, good to see you. Thank you so much. Rupal Bhansali is Ariel Investment CIO of International and Global Equities. Appreciate it.
Thank you.
As we take you to break, just want to check on a couple of other stocks that are moving right now. One of them is Verizon. We talked about all the deals that are going on. Here's another one for you. Verizon is going to be buying a company called TracFone, which is a unit of América Móvil, for about $7 billion in cash and stock. TracFone is a provider of wireless prepaid services that has about 21 million prepaid customers in the U.S. It also owns Straight Talk and Net10 or some other brands. Verizon so far has not gotten as far into this business. It is aimed for more premium customers. So this is a bit of a change in strategy. Those shares, by the way, are up about 1.5%. And we are looking at Vaxart as well. The company shares have been going higher by quite a bit today. It said it received the go-ahead from the Food and Drug Administration for a phase 1 clinical trial of its experimental oral COVID-19 vaccine. This is one of these stocks that has been quite volatile on the various vaccine developments. Coming up next, we will be speaking with Olympic medalist Aly Raisman. Stay tuned. Well, as we know, the coronavirus epidemic has been tough on people, and not just a matter of people being sick, but also people being afraid of being sick or losing their jobs, or all of the many mental health challenges that people are having right now. The CDC said as the results of a survey that more than 1/3 of American adults are experiencing symptoms of an anxiety disorder right now. There's a company that is trying to address this, or a number of them right now. One of them, though, is teaming up with Aly Raisman, the Olympic medalist. It's called Sanvelo. It's a division of United Health. And Aly Raisman is joining us now from Boston. Thank you so much for being here. We really appreciate it. And I'm curious how this came to be and what you hope to accomplish. We have seen other athletes really becoming more outspoken on the issue of mental health. And it's very interesting because you think of athletes as people who are very concerned with physical health, but now it's becoming sort of more holistic.
Mm-hmm. Yeah, thank you so much for having me on. I decided to partner with Sanvelo because for the last couple of years, I've been really interested in feeling better. I've really struggled with, depression, anxiety, PTSD. I've, been very public about some of the trauma that I've experienced. And, I'm not really sure if a lot of people realize this, but, when you do suffer some sort of trauma, unfortunately, it can carry on with you for a really long time. And, I just am really interested in finding ways to get better. And as you said, when I was training, I was really focused on the physical aspect of it. If I had a sore ankle, I would do everything I can to make sure that I would feel better. But I didn't really have the tools or focus on the mental aspect of that. And so it's really important to me to work on my own mental health, but also to encourage other people to as well. And my hope is just to normalize the conversation because, I don't want people to feel alone. And I know this is a very lonely time for so many people.
Allie, it's Anjali here. I cover healthcare, and I'm looking at my inbox with a plethora of pitches for mental health apps. It seems like they're almost a dime a dozen right now. Why Sanvello? What's the partnership with them going to look like, and what specifically are you working on developing with them?
Mm-hmm. So what I really like about Sanvello that I really feel like separates them from other mental health apps is that they have so many things that you can do. They have these daily check-ins where there's a bunch of questions and it will actually give you a score. So you can see your anxiety or depression for that day. You can see if there's an improvement. So the more that you do the app, you're actually able to see the actual improvement, which, gives you some sort of good feeling that that it's really working. There's also guided meditations, there's coaching, there's therapy, there's, gratitude. They give you all different types of tools. And I think this is really crucial because healing isn't one size fits all. What works for me might not work for somebody else. And so it's sort of like a trial and error. But the thing about Sanvello is they have so many options. And I actually recorded my own guided meditation. I've been doing guided meditations for a couple of years. So I recorded that. It's on the app right now that people can access for free. And Sanvello and I will be working on different tools and different stuff that have helped me along the way that I'll hopefully be posting more meditations as well.
Ali, this is Dan. I just kind of wanted to ask how this kind of works with people who are in clinical setting with therapists. Would this be something that you would use in tandem with that? Would it be something that you would use on its own? How do you kind of integrate the two?
I think it totally just depends on who you are and what works best for you. I personally like to use both. I personally like to use therapy on the app, but then I also have therapists. Right now, the therapy that I've been doing is over the phone or over Zoom because I'm not able to go, obviously, in person because of COVID. But I think I encourage people to, do what works for them. And I think that that's really what's really important about it. And, for me personally, it's like some days I feel like I need to talk to a therapist. Other days I feel like I need to do a meditation. Other days it's stretching. Other days it's writing in a journal. So, but I do think it's really important to have someone to talk to. But I think that, the more people that you have in your life to support you, whether that's a friend, whether that's a therapist, because I also recognize, people watching might be intimidated to actually call a therapist. And, the hope is that maybe by using the therapist on the Sanvello app, it might be a little bit less intimidating because it's on your phone. And there's a million other things that you can do on the app as well if you're intimidated by the therapy aspect of it.
I was curious, do the rules that regulate pre-pandemic therapists and whether or not that person is licensed to work with you, do those apply when we're talking about this kind of interaction? Because I know that the people on, you're still seeing a licensed therapist.
Oh, sorry, it cut out a little bit at the end.
You're still seeing a licensed therapist on the app, or are these just people who are highly trained?
I believe it is a licensed therapist, but we can double check that for you.
Terrific.
Allie, I do want to ask you about, some of your teammates and yourself and folks who are involved with the Olympics, which, as we know, has been postponed, particularly for gymnasts who don't have a hugely long, decades-long career competing in many cases. How big of a setback is this for folks? And I would think that that would add to some of the mental health pressures and challenges for athletes as well.
Yeah, I mean, I think that safety and the priority of the athlete's well-being is the number one priority and always should be. But I also understand, and I actually don't understand because I'm not competing. I can't imagine how devastating it is for these athletes and the coaches and, everyone involved in the Olympic movement that it has been postponed because you are working so hard for it. And the Olympic Games are something that is only every 4 years. And so, it's there's so many different barriers for different people. Maybe some athletes actually can't even afford to train for a whole other year. And so there's so many different things. Maybe their bodies just can't handle it. Maybe they have injuries and they would have been prepared for this Olympics in August and next year. They just won't peak at that same time. So I just think it really speaks to the importance of the mental health aspect of really encouraging athletes to realize that they're more than just an athlete. And I know that can be so hard because when you're in this mindset of being an athlete, it's like the priority is winning, and you feel like making that team is the biggest deal in the world. But I think that it really goes back to knowing that you're more than an athlete and really taking care of your mental health every single day. I encourage people, whether or not they're training for the Olympics or not, to take time for themselves every single day. Even if you have 1 minute, it's better than nothing. I think having that routine of checking in with yourself is extremely crucial and very, very important.
Allie, thank you for joining us, and thank you so much for speaking out on this very important issue. Allie Raisman, Olympic gold medalist. What a pleasure to speak with you. Thank you so much.
Thank you so much.
We'll be right back. Our next guest company sort of sits at the intersection of a lot of different timely topics that we are watching right now. We're watching the wildfires in California and thinking about construction and where we should be building. At the same time that there is a housing boom a housing market boom in some areas of the United States. Sam Rubin is the co-founder and chief sustainability officer of Mighty Buildings, which is a startup that makes houses by 3D printing. Sam, thank you for joining us. How exactly does this work, right? Because we've talked about 3D printing of a lot of different things in manufacturing, but buildings, I mean, that's on another scale, obviously.
Yeah, very much so. So at Mighty Buildings, we've actually developed a unique material that's different than concrete, which cures using light, which allows it to harden quickly enough that we can print not only the floors and walls, but also the roofs of structures.
I am curious, though, when I look at some of the website, what gets built, there is a housing shortage, we need housing, but it's very 1970s minimalist, almost Logan's Run. Ugh, no offense to the designs, but you do it quickly, but it's a box.
Yeah, so with what we're doing, because of how quickly our material cures, we actually opened up whole new design possibilities. You'll see on our website at mightybuildings.com that we have our modules which have a curved wall, which kind of hints at the kind of design possibilities that we can do. But we also have the ability to do more traditional looks. And one of the unique aspects of what we're doing is really that design flexibility to do both existing aesthetics, introduce new aesthetics, and really create whatever's needed for design longer term.
Jared Blickery here. I just want to ask you, what is how how scalable is this technology? Could you build entire cities with this, or is this just one building here, one building there? How big is your market and production capabilities?
Yeah, so one of the reasons that we focused on doing 3D printing in the prefab space is that it really unlocks the opportunity to produce at a mass scale. And we've also been working here in California with the factory built housing program to certify our units so they can actually be placed in any backyard in California. And so far we've delivered 2 units in San Ramon and San Diego, with another 3 units on our shop floor right now waiting for the site work to be completed, another 16 on contract, and we've just launched a new partnership with a developer to do a couple hundred units over the next couple of years. So we're really looking at expanding this at scale by establishing printing hubs in California, around the country, and around the world where there's demand to be able to serve those markets at the commercial scale.
Sam, when you look at these kinds of projects, I guess, where do you think that they fit the best in terms of, climate and location? If I'm in the Northeast and there's a heavy snowfall, is it going to be able to hold up to the weight of that? I guess, where do you see these fitting with the designs that are currently being shown?
Yeah, so our current designs were designed for the California market, but with the new fiber reinforced version of our material, we're going to be able to operate anywhere in the world, really, because the structural strength is similar to steel. So it opens up the opportunities to address markets. And one of the cool things about California is that we actually have snow load. We have cold weather. We have hot weather. We have all those extremes. We also have one of the most stringent building codes in the world, which is why we started here versus, say, somewhere like Texas, where you can really kind of do everything, is we want to make it really easy to be able to translate the building to the building code of other states. And we've also really been focusing on the regulatory side, because this is housing. This isn't software that you can throw out in the wild and debug on the fly. We really have to make sure that we're doing it safely. And so we've been working closely with UL and are the first company certified under their new 3401 standard for 3D printing and construction, which has actually been added as an adoptable appendix to the 2021 International Residential Code to provide guidance to municipalities that want to use 3D printed houses.
Sam, I have a little bit more question about the use case here, right? Because one of the other attractive qualities of this is it's very low cost compared with traditional construction. So who are the customers right now, and who do you think the customers will be? Is this a public housing use case, for example, or do you think that private homeowners are going to be more interested in this?
Yeah, so initially we've started with the accessory dwelling unit market in California, given the changes in state law to really streamline the permitting of that. And so for our initial units, we've actually been selling directly to homeowners. And we've, as I mentioned, we've also signed an agreement recently with the developer to do ADUs on some of their multifamily developments, which are currently market rate. But long term, we really see what we're doing as completely market agnostic, as well as being design agnostic, and truly a tool for industry to allow the existing labor force to build more in order to really get all the housing out there in order to close the affordability gap. So whether that's low-income housing eventually, or where we are right now with more market rate, we don't really see that being a limitation.
Sam Rubin is co-founder and chief sustainability officer of Mighty Buildings. Thank you so much. Appreciate it.
Thank you for the opportunity.
Well, from new school, coming up next, we're going to go a little more old school. We are going to talk vodka. Stay tuned. Well, alcohol is one of the many, many different markets that has changed because of the coronavirus pandemic. More people drinking at home, not seeing as many sales in outlets, bars, for example, that are still closed in many places. I want to bring in Rodney Williams. He is the CEO of Belvedere, the vodka company, and he's joining us from New York City. Rodney, it's great to see you again. So what have you seen in terms of your business, your customer base? And how have you had to change as a result of everything that's happened?
Yeah, well, as you well mentioned, having restaurants, bars, and nightclubs closed had an adverse impact on our traditional business. However, we've seen a really strong uptick at retail, and particularly in terms of e-retail and e-commerce sales. One of the trends we're seeing is that young adults are spending a little bit more time at home. Maybe they couldn't go off to graduate school, didn't start that job at first, and their digital savvy in terms of e-commerce is now benefiting their parents and others in the household. So we've seen a pretty strong response there. And in the world of vodka in particular, it's a big category, the biggest in terms of spirits. And overall, consumers are moving into many different craft spirits, but the super premium vodka category is growing, and we've been fortunate to be a part of that. So net, we're up 11% year to date, and 16% for the most recent quarter ending in July.
Hey, Rodney, it's good to see you again. My birthday's coming up soon. And I make a mean Moscow Mule, the key ingredient vodka. My birthday's coming up soon. And I'm curious because with Belvedere vodka, you have a new kind of vodka. Would that be good in my Moscow Mule? My birthday's coming up really soon, by the way.
I think so. But we might even entice you to a whole new way of drinking. So we just launched something called Heritage 176. And basically, we went back to the archives and created a vodka the way vodka was created up until the late 1800s, early 1900s, where the rye is malted at 176 degrees, hence the name, Heritage 176, and it imparts flavor with no sugar. There's no additive. And that's the beauty of Belvedere, is that it's all natural. It's literally just rye and water and distilled by fire and nothing else. So I take away notes of honey and roundness in the finish, but it's a great sipping vodka. So we're quite excited about it.
Rodney, I kind of want to ask about the growth of people drinking more at home and kind of whether or not it's been as exceptionally, I guess, large, or if it's just kind of been around the same. Are we really seeing a lot more people drinking at home, and what do those numbers look like?
Yeah, so we're still sorting out those dynamics. I think when the pandemic first hit around March or so, there was a lot of pantry loading. People were stocking up, but there was still the assumption that we'd ride out this situation for a couple of months and the world would somehow right itself, certainly by the end of summer. Now that there's a realization that this is more staying power and there is a new norm, at least in the interim while the pandemic reigns, consumers have really embarked on creating drinking experiences at home that they weren't pursuing beforehand. We're seeing people convert garage space into home bars, which we weren't seeing before. Our online consumption of recipes with our bartenders and ambassadors is nothing like it ever was prior to the pandemic. So some of these behaviors we suspect will continue. There's still a big angst, and our research says probably about 12% of consumers who really only drank in restaurants and bars and clubs that we want to get back into the category.
Jared Blicker here. I want to ask you if you notice any trends in product mix or pricing. Are you still able to command, are you still selling as much as a premium product, or are people just kind of going bargain basement shopping?
Yeah, it's a great question. And a big fear of ours, given the fact that, we play at the top of super premium vodka, that that would be the case. But in fact, what we're finding is that, and this is true of being in a recession or other difficult times, there is a sort of retreat to quality that the consumer has, where he or she wants to have real confidence in what they're buying. And it's, also with the economic pressure that we're all facing, that they're really getting quality for their money. So we're finding in a category like vodka, the premium and super premium brands are really the brands that are driving the growth more than the economy brands. This interest in craft and craft spirits has really continued to sustain itself. Now, it's also probably true that the stimulus spending helped facilitate some of that. And so we still believe as we move into the fall and winter and possibly a second wave of the pandemic that we're still sorting out what the new norm is going to be.
Rodney, great to see you. Thank you so much. Rodney Williams is the CEO of Belvedere. Be well, Rodney.
Yes, and happy birthday in advance.
Gee, I wonder what I'm going to get him. I want to bring in Melody Hom now, or Melody Hom, because there is a new documentary about Paris Hilton. Not necessarily the first documentary subject you would think of. You would think that all of Paris's life had been plumbed already with her various reality show appearances, but indeed, this documentary tries to expose a different side of Paris. Melody, you had the chance to talk to her. What was that conversation like?
Yeah, Julie, this is very explicitly her chance to reframe her legacy, right? As you say, a lot of her initial years, she's 39 years old. She's been in the spotlight for more than half of her life, has been a caricature in her own words, and that she was supposed to embody this persona, this blonde bombshell, sort of bimbo in many ways. But it's her chance to say, okay, I'm getting into investing. I want to really craft and show the vulnerable side of my life. One area that we actually discussed was the social media apps. You know, she's the OG influencer in many ways, where she was able to peddle her own products, really elevate her own brand. And she said TikTok is her favorite app, bar none. Listen to what she had to say.
I just love the platform. I love the editing. I love all just the different things that you could do. I love all the challenges, the music. I just think it's so creative and fun. And if someone loves to dance or they want to do comedy or beauty, you basically could do anything. And it's just, the innovation is amazing. And it's just more fun than any of the other platforms. You just have a good time with it.
And so just thinking about this sort of juxtaposition, right, where a lot of her life, even this video you're seeing, she's very glammed up, very dolled up. It's counterintuitive because TikTok is supposed to be raw and vulnerable. And Dan Helmley was mentioning in his earlier hit that even the kind of other brands in the portfolio right now, when you look at social media, whether it's Triller, whether it's YouTube, whether it's Instagram's Reels, a lot of them, they're just repurposing the TikToks that they've already posted, right? So Paris did say that she has a diversified portfolio. She's trying to invest in all the different social media companies, but she's really excited about the different avenues that she could possibly see TikTok blowing up. I do want to point out that she started a That's Hot challenge, aptly named after her signature tagline, and it got over 1 billion views within the first 24 hours, and she's going to start sharing content from users.
Very interesting stuff. And also, I guess in the movie, what they talk about, what I had forgotten, Kim Kardashian used to be her assistant.
Exactly.
Forgot about that. All right, Melanie, thank you so much. Appreciate it. We'll be right back. It's time for Word on the Street, where we check in with our panelists, find out what stories or trends they are watching. In the case of Jared, you are watching a trend, which is market breadth, because there's a lot of concern about tech stocks and their influence in the market. But you're looking at overall breadth and not necessarily liking what you see.
Yeah, overall breadth, that is a number of stocks that are rising minus those that are declining. And you can add that value on a day-to-day basis to come up with a cumulative indicator. That peaked around mid to late August, and we have seen it trending down ever since, even as the market continued to make record highs. And so, yeah, there's a lot of talk about market concentration, and it is a fact that the top 10 companies in the S&P 500 accounted for over half of the gains that we saw in August. That was 6.7% for the S&P 500. But you can also look at it on a different view, a different way, which is the equal weighted S&P 500. That has yet to make a record high. And so really the number of stocks that are participating in the rally, when we have them, has not been confirming the overall market strength. Now, it is up today, so we have market breadth advancing today. We'll have to see what happens into the close. And we do have options expiration this Friday, which is going to be very important to look at because it's got a lot of talk that the options market on some days has become bigger than the underlying stock market. That is in terms of total volume. And a lot of that has to do with Robinhooders and retail traders buying options, but also SoftBank and other whales buying options on some of these big stocks as well. So it's going to have important implications for the market. And we do tend to see weakness later in the month of September after options expiration. So that seasonality is a bit of a headwind for stocks going forward.
Good thing to watch on Friday. A good thing to watch tomorrow, maybe, will be Apple's event. Dan Halley, I know you're watching that closely. Doesn't sound like we're going to get a new phone tomorrow or a new phone introduced. What are we going to get?
Yeah, it seems like we're going to be getting the next iPhones introduced probably at the end of the month, maybe into October. And that's kind of a result of the slowdown caused by the coronavirus pandemic. We had previously heard Tim Cook and Apple basically say that the iPhones will be a few weeks later than they normally are. And look, normally they would be released this week or announced this week at an event in Cupertino. It's always a Tuesday. It's always around this time of the month, but we may end up getting them later. And Apple does have events in October. So it does make sense that they would kind of flip the script and instead of having an older one, use this one now. I think the biggest thing to look at is the new Apple Watch. Those will be introduced. There'll probably be an entry-level Apple Watch and then an Apple Watch Series 6. That'll be the premium one. That'll probably start around $399. And you can expect probably better battery life, a blood oxygen sensor, as well as improvements including sleep tracking. Now that's coming as part of Watch OS 7 and is available as a beta now. I've been using it and basically it tells me I get zero sleep. So if you're looking for something to reaffirm that you're a terrible sleeper, the Apple Watch is where to go.
Yikes. I think you are not alone in that, though, Dan Halley. I just want to mention as well, we just got the news, TechCrunch reporting that Google is going to announce a new Pixel, smart speaker, and Chromecast. It has an event at the end of the month also on September 30th. So that'll be something else to put on your calendar there, Dan Halley, to watch as that comes up. I also want to bring you some other breaking news here, which is that TikTok has come out with an official response to all of the back and forth today, saying they can confirm they've submitted a proposal to the Treasury Department, they say, which we believe would resolve the administration's security concerns. So again, it's not clear exactly what that proposal is, but TikTok did come out and make that statement. As we leave you, just want to let you know the S&P 500 is hanging on to a gain of about 1.5% today. The Dow and the Nasdaq also up around that or more. Crude oil today is pulling back by about 0.5%, and it's just above $37 a barrel. So that's something to continue to watch. And the dollar continues to trend a bit lower. The euro is rising against it today. Thank you, Jared. Thank you, Dan. And thanks to Adam, as always. Keep it right here on Yahoo Finance.
Hello, everybody. Welcome into live market coverage here on Yahoo Finance. You're watching the ticker. I'm Zach Guzman. And right now, stocks are kicking off the week in positive fashion here. The NASDAQ coming off its worst one-week decline that we've seen since March, kicking things off with about a 2% gain here in the afternoon trade, leading the overall major indices right now with that gain. The S&P up by about 1.6% and the Dow up by about 1.4%. It's supposed to be a very busy week on Wall Street. We're going to get a few IPOs later on. Snowflake, Sumo Logic, JFrog, and Amwell Health. The big banner names here. Not a lot of economic data, but a lot in terms of deals that are being discussed here today. That fueling overall market sentiment. We'll get into that in a second. Also want to highlight crude oil here retreating closer to $37 a barrel, off about 0.5% here today. The big driver on the oil moves here is OPEC says it expects the pandemic to reduce demand by about 9.5 million barrels a day. That would overall boil out to about a 9.5% decline versus last year. But when you back up and look at the overall market sentiment here, we got a little bit of optimism here over the weekend on the coronavirus front, specifically tied to research on the vaccine front, as Pfizer CEO says that some vaccines could be distributed as early as before the end of the year. And AstraZeneca announced a resumption of their own phase 3 trials there with researchers at the University of Oxford. They resumed those trials after pausing once one of those patients in that trial fell ill. AstraZeneca shares up almost 1% today in the afternoon trade. Also want to highlight some interesting news that broke on the sports gaming front. DraftKings and Caesars entering into two distinct co-exclusive pacts with Disney's ESPN network. That deal announced that DraftKings would become the link-out provider, or ESPN would become the link-out provider for DraftKings there, funneling users over to their products and services on the ESPN digital platforms. DraftKings would also power a lot of the ESPN betting content there, with daily fantasy sports segments beginning on ESPN's premier studio shows. DraftKings shares, though, spiking more than 12% on the news. Caesars Entertainment also seeing a boost on that as well. And the big one, the big deal that everyone's been waiting for on the TikTok front, Oracle beating out Microsoft there. We're seeing shares in Oracle spike about 5% today after news of that potential partnership broke. We got the update from Secretary of the Treasury, Steve Mnuchin, talking about what TikTok Global would look like here in the U.S. And the company did confirm a lot of those plans earlier in a statement, saying that the company would serve as TikTok's, quote, trusted tech partner in the U.S. A lot of question marks around what that means, but furthering the notion that this deal, that again, still needs to be approved by the Committee on Foreign Investment in the U.S. and likely to get approved by President Donald Trump. But ideas forming here that the deal is not just going to be an outright sale like it had been discussed in the past, but potentially a partnership. We're going to dig into that in just a moment. But first, want to back up and think about the questions that investors are facing this week after last week's volatility. A lot of questions around whether or not today's big move to the upside signals an all clear for investors to jump back in. Tech sector, again, one of the standouts here after a tough week last week. And here to discuss that with us is Victoria Fernandez, Crossmark Global Investments Chief Market Strategist. And Victoria, I mean, that seems to be the number one question here. I know you're giving advice to investors about certain strategies they can take to protect themselves should we see volatility resume this week. What are you telling clients right now to navigate all this, and where do you see the market headed now?
Well, where we see the market headed, I think, is going to be more of what we've seen over the past couple of weeks, in the sense that we expect some continued volatility, not just because we've seen some of those high-flying tech names really make a move higher, but we've got the election coming up in, 50 days now. We've got U.S.-China relations that are kind of back on the front burner on some things. You've got the U.K. doing its exit from the EU, that deadline coming up later this year. So there's a lot of things that can add to volatility. But saying that, what we're doing with our investors is really taking a little bit off the table on some of those really high growth tech names and trying to build more of a barbell strategy where we're going into more of the staple names in the portfolio. Some of these value names that we've seen lag a little bit during the big run up on the tech side, we think building your portfolio that way gives you a little bit of a buffer for continued volatility going forward.
Yeah, and some of those value names, I mean, we've seen the market trade close to the direction that we've seen on the coronavirus case count front. That's been improving over the last few weeks. It's driven a little bit of a boost here as tech has come back down. As you said, we have seen the opposite true for a lot of these value names. But when you look specifically to that sector, what are the names that jump out to you as maybe ones that might frame well to be a longer term investment?
Yeah, so we have a few names that we've been adding to our portfolio over the last month or so. Walmart is one of those names that we've added. You were talking about the TikTok deal earlier, and that wasn't one of the reasons we originally purchased Walmart in the portfolio, but it did add some benefit. We've seen that come back a little bit. But look, that's going to be your only strong player against Amazon on that e-commerce side. So we think that's a good name that you can put in your portfolio. We can look at other names like a McCormick on the Spice Company. And these are names that we see trends going forward, not just COVID-19 bets, but further trends that we think will extend beyond a COVID-19 recovery. Cooking at home, we think, is one of those, as people are getting used to that and families are enjoying doing that together. But I think you can also look at names like the banks. JP Morgan is a name that we've added recently. And I know a lot of people are concerned about the banks because rates have been so low. But with that short end of the curve anchored with what the Fed is doing, in anticipation, we might see a higher end on the long end of the curve. And so we get that steepness. Out of all the banks, we like JP Morgan. So we added a little bit of exposure there as well.
Yeah, we got the update on the inflation front last week showing that things might be ticking up a little bit hotter here than some had expected. So we'll be watching that when we hear Fed Chair Jerome Powell speaking later at the FOMC announcement later this week. But when we think about this recovery, to your point of some of these names doing well, whether or not that recovery really accelerates here in the back half of 2020, I'd be curious to get your take on prospects of that happening when you just think about the length of time that we've gone since those additional unemployment benefits rolled off at the end of July. A lot of people wondering what the actual state of the consumer is. You can look at the deals that are being made in the tech space right now, and maybe that boosts confidence from some of those powerful brokers here, the leaders of these companies, saying things are going to remain intact in the back half of the year. But when you look at the underlying strength of the economy, what do you assess the longer this drags on without any phase 4 deal in Washington?
So, Zach, I think you're right. The consumer and the consumption numbers are really key, and it's something that we're watching very closely. Consumption's actually held up pretty well over the last couple of months, which was a little bit surprising, especially with that extra unemployment insurance not being there for the last 6 weeks or so. And we don't see a new stimulus package imminent to help those people. So we have to, kind of look and say the savings that people accumulated over the last 6 months, is that going to start to run out without any extra benefit coming in? And how is that going to affect the consumers and the consumption numbers? But again, you mentioned the economic numbers coming out last week. The goods component side is lagging the spending side. So that leads you to think that perhaps we could see some of that inflation move a little bit higher. But in the long run, we've had the Fed say it really doesn't matter at this point. They've taken that new approach to monetary policy. Inflation can move higher as long as we still have the situation that we're in and the economy is still struggling to recovery. We're going to have the stimulus. We're going to have the liquidity lift from the Fed and low rates. So I think the economy is set to continue to do well with that supporting it.
Yeah, and as Fed Chair Powell has said before, a lot of this is tied back to the way that the U.S. handles the pandemic at hand. And obviously, we're going to be getting some key data coming in over the next 2 weeks after that long Labor Day weekend. Things moving in the right direction for now, but we'll continue to track that and see how it all plays out. But for now, we'll leave that there. Victoria Fernandez, Crossmark Global Investments Chief Market Strategist. Appreciate you taking the time to chat. On the TikTok front, though, that being a one that is kind of bridging the gap here in terms of the market action we've been seeing play out, as well as politics in Washington, D.C. Let's not forget that a lot of the drama over TikTok was sparked here by national security concerns. And now with Oracle beating out Microsoft for the bid here to take over ByteDance's TikTok U.S. business. Interesting to see the updates there as Secretary Mnuchin was discussing how this deal might go. Of course, it is subject to approval from the Committee on Foreign Investment in the U.S., or CFIUS. They say they're going to meet this week before it makes its recommendation to the president, who will also make the final decision here. It's worth noting in that deal, a lot of questions have surrounded whether or not this would be an outright purchase. That's, of course, the track that Microsoft seemed to be wanting to take. Here, Oracle saying that it would be TikTok's trusted tech partner in the U.S. And still, people are wondering, what that might mean. But worth noting overall, when you think about the politics at play here, Oracle co-founder Larry Ellison, of course, earlier this year threw a political fundraiser at his house for the president. That could be potentially something here to keep an eye on, and also maybe a reason as to why Oracle might want to push through here. But still, a lot of questions as to why the cloud giant might be making a consumer-facing push. And analysts are a bit torn on whether or not it makes sense for the company. And here to discuss that with us is our next guest. Kelly O'Grady is .LA chief correspondent and former Disney senior analyst, corporate strategy and business development. And Kelly, good to have you back on the program here. I mean, walk me through what your thoughts are, because as I said, I mean, a cloud giant like Oracle, a lot of people said that Microsoft coming in here would make a lot more sense, but when you factor in the politics of it all, maybe not so surprising.
Yeah, thanks for having me back on, Zach. So this is really interesting. I think that this is Oracle's bread and butter. It makes a lot more sense for them to be a tech partner rather than buy it in an outright sale, as we discussed before. They don't really have a foothold in the consumer-facing business, and they're more B2B. So playing that cloud security, data security role would make a lot more sense for them. And then potentially down the line, seeing a spin out or an IPO of TikTok as a whole. So the thing which I'm really interested, though, is that Microsoft back in the summer had a similar deal on the table. It was to be a tech partner, and ByteDance would retain a minority stake. And this was absolutely unacceptable to the Trump administration. They stated that it would have to be a full outright ownership by a U.S. company for TikTok to continue operating in the United States. So this leads me to believe that we may see some issues with the CFIUS ruling. I mean, of course, this does give the optical piece for the president to have shown that he's hard on China, but it also shows that Beijing is getting appeased a little bit, and that could lead to some issues and a little bit more drama coming out of this, depending on how CFIUS reviews the deal.
Yeah, I mean, when we think about the upside here, analysts, as I said, are kind of split on the idea of what this might mean for Oracle. Obviously, a lot of money is at hand here when we think about monetizing its 84 million US users, TikTok's users. Bank of America is saying that if they monetize that on a roughly equivalent scale to what YouTube's been able to do with its worldwide user base, you could be looking at $630 million to $6 billion in revenues a year. So there's no small piece of change that we're talking about in this deal. But I guess the question becomes whether or not it makes sense with what Oracle's doing overall. And when you stack it up against what Microsoft would have gotten, and obviously they already have a presence in the social media space, I'd be curious to get your take on what Larry Ellison might see in this outside of just the IPO chance.
Yeah, absolutely. I mean, I think that it really gives them an opportunity in a very, very public way to show that they are the leader in cloud and data security. You know, this has been a very publicized deal, probably the most publicized M&A deal in recent history. And so given that they're also winning contracts with the government, they lost out on a recent one, this gives them an opportunity to show more that they are that leader in that space. So I think that's what you're seeing. I love that you brought up the Larry Ellison point, Zach. I think that's another interesting aspect of this. As you said before, he is a friend and donor to the Trump campaign. So I'm curious to see if that has any sway in whether this is approved or not. And I would also expect the Biden campaign to come out swinging because optically it's not a great look given that Microsoft had previously had a similar deal on the table if the president does approve this for his friend.
Yeah, not to mention also when you think about the current CEO, Safra Catz, also worked on the executive committee for the Trump transition team back in 2016. So not just Larry Ellison that has that relationship there at Oracle. But when you step back, I know you've worked on a lot of these deals. The timeline here is also something that I think has a lot of people just mind-boggled in terms of the speed of this getting done. Mnuchin did say that the deal's timeline was indeed September 20th, which would be just about 6 days from now. So, I mean, when you think about the time and speed that had to have come in a deal like this because the president slapped this timeline on it, I mean, are you still thinking that maybe this could get done based on everything we know and all the sign-offs that are required? I mean, how surprised are you that we're here, sitting here just a couple weeks after we heard about this, that we could see Oracle taking over?
I am very impressed, and I know that there are some very tired analysts out there who have been working on the model to get this happening from my own experience. Listen, I think that we are going to see a little bit more of an evolution because while this does address the data security issues, this partnership doesn't address the fact that there could still be underlying spyware in the tech, which is something that the president has been very concerned about. And it doesn't address the algorithm. This is unlikely if it's a partnership that Oracle would actually get their hands on the tech or algorithm. And you could see potentially propaganda or certain election candidates being pushed forward on that for you component. That's one of the biggest issues that people are concerned. It's not just the data, but it's consumers being swayed by the app. And so I'm very impressed that a deal has been reached in such a short period of time. But I do think that we're going to see a little bit more develop out of that CFIUS ruling and potentially the president's own motivations being seen as hard on China.
Yeah, it's going to take a lot of those hurdles to get through here, but we'll see what happens in the weeks ahead. But for now, Kelly O'Grady, always good to chat with you. Thanks again for coming on.
Thanks, Zach.
All right, we're going to take our first break here on the ticker, but when we return, digging into the new report from the CDC warning about the ability for children to spread coronavirus to parents in the household, why that is a new stance and what it says about the return to schools this fall. More concerns on that health front. We'll break down all the coronavirus latest right after this. Welcome back to live market coverage here on the ticker. Of course, over the last few weeks, we have seen things improve here on the coronavirus front, at least when you track the average of new cases. Those have come down here in the US and leading some to think that maybe we've moved past the worst of it. But there are new concerns tied to children going back to school. A new CDC report there highlighting the risks associated with the idea that children could spread coronavirus cases that they get at school back into the home. And that was the finding of a new CDC report that highlighted about 25% of children observed in that study did transmit cases back to those who were not in the school or non-facility contacts there, raising new questions about those risks as students do return to school. And here to discuss that with us and more on the coronavirus front is our next guest, Dr. Amish Adalja, senior scholar at Johns Hopkins Center for Health Security, joins us now. And Dr. Adalja, I mean, this is interesting to see the CDC come out with this because we had seen reports, mainly from Politico, highlighting pressure from Trump appointees on Dr. Fauci to kind of stress here that children were not a risk in going back to school, at least when it comes to transmitting coronavirus back into the house. I just want to read one of those emails that Politico did have from a Trump appointee applying pressure ahead of Dr. Fauci's media reports. In that email that they published, they said, can you make sure here, quote, that there's no data, none, zero across the entire world that shows children, especially young children, spread this virus to other children or to adults or to their teachers, none. And if it did occur, the risk is essentially zero. It would seem to me that now we do have data that shows there is a risk here. And what does it say to you?
It tells us that we're learning a lot about this virus, and it has been true that children have been spared hospitalizations and deaths, and we haven't seen them sparking outbreaks. But there are circumstances when outbreaks can be driven by children where they can spread it to individuals. So it is important when you have schools, daycare centers, summer camps, all of those types of activities, you need to still have mitigation efforts. It's not guaranteed that those, just because you're having children there, that you're not going to get spread. And it is important, as we have schools opening, that they put in place face covering rules for those children, because there is this chance. It's non-zero. We know it hasn't been driving the outbreak, but it's clear that it does occur, and it is not true that it's something that you can forget about or not think it has to be an important part of how you think about reopening schools and other places where children congregate.
And how would you judge? I mean, when we think about the statistics behind the study, obviously preliminary in kind of looking at this first, but I mean, what do you make about the risks associated with that if it is about a quarter of the spread here in the CDC observation?
In this study, it does appear that it's significant. 25% of a 25% attack rate is something that's around what we expect with adults in a household. For example, one adult may infect 25% of the other members of their household. That seems to be high. So we want to know exactly where did they contract this, what types of mitigation efforts were in place at those places where the children got infected, so that we can try and learn from this and minimize the spread that children might have. Again, it's also important to remember it is one study, and it's hard to extrapolate one study to what's going on in the entire world. And was there something special about these circumstances that allowed this to happen? The age of the children, the activities that they were in, how they interacted in the household. So there's a lot of questions there. So we have to be careful not to underinterpret this, and we have to be careful not to overinterpret it. So we want more data on children, and I think we're going to get it as schools open across the country.
Yeah, well, at the very least, we are given the chance to interpret the data, a very scientific approach here to think about what this means. And that, I guess, would kind of support the idea that maybe these institutions, whether it be the FDA or the CDC, are allowed to do their jobs here and not being pressured politically. I know that there have been fears about that happening, especially as we get close to maybe getting one of these vaccine candidates approved for emergency use authorization. But when you step back and look at the Trump campaign itself, interesting to see them denying or defying, I should say, the directive in Nevada as they hosted an indoor rally there and really looked over the fact that Nevada doesn't allow more than 50 people to gather indoors right now. They said they chose some outdoor venues that were declined by the governor. But what do you make of that, landing on a manufacturing plant, the president speaking indoor at a rally, and the risks tied to that during the pandemic?
It's another example of this mixed messaging that we've seen from the very beginning of this pandemic, where on the one hand, they're underplaying it, behaving as if we're not in a pandemic, but then, as we heard on the Woodward tapes, talking about the fact that they know that this is severe, that it is worse than influenza. And I think that makes it very hard for the general public to know how to behave. And we know that indoors, the spread of the virus is enhanced. And we've seen already with political rallies like the one in Oklahoma that cases can occur. So this is something that if you can do this outdoors, if you can do social distancing, if you can have a face masking policy, you can make this safer. We know we can't get the risk down to zero, but I think it is careless to have these types of large gatherings indoors when there are other alternatives available, especially when it is something like a political rally. And it seems more to make a political point than it actually does to try and mitigate the spread of this virus. And I think this, again, is just poor leadership that we've seen from the very beginning of this pandemic from the highest levels of our government.
Yeah, I mean, obviously, it's not just the political rallies here, as we were discussing on the show last week, some stadiums allowing fans back in. So there's a lot of measuring to do in these next couple of weeks to see where cases go, particularly where these things were allowed to move forward. But until we get a vaccine, that seems to be the cycle that we're in, is watching the data, looking at where these hotbeds are of new cases. But on that front, the vaccine front, interesting to see the updates there, as Pfizer's CEO mentioned that it could be possible here for Americans to get those COVID shots before the end of 2020. I'd be curious to get your take on that timeline here, as again, all of these vaccine candidates would need to get FDA emergency use authorization here before they're rolled out to the public. But what do you think about that timeline to actually get them to those first line workers before the end of the year?
I think it's in the realm of possibility. If everything goes perfect in phase 3 clinical trials with the Pfizer candidate or with some of the other candidates, that we can get a limited emergency use authorization before the end of the year for maybe healthcare workers, high-risk individuals. It's not going to be as if the general public has access to this vaccine probably well into 2021. So I do think that we can expect a trickle of vaccines, several 100,000 doses maybe, that can cover some of our healthcare workers who are at highest risk. But this is something that we're going to be fighting for the most part without a vaccine as we get into 2021.
Yeah, and beyond just those big CEOs, I mean, they're working with other companies here to really roll those out, and that becomes the next question: is how much manufacturing capabilities here can feed these vaccines to get them out across the world? The Financial Times recently spoke with the CEO of the world's largest vaccine manufacturer, based in India. And he laid out the timeline that it would take until about the end of 2024 to have all of the vaccines needed to get out there across the world. It's going to be until 2024. So, I mean, when you think about that, how long stretched would the vaccine rollout be in getting it into the hands of all those people out there that actually need it, and you can reach the herd mentality that needs to be achieved?
We know it's going to be a big challenge, especially in resource-poor countries. We still have problems getting measles vaccine into people's arms or polio vaccine into people's mouths when you think about the world as a whole. So I do think we are going to be rolling out this vaccine program, if you think about it globally, for several years. I think in the United States, hopefully by the end of 2021, we have enough people vaccinated to cross the herd immunity threshold. But vaccine delivery is a very complicated matter. And some of these vaccines, they require 2 doses and they require extreme cold storage, like minus 70 degrees centigrade. That's very hard to do when you're thinking about places where they don't have electricity that's standard. So this is going to be one of the most daunting vaccination programs that we've ever had, probably in history.
Yeah, and it's going to be something to watch here when you think about, as you said, all of those complexities on the organizational front. Clearly has not gone well, at least on the testing front, to get us here. So a lot of hurdles to see us overcome. But Dr. Amish Adalja, senior scholar from Johns Hopkins Center for Health Security, always appreciate you taking the time to chat.
Thank you.
We're going to take another break here on the ticker. When we return, digging into the statistics behind Democratic nominee for President Joe Biden's tax proposals, a new study out there from the Penn Wharton budget model, digging into where spending is getting boosted and what it means for taxes for millions of Americans. We'll chat that right after the break. Stay with us. welcome back to the ticker. Right now, we are still seeing strength in the markets coming off the NASDAQ's weakest week since March. Today, kicking things off in the green, up more than 1.5%. Again, as tech stands out to kick off the week. Keep you updated on those market moves. But for right now, with the election less than 2 months away, I want to dig into Joe Biden's tax proposals here. A new model out of the Penn Wharton budget model indicating where Biden seeks to boost spending here and what that means for taxes for millions of Americans and whether or not taxes will be going up and where they will be going up. And here to discuss that with us is Rich Prizanzano, Penn Wharton Budget Model Director of Policy Analysis. And Rich, I mean, your new report here highlights the big boost in net spending, whether you look at education, infrastructure, or research and development. I mean, there's some big spending proposals in this plan, but how does it stack up in terms of how we're going to pay for it?
Yeah, so actually it's pretty interesting. So there's some significant, as you mentioned, some significant tax increases, mostly on the corporate side and the upper income, sort of above 400K. And then over time, the spending programs that Biden has put forth are actually what I would say is productive. So education makes people more educated. Obviously, that makes them more productive. That leads to more production in the economy. Similar to the infrastructure, kind of the discussion that you're having before. As you build roads and bridges and things like that, it makes everything in the economy move a little bit smoother and be a little more productive. So that spending kind of adds up to a bit of a productivity boost, even accounting for some of the negative aspects that are related with tax increases.
Yeah, and I mean, when we think about how President Trump, we've already seen this play out on the campaign trail, attacking Joe Biden as increasing your taxes for every American across the board. When you dig into the specifics of the proposal, you mark that 400,000 income level here as kind of the break point. But when you dig into it, I mean, how much truth is behind that, and where do you see taxes rising here under the proposal?
Yeah, so this is one of those things for the tax community is kind of wonky. The corporate tax increases by convention, the sort of the standard in people that work on what I work on, take those corporate taxes and pass them through to individuals. It hits workers in lower wages. It hits shareholders in lower dividends. And so it's right that if you consider the corporate taxes being passed through, there's a small increase all through the distribution. And that's, I think, the basis of the claim of the Trump administration. But I don't think any economist would say those changes would happen immediately. So when, in our analysis, we like to have a toggle that turns off that sort of standard passing through the corporate taxes. And when you do that, you find that group below 400K doesn't face any tax increases.
Yeah, because that's really the tricky thing here. Obviously, we've seen how Trump has changed tax law, specifically on that corporate tax rate. It's something he campaigned on during the last election cycle, and he did that. He permanently slashed the corporate tax rate from 35% to 21% through the 2017 Tax Cuts and Jobs Act. But when you think about what President or former Vice President Joe Biden has discussed in this proposal, he wants to slash that corporate tax rate from 28% as it's put, or from 21%, he wants to raise it to 28%. Excuse me. So, I mean, when you think about that moving in the opposite direction, you talk about the trickle down effects for the average worker here. I mean, how long, if not instantaneously, would you expect these things to impact the overall broader job market out there? As we've noted, after 2020, there's going to be a long and healthy recovery period here before we get back to normal.
Yeah, so I think, the ultimately, when we sort of think of the fully phased in changes, we're talking about an average of a drop in after-tax income of about 0.7% for folks. So less than a percentage point drop. So again, for those set, even fully phased in, it's really small. And I think, timing is sort of depends on which model you pick to look at. So I think a lot of good academic researchers have it between, say, 5 and 10 years. So again, the convention is to sort of put that in that first year, but I don't think anyone thinks it would go through that fast. Mm-hmm. But that said, I mean, we're talking, again, we're quibbling in my mind over a very small tax increase for most of these folks. And I think as you mentioned, the 28%, I think the other piece with that is the high income earners. So again, thinking about the wealthy here, he's raising those individual income taxes and then changing the taxation of capital gains and dividends to be ordinary rates for the extremely high income.
I mean, let's be very clear. I mean, I think that this is fair to classify this tax proposal as tax the rich, because you're seeing those for those high income groups go up considerably here. But I mean, as far as it compares to maybe some of either the fears being put out there from President Trump here and saying that he's going to be taxing everybody at higher rates versus what some even progressive Democrats wanted here and going farther to really increase taxes, whether it be the corporate side or individual rates. I mean, how would you rate it in terms of where he's landed on the spectrum of maybe what some more progressives like Elizabeth Warren may have wanted here?
Yeah, so I think it's much less than, say, Warren or Sanders. I think, if you think sort of back to Hillary Clinton's proposals and things like that, she had a more across the board spending increase. Here, tax increase. Here, Biden is more targeted. And I think, you say tax the rich. I think, Warren and Sanders proposed, which we did analysis of, sort of the wealth taxation. And here, I think Biden's getting at the same folks in a little bit more manageable way, and a little bit that the IRS can administer by increasing the income taxes and then the tax rate faced by capital gains and dividends, and then things like treatment of capital gains at death, things like that. I think it is exactly doing that. Doesn't go as far as, say, Warren or Sanders. I think in some respects goes a little bit further than Clinton, but I think overall, I think is a much less tax increase than say Clinton was proposing when she was running.
Yeah, very interesting things, though, to see how all this will shake out here as the new tax proposal moves forward. But Rich Prizanzano, Penn Wharton Budget Model Director of Policy Analysis, thanks for bringing us the latest findings there.
Thank you.
All right, we're going to take another break here on the ticker. But when we return, digging into one of those sectors, as we've been highlighting, hard hit in the pandemic, a REIT tied to college campuses with properties on nearly 100 college campuses, including the University of Washington, Oregon, ASU, and many others around the U.S. We'll chat with the CEO over there at American Campus Communities to see how they are navigating the pandemic and what they're seeing on campus through all of the uncertainty. We'll chat that right after the break. Stay with us. Welcome back to live market coverage here on the ticker. The NASDAQ giving up a bit of those gains here in the afternoon trade, coming off its weakest week since March, now trading higher by about 1.4%. We'll continue to track that. On the S&P, though, when we look at the sectors seeing the largest strength today, it is, again, those tech standouts here to note that sector, as well as real estate, the two strongest standouts today, as consumer staples, communication services, and discretionary pretty much round out the bottom performers. But again, we'll see what happens in the afternoon trade. Meantime, a focus on college campuses here, as we've been highlighting. A few universities have moved back from plans to bring students back. We saw that play out at UNC a couple weeks ago. But one of these companies that is tied to that space is one that we have not highlighted on the show before. That would be American Campus Communities, a REIT founded in 1993 based in Austin, Texas, the largest owner, manager, and developer of high-quality student housing buildings here in the U.S., I should say. And shares are about 20% lower so far on the year. They just gave investors an update about the lease, or I guess I should say rentals there on these properties as of the latest clip, down by about 7% versus what they saw last year at this time. So for more on what these buildings are seeing, occupancy rates on campus, a lot here to deal with in the pandemic. Here to chat all that is the CEO of American Campus Communities, Bill Bayless, joins us now. And Bill, good to be chatting with you. I guess first we'll start on that decline. I mean, it seems pretty large, but how do you put that in historical context here when you think about that drop in students being in it?
And we're actually very pleased with where we are today as the universities have commenced the new academic year. Last year at this time, we were at 97.4% in terms of occupancy. And this year, we are currently at just over 90%. So about a 7% decrease, which overall is really not bad. When you dissect that number further, with sophomores and upperclassmen, our occupancies are really at about 92%, only about a 5% diminishment. And where we saw a little bit of apprehension this year is among first-year students that have graduated from high school among this COVID pandemic. They're leaving home for the first time. And there we see first-year residence hall products down to about 80% occupancy. That's a very small portion of our portfolio, though, only about 10% of our beds. And so overall, we're very pleased. And the students demonstrated that regardless of university curriculum delivery, whether it's in-person, online, or realistically what most schools are doing, are toggling back and forth, that they want to be in the college towns, in the university environment as they pursue higher learning.
Yeah, and when we think about that recovery, obviously it's kind of hard to predict where things go from here. To your point there, when you think about first-year students coming in, we saw a lot of students, including at some big-name colleges, Harvard, seeing quite a few defer their time on campus here. So when you project out how long that trend might last, how important is that for you guys, and how do you see it continuing here past 2020?
Well, it actually, the one thing that we've seen from our university partners, and we predominantly serve large public four-year land-grant institutions, is that they're reporting that first-year student enrollment is not down, and it's holding relatively steady. And so the good news is while about 1 in 5 students said maybe I'll go ahead and stay at home for the first semester while I'm taking classes online, they still enrolled at the colleges and university. And so many universities are managing the pandemic to see many of these students may still come back for the spring semester and certainly by the fall of 2020. And so we're very pleased that in the enrollment numbers that we're hearing early on from college and universities, it doesn't look like any long-term diminishment in demand for higher education. And in fact, some universities, our partners at Arizona State University are saying they're seeing some of the highest overall enrollment numbers for the fall of this year.
Yeah, and I mean, I guess I would assume there'd be no one more attuned to this than you in terms of where colleges are going and how students are thinking about all this. But I imagine graduation is also pretty busy when you think about the influx of people coming in, maybe not to live there, but your parents coming back to campus, that being a big driver. I don't know who wants to go to college if you're not going to be able to step across that stage there and get your diploma. But when you think about that coming up in 2020, how do you see it playing out? Because I think a lot of people were caught flat-footed by the idea of this fall still seeing a shift to virtual classes. And when you look out to graduation in the spring of next year, are you projecting that those are going to be virtual as well? What do you see playing out?
In the universities, the one thing that they have done, when this hit in March, none of us were prepared for a pandemic of this type. Universities and colleges certainly hadn't contemplated operating in this environment. And the institutions have done just a fantastic job in creating flexibility. And that throughout this entire academic year, they're prepared to be able to have whatever in-person classes they can, to immediately toggle into online where they need to. You've seen that as there have been some spikes in college and universities. They said, okay, we're going to go online for the next 2 to 4 weeks, and then they'll reassess and be able to do it. And so as we look out as far as May, I think it's very difficult to say exactly where we may be at that point in time, but the universities have done a phenomenal job in being able to have the flexibility to go back and forth. And where we've been less impacted than I think we ever thought that was going to be the case early on in the pandemic is that, modern student housing is households of 2 to 4 students living in apartments. And so it's just like any other household, apartment or household. They're able to isolate, they're able to quarantine as necessary. And so it's been normalcy for them in regards to their living conditions. And where the actual commencement ceremonies end up, I think we'll have to wait and see as to whether it's a Zoom commencement ceremony or they're going to be able to actually walk across that stage with a mask and social distancing.
I think everybody's hoping for that. It'll be interesting to see if that happens again, what it might do, as you're saying, to the overall trends of people coming in back on campus. But for the time being, Bill Bayless, American Campus Community CEO, appreciate you bringing us that update. Be well.
Thank you. Be well also.
All right, we're going to take another break here on the ticker, but when we return, an interesting new startup that is bridging the gap between employees that cannot participate in employee stock purchase programs, how they are providing loans to help bridge that gap. We'll discuss that with the founder right after this. Welcome back to the ticker. On today's Startup Spotlight, I want to focus in on a very interesting new idea that's looking to close the gap when it comes to employees who are unable to take part in employee stock purchase programs out there. Sometimes, and I was in this boat too, sometimes you don't want to see your paycheck get diminished by all that much to buy shares, but often at a discount, and it could actually lead to some pretty interesting wealth opportunities here when we think about putting your money into those programs. So here to discuss how Carver Edison, a new startup, is trying to help employees take advantage of those programs is the founder of the startup, Aaron Shapiro, joins us now. And Aaron, I guess first we should just start by explaining how you guys actually make this happen, because, I was just out of college. I was working at another company, and this was an option for me, but sometimes it's hard to actually make ends meet if you do put that money into these programs. So how are you guys helping?
Yeah, absolutely. Thanks for having me on, Zach. Our core product, cashless participation, makes it possible for employees of public companies, not just in the U.S., but around the world, to maximize their contribution to their company's stock plan without actually having more money come out of their paycheck. So much like a regular employee stock purchase plan works today, when you sign up, you elect how much money you want to have taken out of your paycheck. That money comes out of your paycheck every 2 weeks for usually about 6 months. And then right at the end of that 6-month period, before the stock is actually purchased, we work with the company to make it possible for employees to maximize the number of shares purchased without really having that money come out of their paycheck. So pretty powerful technology, and we've seen some amazing results so far, especially at the height of COVID-19.
Yeah. So how does, I mean, in terms of applying, the practice here, does it work as kind of a bridge loan? You provide the upfront capital for them to make it work, and then at the end they pay back what is owed and get to keep the upside. I mean, how does it work structurally?
Yeah, structurally, what happens is we're actually sending the company itself the difference between whatever employees can afford to contribute and whatever the maximum allowable is under the plan. And from there, what the company does is they take the employee contributions, combine it with the cashless participation amount, and we get sent just enough shares to repay the amount that we sent to the company. So the net effect for the average employee is, without paying anything extra, when they log into their brokerage account, they're going to see between, on average, 50 to 150% more stock than they could ever own. And we're certainly getting our money back and making a little bit of money along the way.
Yeah, what's interesting too, though, is that, this, I don't know if anyone cares that this happened to me where I couldn't take part in the employee stock purchase program, but this is something that your own mother went through and kind of the impetus of the idea too. I guess, it's one thing to say, all right, maybe you can't participate because, you want to keep a little bit more of your paycheck. But I feel like the other aspect of this too is how little employees might know about the opportunity here to actually take advantage of these programs. So what have you seen on that front, and how difficult has it been maybe working with employers to get them on board with something like this that might also take a little bit more explaining?
That's exactly right. There are two parts of the equation. It's the cost side and it's the education side. And we actually just released a first of its kind education platform called Carbon, which makes it possible for companies to build, schedule, and launch equity education campaigns in over 30 countries across 10 languages to their employees, to do exactly that, to help people understand what their stock plan is and really how it works on a global scale.
And when you think about the savings too, I mean, in your mom's case, it seemed like quite a bit when you think about how these stocks operate and the ability to get shares at a discount, which should never really be overlooked. But I mean, what are some of the, I guess, success stories that you have seen from people adopting the program so far?
Yeah, so it's a great question. In my mom's case, over the course of 15 years, it cost her over $1 million. And in a case study we just released with E-Trade, who's been an incredible partner for us, Scott Wally and the corporate services team there has really been remarkable, bring cashless participation to the market with us. But as we look at the results, we were able to turn for employees of one NASDAQ company about $3,700 into $13,000 in profit in a 6-month period, especially as you think about wage growth across this country. For the most part being flat, what we were able to do is deliver in 6 months the equivalent of a 7% raise to employees of this company. And just if I could, to give you a sense of sort of the power of employee stock purchase plans and the returns, there's a great industry study that came out that took a look at the average return on investment for purchases happening in April of this year at the height of some of the market volatility from COVID-19. And the average return from those purchases was about 40%. If you go back to 2019, it was 31%, 2018, 26%. The only place you see consistent returns like that generally is coming from Renaissance Technologies and some of their funds. And the real power of this is, especially in volatile markets, the powerful results that rank and file employees of publicly traded companies around the world can realize from their company's employee stock purchase plan.
No, it's very true. And I was one of them. As I said, it's not always easy to kind of see that paycheck shrink a little bit, but the upside opportunity, not one to be overlooked. A very interesting idea, though. So just one that we wanted to highlight on the show. But Aaron Shapiro, Carver Edison founder, appreciate you taking the time to discuss it.
Thanks for having me.
We're going to take another break here on the ticker, but when we return, digging into that FOMC event coming up here in just a couple days, what you should be thinking about before Fed Chair Jerome Powell steps to the mic. We'll chat that after the break. Welcome back to the ticker ahead of Wednesday's FOMC meeting here with Fed Chair Jerome Powell stepping to the mic. I want to dig into what investors should be expecting, especially after they came out with that new big stance on inflation targeting. Here to discuss that with us is Yahoo Finance's Fed reporter Brian Chung. And Brian, I mean, what do you think might be the most important thing to come from Wednesday's meeting?
Well, the most important thing really won't be whatever Jay Powell says to the mic, but more importantly, what's going to be in that dot plot projection. Keep in mind that the Federal Reserve has what they call the summary of economic projections. They release these every other meeting, so we didn't get it in the July FOMC meeting. We will get it in the September FOMC, where they'll provide some projections for where interest rates might be in the next few years. Keep in mind that as of the last projection that we got in June, the Federal Reserve essentially telegraphed no rate hikes through the end of 2022. But there were 2 of 17 members that said there could be some rate hikes before that point in time. With the change, though, with the Fed's thinking as announced at that Jackson Hole conference 2 weeks ago, it's possible that now all 17 members of the FOMC could be projecting no rate hikes through 2022. But that's definitely worth watching as we head into that meeting. We'll have the full coverage of that right here on Yahoo Finance press conference at 2:30 on Wednesday.
Yeah, the other big question here, aside from how this pandemic goes, which of course is where Jerome Powell always shifts the discussion, but outside of that, the other question is how the consumer is holding up, and that was kind of the focus of a new New York Fed survey looking into, I guess, consumer expectations on the employment front. What did you see there in terms of how they're gauging this recovery?
Well, the New York Fed this morning released a survey of consumer expectations where they had a number of labor market anecdotes where, more importantly, they suggested that actually people are becoming a little bit more concerned about losing their job. The percentage, or rather the mean perceived probability of people losing their jobs actually increased to 18% in the month of August. That's an increase from 16% in July. That reverses some of the downward trend that we had seen in the later part of the summer, people becoming originally more optimistic that they would be able to hold on to their jobs, and now getting increasingly worried that that won't be the case over the next 12 months. So this is definitely something worth watching. The New York Fed saying this was particularly more pronounced among those that have income of below $50,000 per year per household, in addition to those without a college degree, which shows that, yes, the economic recovery is happening, but it's not even across the spectrum. And it's also possibly getting even a little bit more slow, something the Federal Reserve is going to have to pay attention to as they head into that decision this week.
Yeah, a lot to come from that. As you said, the dot plot, the thing to watch, but also we'll see how they assess the ongoing recovery here. And again, you know, inflation's sexy again. So we'll see what they have to say on that front as we continue to get new data on that front. But Yahoo Finance's Brian Chung, appreciate you bringing us that here. That'll do it for us here on the 1 p.m. hour, but we're going to continue our market coverage here on the other side as the NASDAQ maintains its gains up by about 1.75% after its roughest week since March. We'll chat with a man who called this recovery earlier back in March. Fundstrat's Tom Lee joins us right after the break. Stay with us. Welcome back to the ticker. I want to highlight the market action we're seeing right now after the tough week. The NASDAQ suffering its worst week since March last week and bouncing back with some big gains in the tech space here to send the NASDAQ up more than 1.5%, bouncing off what looked like it could be the rally was losing some steam, but back up above 1.5%, the gains today. A few of those moves being sparked by some individual news and announcements here to highlight. Mainly want to highlight the spike that we're seeing in DraftKings stock right now, spiking to session highs after the company announced a co-exclusive pact with ESPN to become one of those providers of their fantasy sports coverage here. And ESPN also saying they're going to link across to send their sports fans over to DraftKings products and services. Shares there up more than 13% on the news. Caesar is also announcing a similar deal there in terms of interacting with ESPN. So that a big afternoon mover to highlight here. Also want to highlight the big deal that we've been covering in the social media space as TikTok, at least ByteDance's US division there in TikTok, looks to shift things over to a tech partner, Oracle, beating out Microsoft in the bidding for that business. Shares popping about 5% today after that news broke. Secretary of the Treasury, Stephen Mnuchin, highlighting that the new entity would be called TikTok Global and create about 20,000 jobs, he says, here in the U.S. in a deal that will require both approval from President Trump as well as the Committee on Foreign Investment in the U.S., or CFIUS, expected to make that decision along with President Trump in the coming days. Also worth noting, of course, that Microsoft did not have one key element that Oracle did in terms of a relationship there. Co-founder Larry Ellison, who hosted a few fundraisers earlier in the year at his house for President Trump. Also, its new CEO, Safra Catz, was part of that transition team in the Trump administration back in 2016. But overall, the big trend today is a strength in the tech space. It's something we've been talking about as a rotation back into cyclicals have been discussed here over the last couple of weeks, especially after that meltdown we saw last week. But where do things go from here? Is today just a head fake from some of these tech names, or is it a reversal of that trend? And I want to get into that with our next market guest here. It'll be FundStrat's Tom Lee joins us right now. And Tom, I always love having you on because you kind of called that bottom that we saw back in March. But how do you assess what's going on here now with tech again, coming off of that brutal week last week?
Yeah, and last week was rough. I think markets are at a crossroads because we've gained so much since March, and the economic data has been better. I think the health data has been encouraging because cases are falling. But from a market's perspective, nothing is really decisive. So I think investors are still torn, and I think that's why they're still sticking with these tech stocks. But I don't think tech needs to roll over for cyclicals to work. I think for cyclicals to work, it really just means investors need to be confident that the good news on the economy is continuing, and then the cash comes off the sidelines, and the sentiment, which is really bearish, turns positive. And I think that's what fuels the rally into year end.
And that's kind of the thing that you've been highlighting here too. I mean, a lot of market watchers have been highlighting that, the market moves that we saw earlier in this year had generally gone in the direction of coronavirus cases. And we've seen that constantly improving over the last few weeks. I'd be curious to know maybe if some of that profit taking in tech might not have been caused by just, the run up that we've seen, but maybe some investors hedging against the potential risks of cases going in the opposite direction over the next couple months, since we've seen that precedent of it triggering a selling wave before. How much weight would you put on maybe that playing out here?
I think there's a lot of uncertainty because one of the models that I think is really quite good is the IHME model, healthdata.org, and they're projecting in the fall to have this massive resurgence in cases. Part of it's the flu season and part of it's back to school. I don't know the future, but if that's the path, then I'd agree, Zach. Like the market should be kind of nervous because we don't know how people are going to react. But if France and Spain are any template, they've had cases go to all-time highs, but because deaths have been really muted, the policymakers there haven't really done anything. So I think there's, I guess it depends. I mean, cases are cases, and that's important, but it's really going to be severity that matters the most.
Yeah, on that front, I mean, we did see Israel reinitiate lockdowns again. So that did happen. And there's precedent there that it could happen again here in the US. We've seen states reverse positions, certainly, too. But when we think about the risk reward, since that really does seem to get at the heart of where investors should be positioning themselves here now, I would suspect that cyclicals would take a harder hit if you do see cases rise again, because some of those epicenter stocks, as you call them, the hardest hit when cases did start to spike here before in 2020, you've been advocating for getting back into those. But if we did see cases rise up again, I feel like they would get hit even harder. So talk to me about the risk reward in those names versus some of the other tech names out there.
Well, yeah, the most sensitive to like what happens to not only the economy, but health is going to be the epicenter stocks, because they're so sensitive to directions. And also, they're also sensitive to a cure or a vaccine. I think what we've already seen that states that have had a lot of cases already, like New York, tri-state, or even Florida now and Arizona, even when you get like super spreader events like back to school happening, it's not triggering a new wave of cases. So I think that 75% of the country, it's not looking so bad right now. And I think the key now to watch is, whether the schools can stay open and then back to work, especially New York, because New York is so important to sort of how the national, landscape looks. And New York is opening for indoor dining. And I think there's more people going back to work. So, normalcy might be sooner than we expect.
The other question too here, and I want to get into some specific names when we think about individual storylines playing out too, because obviously people getting back to work might be a positive for some tech companies, a Microsoft or a Facebook, what have you, versus a Zoom and the run-up that we've seen there. But also there seem to be storylines that are playing out completely untied to what happens on the health front. And I guess maybe some of those storylines would be tied back to some of these high flyers in 2020, whether you look at I guess we'll start with the sports gaming space too here, because we're seeing those spikes play out today when DraftKings teamed up with ESPN to be their co-exclusive partner, and ESPN is going to be throwing a lot of traffic to DraftKings. I mean, I guess that's tied to the pandemic too, though. Every storyline's tied to the pandemic because we got sports back now, and we saw it over this weekend. But that does seem to be one of those opportunities that's going to exist for years to come, since it seems like that was something sports leagues, cable providers did not want to touch in sports gaming. But now, as those attitudes change, I mean, talk to me about maybe that being an attractive or unattractive thing for investors to watch.
Well, I think what we're seeing with like DraftKings really speaks to a generation, the millennials and even Gen Z, because those are native digital cohorts, right? I mean, they grew up with a digital life. And now in this pandemic, we're seeing that sort of notion of living digitally kind of mainstream. And you're right, it's a huge deal. Like when the either networks or cable sort of get on board with that. And I think that really tells you why you got to bet with millennials and what they're going to do. And not only are they living a digital life, they're moving to the suburbs now. So housing and housing related is going to be a really important story for many years. And actually it's still investable today. And then all the infrastructure that goes around building a home. So there's a lot of things millennials do that are, that you're seeing. And I think DraftKings is an example.
The other name out there too, I guess on the same theme here, would be the EV space. And we've seen that with Tesla. I can't tell you how many millennials I know out there that can afford one have been all about getting an electric car, and Tesla, the main proponent of that's discussed here. And they've recovered about half those losses that we saw in the tech sell-off since the end of August here. So I guess, that being another one of those names, what do you think about when you look at a Tesla and maybe the same idea that it would be something to stick with here, especially when we think about the price that it's trading at now, north of 405?
Yeah. I mean, Tesla, I think, has completely turned the head of auto business model around. I mean, I think it is a lot more like Apple with its iPhone and how it really disrupted the handset carrier ecosystem, in wireless. And I think Tesla is a car that, has fanatical loyalty from its owners, and its interface is so different, and it's electric. And, I think people are going to make a mistake trying to put it into a box as a low multiple automaker. But, I don't know what the upside is. Cost of capital is low right now. So valuation can be quite elevated for a lot of things.
And that seems to be the thought across the board, perhaps. Some of that playing out last week. We'll see what happens this week, though. Things kicking off in the green as the NASDAQ still holds its gains. But Tom Lee, Fundstrat Global Advisors Managing Partner and Head of Research, always appreciate chatting with you.
Yeah, thanks for having me.
All right, we're going to shift gears back over to that pandemic front here because an interesting dynamic playing out here in Florida. As we noted, things have been improving in some of these hotbed states, whether it's Florida, Arizona, or some of the others we've been discussing. But for the second time, Florida is going to be moving forward with opening bars and breweries here at about 50% capacity, which is causing some alarm in the medical community because of what could happen after we saw cases spike the last time they did that. So here to discuss that and much more on the coronavirus front is Dr. Adrian Burrows, family medicine physician and CFP Physicians Group CEO. And Dr. Burrows, you're based out there in Florida, so talk to me about this decision and why we shouldn't be expecting the same thing this time around.
Well, no, I'm not sure that I agree that we shouldn't be expecting the same thing. In my opinion is that we probably will see the exact same thing. You know, you have these bars and breweries opening back up, 50% capacity. And like I tell people, it's common sense. Drunk people don't social distance, you know, and so, you know, I expect that you'll start seeing a rise in cases here as this progresses.
I think drunk people don't social distance will be the headline that we run with here. But when we think about maybe I'll push back a little bit because we have seen the positivity rate fall, right? That seems to be something that people look at. It's improved in Florida. It's down at about 12% for the state. Granted, that's still a far cry from New York City's under 1% that we've seen here. And even us, we don't have indoor dining coming back till the end of the month, and that's going to be at 25% capacity. So maybe talk to me about how this is a sliding scale and maybe why that might be, outside of anything else, why this decision's moving forward.
Well, I think that you're right. We definitely have seen less cases than we've seen, certainly not as low as we'd like them to be. I think that what we have done in Florida is that once we start seeing some positive momentum, we undo it all by rolling back into things too quickly. You know, I don't have an objection to these things reopening. I just think that we should be taking baby steps and gradually increasing that as time goes forward. And that's not what we've tended to do.
Yeah, and this time around, I mean, when we talk about the rise, obviously on a state-by-state basis, it makes sense for us to track and we can kind of monitor hotspots here. But when you back up and look at the overall case count, the WHO reporting that yesterday saw 307,930 cases here, 307,930 new COVID cases. That would be the most in the single day that we've seen since the previous high set earlier in the month. But clearly, it kind of speaks to the idea that this is not a problem that has gone away, even if things are improving. We saw Israel announce that it would be locking down again. So just to push the point a little bit further here, how bad do you think things might get in Florida versus the last time you saw the state lock down? Because we have seen pushback on the political front, seeing that that's not a direction some of these governors, politicians want to go.
Well, yeah, I think that one of the things that I'm waiting to see what happens next week. So we just had another major holiday. Labor Day just passed. So I think you'll start seeing cases probably start to rise again come next week. And I think that the thing that we have this time, when we've seen spikes before at Memorial Day and at the 4th of July, what's different this time is that now schools are open. And now nursing homes in this state are now starting to have visitors. And I think that that's what's most concerning to me is that we have had major holidays, lack of social distancing. Now we have schools open and nursing homes open to visitors. And that's where my concern comes from.
Yeah, all of those things happening at once could be something to watch. And of course, it takes a time. There's a bit of a delay in terms of policy changes and the cases showing up. So there is a bit of a lag time that we're going to have to bear with here. But outside of that, I mean, there are still concerns that we've seen not really change from the beginning of this pandemic, whether it be PPE issues or pricing issues and some of these things. I know that's something that you've taken issue with in terms of the medical community here, dealing with some of those things. Have you seen things, I guess, improve at all since where we were back in March?
So this is where we are. We still have issues where people are having issues acquiring personal protective equipment. A box of gloves prior to the pandemic cost $4 to $5 a box. Now they're up to $27. A box of N95 masks, a box of 20 would cost like $20 to $25. Now it's $125. Anyone who's trying to find Lysol or Clorox wipes understands, the dilemma of trying to even find them. And then once you find them, they've been marked up 2 to 3 times.
just in your local grocery stores. And I think that's disgusting. I think that there definitely needs to be some type of political intervention here to make it easier for us as healthcare providers to deliver care in a cost-efficient manner.
You talk about political intervention. That's one thing that we've been stressing here, and the idea of some of these warnings and guidelines coming out of either the CDC or the FDA. We've seen that policy position maybe shift a little bit as the CDC announced a new report looking at maybe the risks of transmission from children going to school and going back into the household in a new CDC report highlighting about 25% spread there in some children going back into the home, warning about that being an issue that may have not been stressed completely from the Trump administration earlier on. What's your take on maybe how that might give pause to, I guess, the school aspect of all of this reopening right now in Florida and beyond?
Oh, absolutely. I've always been a proponent of being conservative when it comes to your health. And so at the beginning, when the pandemic first started, there was a lot of reports that said that kids couldn't transmit it or that they were low risk of transmission. Then, of course, schools started back and we started seeing all these outbreaks in schools. This is a risk for the students, it's a risk for the parents of the students, and it's a risk for the teachers. And I think that anyone who calls themselves a coronavirus expert is a liar. No one's a coronavirus expert. This is something that we don't know, and day to day it changes. So because we don't know a lot about the virus, we need to be as conservative as possible. And I have grave concerns going forward.
Yeah, and I guess we'll update the headline there in terms of drunk people don't social distance, and children might also be a little bit difficult to get social distancing as well. For the time being, we'll leave it there. We'll see how these cases play out. Again, we're both on the same page and hoping that we don't see the same uptick, but a lot of concerns as bars resume business. Dr. Adrian Burrows, always appreciate the chat.
Thank you so much.
All right, we're going to take another break here on the ticker, but when we return, highlighting the dangers out there on the West Coast as firefighters continue to battle the wildfires there. President Trump slated to make a speech from the scenes there. We'll highlight some of the issues playing out in the economy with the executive director of the Sonoma County Farm Bureau right after this. Stay with us. Welcome back to live market coverage here on the ticker. As we've been highlighting here, the rally remains intact after the rough week of last week. The NASDAQ suffering its worst week since March. Today, a very different start to this week as the NASDAQ advances more than 1.8% at the time, being the Dow up by about 1.3%. And tech stocks, again, the big standout there. But real estate, the strongest sector, all 11 on the S&P 500 are in the green right now, but we'll bring you highlights and updates as we get them. Meantime, want to focus on the dangers out now in the West Coast. We've been highlighting the fires spreading there. Overall, firefighters continue to battle what we've seen play out in California. And of course, all of this comes after we've seen the scenes, unfortunately, last year, as well as dealing with the pandemic again today. And now this fire that is truly shocking when you think about the economic impacts of all of this hitting at once. And here to discuss that with us as communities over there continue to grapple with this is Tani Tasconi, Executive Director of the Sonoma County Farm Bureau, as well as Yahoo Finance's Sabeel Marcellus. And Tani, I mean, when you think about the scale of this right now, it's hard to overstate. You got more than 16,700 firefighters struggling with nearly 30 wildfires across the state, according to CAL FIRE. I mean, put this into context for me in terms of how these businesses are struggling to keep things afloat, one thing after another.
Well, I'll tell you, Zach, it is just unfortunate that in so many ways, Sonoma County is probably more prepared than any other county in California right now to deal with wildfires and the aftermath of wildfires, which is it's kind of a bad rap to have in a lot of ways because, it's just from our years and years of experience over the last, 3 years of having to deal with some massive wildfires. So, we're working very hard in our ag industry. We're trying to support our farmers as much as we can with information. But, Sonoma County actually has about 40 different crops represented on our crop report. So we are dealing right now, there's a lot of conversation around our wine grape industry because it's harvest, but also have those same kind of situations playing out in vegetable crops, our logging industry, and then also, our cattle industry as well has been hit really, really hard. So spending, a lot of time trying to help people, whether they've had to move cattle off of pastures and things like that, getting them feed. Our wine grape industry, I'm sure you've heard, the concern about smoke taint and how we're dealing with that. And I'll tell you, our grape industry is getting really hit hard. And it was unfortunate because we were all somewhat excited because the grape harvest actually started about 12 days earlier than normal.
Yeah.
And we all thought we were going to be out of the wildfire season, right? Because our wildfires have tended to be late September, October. So I think everybody was, it's unfortunate you're excited because hopefully you're going to avoid the wildfires, but that wasn't the case. Most of our champagne grapes and our sparkling grapes and our white wine grapes, most of them got harvested, but it's hitting our red grape industry really hard. And it's a tough situation because there's potential for smoke taint.
Yeah.
And it's a weird kind of relationship because, not all the vineyards are owned by specific wineries, right? So you've got two different very important parts of the wine market working together. You've got the grape grower who grows the grapes and you've got the winery who processes the grapes. So the grape grower has what's called crop insurance. And so they can take a chance and not pick their grapes and hope the insurance works, but they have to prove smoke taint, or they pick the grapes and take a chance that the winery is going to reject it.
Yeah, I'll admit, I didn't even know smoke taint was a thing. I'm not sure if you did either, Sabeel, but there's a lot more.
No, I definitely didn't. But I want to talk about the greater impact of the wildfires for Americans that may not even realize they're impacted in terms of farmers, in terms of cattle. So I'm talking about grocery prices, for example, for food, milk, fruit. You were talking about wine. How is that going to be impacted? Are we going to see the price of all these items go up?
You definitely, from a standpoint of Sonoma County, only one of our dairies was actually in the area this year that was hit by wildfires, but statewide, from a standpoint of milk, you will see some disruption overall. Not necessarily that a lot of the dairies had to shut down. You cannot stop milking cows, you just can't. So, but a standpoint of all those other parts of the sectors, the processing facilities and things like that, that may have had interruptions because of evacuations and everything. We also are dealing with power shutoff programs here too in California. And then also, the whole transportation of products and everything like that. From a standpoint of food crops, there is a lot of concern around ash and the ash that's fallen on the crops and the need to be more diligent as far as, washing crops and washing the food products and things like that at the farms and then also wherever they're getting processed or sold. So there is going to be an increase in costs of getting that food to the market. So there's an expected potential increase in food costs to the consumer as well. So I know that, hopefully this is the last of the fires, but I think that if we see any additional fires hit us pretty hard in California, that's only going to be exacerbated. And the concerns, I think. The other thing I'm hearing locally from our guys is that they may have gotten one harvest through with the crops, with the vegetable crops, and they were starting a second harvest. And now with the fires and actually with the air quality that we're dealing with right now, without a lot of sunshine, there really has been a defeated effort to try to kind of get a second harvest off this year.
Well, as we know today, President Trump is in Northern California. He's assessing the wildfire damage. What impact do you think these wildfires are going to have in terms of support for President Trump among farmers, which has tended to be very strong?
I think we're hopeful. Obviously, sometimes the president doesn't necessarily say things correctly about the whole raking the forest, but I hope the underlying comment on that is really about that we need more forest management. We need more grazing in all of the Western states. And grazing doesn't come easy. I know a lot of people believe that to be true. It's like, why don't you just throw some animals out there and, goats, sheep, cattle, whatever. But, our other challenge, and it's all related to climate change, is that we don't have a lot of water sources. And so being able to graze public and private forest lands or just range lands, the water element is the most important thing. So if there's going to be some opportunity for federal government to step in and help us do a diverse kind of platform of forest management, I'm hoping his visit here is just kind of the kickoff for that.
Yeah, hopefully. I mean, we still see a lot of that coming from the PG&E settlement here, questions about what to do with that 150 million. I know that that's top of mind for a lot of people out there, but for the time being, we'll leave it there. I appreciate the discussion there. Tony Tosconi, Executive Director of the Sonoma County Farm Bureau, as well as Yahoo Finance's Sabile Marcellus. Thanks to you both. We're going to take another break here on the ticker, but when we return, Nikola, the EV truck maker, hitting back against what it says are false claims against the company. We'll have the updates, the statement coming from that company as shares still continue to rebound after they put that out. Stay with us. We'll be right back. Back to the ticker on the afternoon trade, we are seeing shares in electric truck maker Nikola rebound after it was hit with a big sell-off after a short seller published a research report claiming that the company was not living up to what it was telling investors. Today, the company releasing a statement hitting back against a lot of those things that it calls false claims in a detailed report here. And for more on that, as we see shares continue to move past the 10% gain in the afternoon trade, I want to bring on Yahoo Finance's Emily McCormick, who has the details. Emily?
Good afternoon, Zach. And we are seeing Nikola this morning issuing a more comprehensive rebuttal of Hindenburg's short seller report from last Thursday. It said in a statement today, quote, "These allegations by the short seller are false and misleading and designed to manipulate the market to profit from a manufactured decline in Nikola's stock price." Now, Hindenburg, of course, does stand to gain from a drop in Nikola shares because of its short position. And just taking a look here at this statement that Nikola put out today, I do want to highlight that while it is much lengthier than the relatively brief response it issued immediately last week, it doesn't necessarily refute every point that Hindenburg made in its short report. And that's something that the founders of Hindenburg actually pointed out in a statement to media as well. So to run through a couple examples here of Hindenburg's claims and Nikola's response today, for one thing, Nikola disputed Hindenburg's allegation that it wasn't being truthful about making its own inverters. And those are a key component for electric vehicles. So Nikola said in its statement that it has been, quote, "designing, engineering, and working on its own inverters for quite some time. The company does use third-party parts in prototype vehicles, some of which may be subsequently swapped out for its own parts in production." Now, to look back at what Hindenburg had said, that had alleged that Nikola's inverters were not proprietary to the company and had instead been using another company's components and then covering the label on that component to conceal the fact that they'd been outsourced. So Nikola shifting the narrative here a bit in that statement this morning. And then also want to point out another thing that Hindenburg had said that's been capturing a lot of headlines, and that's Nikola's 2018 promotional video that portrayed a Nikola 1 prototype as functional when instead it had just been pushed up a hill and filmed rolling down that hill at an angle that made it appear like the truck was driving on level ground. That's something that Nikola claimed had never stated, that its truck was driving under its own propulsion, although the truck was designed to do just that. So a bit of a discrepancy there between Hindenburg's report and Nikola's portrayal about what the truck was intended to do and how it was portrayed. Now, as you mentioned, we are seeing Nikola shares up about 10% in intraday trading. It's making up some of the losses that it saw over the past 3 sessions following Hindenburg's report. This is going to be a continuing story here, likely to see some volatility as investors continue to digest these reports and Nikola's rebuttals. Zach?
Yeah, no, just insane moves to highlight there too. When you think about the 50%, almost 50% advance after that multi-billion-dollar investment from GM, it gave all that back following the Hindenburg report, and now trading out flat since before that deal was announced. So interesting to track those moves. For her part, GM's Mary Barra did say we should note that the company GM did its appropriate diligence before it signed that Nikola deal here. So further giving support to what we're hearing from Trevor Milton being true. We'll continue to see how that plays out. But Emily McCormick, appreciate you bringing us that. Meantime, also in the tech space, want to highlight a big deal in the semiconductor space. Chipmaker NVIDIA agreed to buy ARM Holdings, a maker of chips for mobile phones. SoftBank used to own them in a deal worth $40 billion. It's big news. I want to bring on Yahoo Finance's Dan Howley for more on what this means for the chip space. And Dan, it's a pretty good return for SoftBank.
Yeah, it really is. You know, if you look at the way the chip space is now shaping up, it seems as though NVIDIA is going to be an increasingly more dominant presence there. Right now, obviously, Intel is still the main player, despite the fact that they've been dinged for not really innovating as far as their chip design goes, and then reports that they were going to outsource their foundries. That's something that NVIDIA already does, and rival AMD already does. With ARM, basically what NVIDIA would be getting is the company that designs chips in low-power devices, including smartphones. That's absolutely massive because a lot of those chips are then starting to work their way into PCs. We're seeing what are called always-on PCs from Windows or powered by Windows. And of course, Apple has announced that it's going to move away from Intel entirely for its own devices and lean on its own chips for computing based on ARM's design. So NVIDIA is going to get its hands in all of these different places. And then on top of that, NVIDIA will be able to use ARM to basically license out its own product design. So they're going to win both ways on this. And then in the data center space, where NVIDIA is increasingly seeing its revenue from, ARM will be a presence there as well. In fact, it was just this past quarter that NVIDIA's data center division out-earned its video game division, where it usually made its chops. So obviously, this is going to be a big move for NVIDIA going forward, and a bigger move for the chip space overall.
Yeah, no, I mean, with the wind at its back here as Apple shifts its plans on the chip space as well, obviously that's a big customer when we think about what ARM has ahead of it. And just to go back, SoftBank acquiring ARM back in 2016, $31.4 billion, and now this deal valued at $40 billion. Not bad for Moss's son, but Dan Howley, appreciate you bringing us that. We're going to take another break here on the ticker, but when we return, highlighting that 1.75%, we got 1.75% in the afternoon trade to the upside here on the NASDAQ. We'll dig into whether or not that means we're out of the woods officially. All the market moves coming your way right after this. Welcome back to the ticker. Today's week getting started on a very positive note here as the NASDAQ maintains its gains up more than 1.5% after suffering its worst week since March last week. And our next guest says that deals being made right now in mergers and acquisitions, we just talked about NVIDIA and ARM Holdings. He says that uptick in activity is proving that sentiment is turning a corner. So here to discuss that theory with us is Ryan Dietrich, LPL Financial Senior Market Strategist. And Ryan, I mean, we're up more than 1.5% here today. So talk to me about why you connect those dots and say, look, we might be moving higher here.
Yeah, Zach, I mean, we had this record run, right? We know that. But a whole way while the economy was recovering, there weren't a lot of big deals. And what's that tell us? Well, you rarely see big deals when you're in a recession. You rarely see big deals when there's issues with the credit markets and with the bond markets. But now all of a sudden, we're starting to see that. And I get it. Everyone says, oh, my goodness. But in 1999, 2000, there were a lot of big deals also. But we're not seeing quite the same thing. I mean, you mentioned the chip one, but look at biotech, right? The deal Gilead did. I mean, look at biotech stocks today. There are some really still some good valuations there with biotech and chips doing well. And then the whole, Oracle and TikTok deal, it's kind of one less, I guess you call it headache for the market. What's going to happen with TikTok? Is it going to go away? With a 12-year-old daughter, I can tell you, I don't want that to go away. It's kind of a built-in babysitter, So, I mean, you think about it, some of those things that we view it, yes, market's really stretched. We can talk about that. Bigger picture, my goodness, 6 to 12 months from now, we think these are really positive steps.
Yeah, I mean, there's a lot of people benefiting from that TikTok news. We would highlight Fastly's shares too, a company that we talked about before, kind of being levered. A lot of their revenue comes from TikTok. If the U.S. business shut down, that obviously wasn't going to be a good thing. But shares enjoying about an 8% boost here in Monday's trade. But beyond that, I mean, I guess we also got positive news on the vaccine front, which really benefits sectors, whether it is tech or not. But we saw the AstraZeneca trials with University of Oxford researchers resume. We got Pfizer's CEO coming out and saying that you could have a vaccine come out to those frontline workers by the end of the year, before the end of the year. So talk to me about how that might impact sectors differently here, if that is true, and we do see, I guess, things improve on the health front quicker rather than later.
Yeah, I mean, what's benefited, we know the large cap tech names, some of the healthcare names. But if you get the economy opening up, if you get the better news on the vaccine sooner than maybe we expect, that's going to help some of those cyclical value names, specifically materials, look really good to us, and industrials. We don't like financials as much. They're still lagging. Yields are still low. But if, you think about tech just can't always go up, right? We still like tech. But if that were to give the baton away, the materials, look at something like chemicals. I mean, chemicals are really looking good here. U.S. dollar still looks weak. A little bit weakish U.S. dollar tends to be a tailwind, if you will, for kind of large cap stocks and emerging markets. I mean, look at the data we're seeing out of China. I mean, the data, no one really trusts Chinese data. I get it. But what did Hyatt just say? They said people are staying at hotels as much in China now last month as they were back in September. I mean, there's a real global recovery taking place here. And if someone wanted to go into the cyclical value areas, we would suggest doing the materials and industrials, but sticking probably with a little bit of a growth overweight still with who brought us to the party, specifically technology and communications.
I'll push that point too a little bit further, because we have seen strength even with shakiness on the health front or what have you. We've seen strength in the housing sector. So when you dig into that material space and who else you're seeing there for strength, I mean, what are the specific names that you look at in industrials and materials that you enjoy right now?
Yeah, I can't talk about individual equities, but again, specifically, we like some of just the big ETFs when it comes like XLB, that's one of the big materials ETF. And you mentioned housing. I mean, housing, I guess, is more consumer discretionary, but nonetheless, it's amazing. This is the first recovery we've ever had, or I'm sorry, recession we've ever had, where the housing market didn't even slow down. So you got to think that along with copper. Copper is breaking out to a 2-year high. In our opinion, you see that strength out of copper, that's another sign the global economy is in fairly good shape in our view. And again, historically higher trending copper tends to pull the 10-year yield along with it. So we think the 10-year yield will probably play catch up the second half of this year, or even, I guess the fourth quarter of this year. It's not even the second half anymore, right? The fourth quarter of this year. And that again can suggest the global economy, or U.S. economy, is slowly continuing to improve here.
When you talk about risks too in the back half of 2020, because we haven't discussed those too much, obviously the election looming, uncertainty there for a lot of investors, I guess, depending on how you look at it. How do you see volatility? Maybe we saw it last week continuing here with that on the horizon, as well as, I guess, more question marks for how long this recovery, lockdowns potentially, if we have to go back to those. We're seeing that across the globe here, Israel just doing that too. So, I mean, talk to me about some of those risks that you're also digesting.
Yeah, I mean, we've got the same risks as everyone else. Like you said, if you have more waves coming out, if you get some bad news on the vaccine. But one of the risks, I think, is just the overall sentiment. I mean, we talked about sentiment improving from a market's point of view, but a lot of those small traders have done very, very well with those large cap tech names. I mean, there's a lot of optimism out there. And a funny thing about September and October during an election year, those tend to be weak months. Don't forget, October's the worst month of the year during an election year. So seasonality is not really doing anyone any favors. So maybe a little bit more of a pullback. I mean, the NASDAQ 100, 2 weeks ago, right about now, was 30% above its 200-day moving average. That's about as historically stretched as you're going to see. We know tech and big cap tech have come back, but again, under the surface, look at small caps. I mean, small caps all of a sudden are starting to outperform. There's a lot more small caps than large caps. So we're encouraged by some of this rotation that we're seeing. But overall, I think this overall sentiment being a little too frothy still is maybe one of the near-term concerns we have. But the economy is going to justify any pullbacks, and we're going to use it as an opportunity for a continuation of higher prices, at least out into the first half of 2021.
No, it's a very good point. I mean, I didn't highlight the Russell here, but technically outpacing the NASDAQ too, up 2.5% to the NASDAQ's 1.6 gain for the time being. But we'll have to leave that there. Ryan Dietrich, LPL Financial Senior Market Strategist. Appreciate you sharing your thoughts.
Thank you.
Of course, there have been some of those standout names here in the shift to working from home this year. You can call it a tech name as well. Peloton pulling back a little bit today, despite the fact that it's still up by about 170% on the year, giving back by about 4% here in the afternoon trade. But Yahoo Finance's Brian Sozzi caught up with Peloton CEO John Foley to discuss how the company is looking to build on the momentum it's already seen in 2020 and how it won't include a repeat of that disastrous and heavily criticized ad featuring a woman whose husband gifted her a Peloton bike that quickly went viral for all the wrong reasons. Take a listen.
You know, I think we've talked once or twice since the, speaking of creative, since the Peloton Girl ad dropped. How did you view the market's response to that? And is that approach, that type of marketing, is that what we should expect from Peloton moving forward?
I hope not, Brian. I think we're going to learn from that experience. We do have some super cool marketing coming out this fall, some brand spots with our new head of global marketing, brand marketing, Dara, who we're very excited and pleased to have onboarded, and she's going to do some great stuff and really paint her masterpiece here at Peloton. But with respect to that ad last year, you know, as we did a postmortem on it several times, it felt to me like there's just still baggage in the fitness category of all of the, for decades and decades, bad brands, bad marketing, gimmicky products. And so I think we were lumped into the association with some of those, you know, all the baggage in the categories, because we don't sell weight loss, as you know, we sell happiness. And you, Brian, understand it more than most, is just, it's not about hard body. It's not about, you know, six-pack abs. It's about being a good father, a good professional, a better version of yourself, and being happy because you have fitness in your life. And we know that, and our members know that. Last year, I guess that ad didn't quite strike the right chord of communicating that in the right way. So we'll be better moving forward.
Learn from your mistakes. It's always important in life. And you can catch the full interview there with Peloton CEO and co-founder John Foley on Yahoo Finance at yahoofinance.com/presents. We're going to take another quick break here. And on the other side, digging into some of those executive orders that President Trump pushed through here amid the stalemate between Republicans and Democrats on that next wave of stimulus, why more companies are not buying into that payroll tax deferral plan. We'll discuss that right after the break. Stay with us. Back to the ticker. It has been weeks since we saw that additional $600 in unemployment benefits through the CARES Act roll off at the end of July. And a lot of questions remain about whether or not the American worker who has been laid off, or even those still with a job, can suffer through the rest of this pandemic and not see a shaky turn of events here in the recovery that we've seen play out Q3, now moving closer to the end of the year. And one of those plans was Trump's executive order on his payroll tax deferral plan. We've discussed how companies might not have taken that up due to some complexities there and a shifting of liability should that get reversed or challenged in the courts. And here to discuss that, as well as why Republicans and Democrats have yet to agree to another round of stimulus, is Caroline Harris. She's Vice President for Tax Policy and Economic Development at the U.S. Chamber of Commerce. And Caroline, thanks so much for taking the time to chat. I mean, when we talk about it, it was one of those things that Trump pushed through to try and, I guess, buy some time here. But companies don't look to be taking it up. So what do you think's at play here?
So I think this is well-intentioned, like you say. I mean, I think there was frustration with lack of legislative action at the other end of Pennsylvania Avenue. So I think the president put this out, well-intended. I think it sort of has three buckets of flaws. I think first, on the employee side, you're going to get a comparatively small benefit every 2 weeks to what happens come 2021 when you have to pay back this deferral because it's not forgiven. So if you make about $50,000 a year, you're going to see about $120 every 2 weeks in your paycheck. Certainly, not inconsequential. But then come January, your first withholding is going to be $240. And I think that's sort of a hardship for a lot of folks who really do need that money. I think the second thing is for the employees who realize, hey, this is a hardship. If your employer opts in, it's unclear how an individual employee can opt out. And so I would put those in the first bucket. And the second bucket, I would talk about the implementation or sort of IT administration aspect of this for employer is immensely challenging. Payroll systems aren't set up to determine who's eligible for a payroll, for this payroll deferral. And it's unclear how an employer even reports to the IRS that they're deferring this, so they're not subject to, penalties, fines, interest, et cetera.
Yeah.
As you hit on there, the liability issue, obviously a big deal. If an employee separates from his or her employer come 2021, the employer is liable for that.
No, it's all very tricky. And I mean, the thing is, this drags on too, though, because Republicans and Democrats have not agreed. We've heard from a few Senate Republicans here after Senate Democrats blocked that skinny bill to get through, that we're not going to see agreement for another stimulus bill until after the election, which would be months without aid here for a lot of America's workers. I know you talk to congressmen and women all the time on this. What are you hearing in terms of where we go from here, and what percentage chance do you give to that being true?
Sure. So I think the fundamental differences here are the dollar amount of this. We saw the HEROES Act come through the House north of $3 trillion. You saw the skinny bill that failed in the Senate last week around $650 billion. So it's quite a delta there, I suppose, between what Republicans and Democrats want, to say the least. I think there's also differing priorities for different sides of the aisle. For the chamber, we look at it this way. You're at the beginning of a K-shaped recovery. So you have industries and sectors that are going to recover very vigorously. And you have folks who are going to continue in a free fall for a very long period of time. And that's why we believe it's instrumental to take action and do this stimulus. We want to see things, as you sort of hinted on before, unemployment, the pandemic unemployment issue addressed. We want to see additional aid for small and mid-sized businesses who continue to struggle, whether that be an additional paycheck protection money or tax incentives, liability protections. You have a lot of people out there who are complying with what the federal, I think you mentioned earlier, the CDC, these federal guidelines, and we want to make sure they're not facing unwarranted lawsuits when they are complying. Spending for childcare and K through 12. I mean, talk about important education incentives. That remote education looks really different. And, I think we really need, that's something worth putting money into. So our position has been that, we don't want to prolong, we certainly don't want to see that free fall continue for those folks who are in those industries. And we just think it's imperative to get this done.
Yeah, and even for those who do still have jobs, we noted pain too, and a shifting cost structure as well. I don't know if anyone out there watching has been working from home as well, but maybe your energy bill has gone up through all this as well, but a lot to see changed here as this fight continues. But Caroline Harris, Vice President for Tax Policy and Economic Development at the U.S. Chamber of Commerce, appreciate you taking the time.
Thank you. Have a great day.
You too. We're going to take one more break here on the ticker. When we return, the surge in hiring, at least one company seems to be, that would be Amazon. Their plans to bring on more workers in the U.S. and Canada to support more purchases. We'll discuss that on the other side of the break. Stay with us. Welcome back to the ticker. Despite the coverage that we've been dedicating to a lot of jobs getting cut out there, one employer is adding to its payroll. That would be Amazon, hiring workers in the U.S. and Canada amidst a surge in e-shopping. And here to discuss that with us, Yahoo Finance's Sabeel Marcellus. And Sabeel, I guess that's where the jobs are.
That's right. At a time when tens of millions of Americans have lost their jobs, are looking for employment, collecting unemployment insurance, we're seeing Amazon really stand out because they have announced today that they want to hire an additional 100,000 workers. And they're talking about part-time and full-time positions, paying $15 an hour at minimum, having those workers be able to have benefits, and even in some instances, sign-up bonuses of $1,000. So clearly Amazon ramping it up, wanting to bring in more people, more of a headcount, more people onto their payrolls. Now, Amazon's not the only one doing this. We also saw this from Walmart, Target, and even Instacart, adding hundreds of thousands of workers to their payroll to try to deal with the surge in millions more Americans trying to get goods online shipped to their homes.
Yeah, that's definitely where we've seen the shift in employment. A lot of those e-commerce tied jobs seeing a boost here. But Yahoo Finance's Sabeel Marcellus, I appreciate you bringing us that. That'll do it here for us on the ticker. Stay tuned. The final round is next as we continue to track this rally with the NASDAQ up more than 1.5%. We'll be chatting with the mayor of Miami, Francis Suarez, will join the show next to discuss Florida reopening its bars yet again. We'll see how it goes this time. Stay tuned. Final round is next.
All right, good afternoon, everybody. Welcome to the final round here on Yahoo Finance. Miles Elden with you in New York on this Monday afternoon. Let's take a look at the markets here. We've got all three majors right now sitting in green figures. Tech leading the way. Really, the Russell 2000 small caps are leading the way. The Russell up better than 2% right now. About an hour to go in today's trading session. The NASDAQ tech index up about 1.8%, most among the majors, but the S&P and the Dow are both up better than 1 percentage point. Looking at some of the trades moving the market today, we see a nice bid in the airlines and the hotels, reopening trade underway to some extent today. And so overall, seeing the market kind of stabilize, I think would be the right word to use after we saw that volatility at the end of what that would have been 2 weeks ago. And then, of course, in the beginning part of last week, we had the S&P down about 8% at its lows. The NASDAQ fell into correction territory, off 10% from its record highs. NASDAQ right now is back above 11,000 during today's trading session. Just taking a look here at the S&P sectors, all 11 sectors are in the green today. We see real estate moving to the upside, but tech and healthcare, the second and third best performing sectors right now among the majors. XLC, communication services, the laggard on today's market. All right, we're bringing in my co-host, Shauna Smith, joining us for the next couple of hours. Shauna, just for quickly, what stands out to you in today's market action?
Well, Miles, I think going into this week, there was lots of questions about what we would see, especially on the heels of the volatility of last week and at the end of the previous week. So I think the fact that we are starting off in the green and pretty strong with the Dow, S&P, and NASDAQ all up over 1%. Obviously, that's a strong sign here for the markets as we begin a new week. But I think the big story of the day is this deal activity. And of course, we also got the positive news on the vaccine front when it comes to coronavirus. But I think those two headlines are what's really helping investor sentiment today. You mentioned the reopening trade catching a bid with the airlines here amongst the winners. Also, if you take a look at the S&P leaders, Tapestry and Kohl's are the two top performers. And it's been quite some time, I think, since both of those names have been leading the way higher. So that, of course, is something to note in today's market action. Apple, of course, has been that one name that seems to be one of the names, I guess I should say, that seems to be dictating the market action lately. So it's one of the big gainers, up just around 2% today, holding above its 50-day moving average. So that's a positive sign here for the markets. And then I mentioned that deal activity, and I don't think we can overstate the importance of that today with NVIDIA buying ARM. We'll talk about that in a little bit more detail in just a few minutes, but NVIDIA stock today rising 5% on that news. And then, of course, we have Oracle and TikTok. Oracle shares also up just around 5%, just shy of that all-time high that we hit last week. And then in the pharma space, we also got a deal there in regards to Gilead buying Immunomedics. Now that's a cancer drug maker, $21 billion deal. Gilead stock up just around 3%, and then Immunomedics, their shares doubling. So lots of action in the M&A space, and of course, that could kind of help the confidence, or at least some of the skeptics out there, just in terms of the strength of this market.
Yeah, well, we've seen, Shauna, if you think about what really keeps the deals market open, it's always the ability to get financing for anything. And of course, we've seen such a strong summer in the fixed income markets that we've talked about with so many guests over the last few months. But I wanted to get a bit more into what's going on with that NVIDIA ARM deal. Jared Blickery joins us now. And Jared, the chip space is certainly one that you follow very closely, just for an indicator of, it tends to be a leading indicator, I should say, of market cycles, and traders watch this area very closely. But I think this deal, just for the actual technology that's happening here, the SoftBank angle, it's a very interesting deal, for all kinds of market sentiment as well as technical reasons.
Yeah, just to build on what you were talking about there, this is going to be, if it goes through, because that's not even a fait accompli right now, but if it goes through, it would be the largest in the chip space ever. And it really just puts the pedal to the metal against Intel's business here. And it's even going after AMD's server business. Now, AMD is already eating Intel's lunch. We know that they tend to move inversely on their earnings dates because they are such close competitors here. But NVIDIA has emerged as a leader in the data center space. And this gives them the ability now, if it goes through, the ability to produce CPUs in addition to GPUs. So it adds to its profile and could cement its market dominance in the data center space. Now, this would have to be signed off by US regulators and Chinese regulators. So it could take time. And even if it does go through, I mean, we could be sitting here for a year waiting for approval on this. And of course, we have the heightened tensions between US and China ahead of the elections. We don't know who the president is going to be. That could affect the outcome. So lots of variables here, but it could be very exciting for NVIDIA. And we see it's up about 5% today.
All right, Jared, let's turn our attention to the broader market and something that we've talked about on an almost daily basis, and that's just the VIX. Just want to get your view on sort of how you see the market. Maybe I use the word stabilizing. Is that something that you would characterize the market as doing, kind of given the action we're seeing today, and kind of given the way that I think we can say some of the trades that were, if we back out that kind of euphoric period in August, the trades that were really driving the market seem to be kind of, collecting themselves here a bit.
Yeah, the VIX is pretty interesting recently just because of all the options open interest right now. We know that the Robinhooders have been buying calls. We know that big companies, big whales like SoftBank, they've been buying calls. And there's been speculation that it's distorted the VIX somewhat, at least the spot VIX. And that's what we're looking at here on the Wi-Fi Interactive. This is a 3-month view. And here's that big spike up we got about 2 weeks ago, late in that week. And we've come back down rather nicely around 25. So this is actually the lowest we've seen since that big sell-off in equities. And we do have options expiration this week, so we're going to be tracking this throughout the week. But if you want something that's actually more sensitive to volatility than the spot VIX that we're looking at, that would be the future spread between the second month and the 8th contract month. And that really never signaled as much fear in the market as a spot index was, and it was quicker to come down. So we don't really have the same volatility elevated or fears that it's going to remain elevated that we might have when we first got that sell-off in this big spike here. So the bottom line is that in this options expiration week, we're not seeing too much fear in the market right now.
All right, Jared Blickman, we'll check in with you later on in the program. All right, let's turn our attention now to everything going on with the coronavirus. And we have heard now for several months that the end of this year would be a potential for some kind of vaccine to not only be approved, but maybe get its way out into the public. And some of those headlines continue today. Anjali Kimlani joins us for the latest on all of that. Anjali.
Thanks, Miles. Yep. So reaffirming that message today, we heard from Pfizer CEO saying about the same, that the vaccine is likely to be distributed to Americans by the end of this year. But we're still looking at what that timeline looks like in terms of actuality, with phase 3 of their trial reporting out by the end of October, but not early enough by the end of October to be involved in the independent discussions about vaccine distribution. So that's going to be an interesting timeline and just how close it gets to the end of October and possibly longer. Meanwhile, we know that AstraZeneca did resume its trial. We know it was on hold last week because a patient had an unexplained illness in the UK for phase 3, and that triggered a sort of a hold globally for all trials. So right now we're waiting on word on what happens with the US trials and whether or not those can continue this week.
All right, Anjali Kimlani with all the latest going on the coronavirus front. Anjali, we'll talk to you later on this week. All right, let's take a quick break. And on the other side of this, we're going to talk about everything going on with TikTok today. I wouldn't call this resolution, but there is some sort of progress in the TikTok saga. Oracle, now its trusted tech partner. We'll get into all that coming up here in just 2 minutes. All right, welcome back to the final round here on Yahoo Finance. Miles London with you in New York. Well, the story we've been covering now for almost 2 months is the saga with TikTok. What would happen after it was, I guess, reportedly forced to sell itself based on a request made by the president. And it wasn't exactly clear how this would resolve. And today it seems like there is something like resolution. Oracle coming out today and saying that they are now TikTok's trusted technology partner here in the US, which Dan Roberts does not mean that TikTok is being sold to Oracle, but the request that basically a US company, I don't know, be involved or be the caretaker, or however you want to phrase this, have a hand in TikTok's business and make it not so clearly an arm of the Chinese government. It seems that that is now where we're at. And I guess I would ask, is this the end of the story to you, or just sort of maybe a middle, interlude of sorts?
Well, it's maybe not the end, Miles, but an unsatisfying resolution. And that's if it goes through. Let's make sure we say, as you caveated just now, this does not mean that TikTok's US operations have been sold to Oracle. That's incorrect. And in addition, the idea of a partnership, which is how the companies are framing it, still has to be approved by the White House and by certain committees. So it's a proposal for now, and it still has to be approved. The idea that it's a partnership instead of a sale, in some ways you would think that's unsatisfying, but arguably, based on what some analysts are saying, it's kind of the only way that it made sense for Oracle. And if you look at it from Microsoft's perspective, Microsoft clearly wanted a full sale. I mean, Microsoft wanted control of the algorithm and the data. All you really get with the partnership is political capital. And if you remember over the last few weeks, when it started to look like the bidding process was coming down to 3 big names, Oracle, Microsoft, and then Walmart, everyone on this show kept discussing none of those names is really an obvious fit for TikTok. We can talk in each case about why, but Oracle, almost sort of the least obvious of the 3. Oracle doesn't have a hand in data, in content, or in social media, really, in any way, shape, or form. What it is doing is it's in a battle for cloud supremacy with other companies. And I think that, you look at the fact that Microsoft won that big Jedi contract. I don't think it's too presumptive to think that Larry Ellison, who of course is a friend of President Trump and a political donor of President Trump, he held a fundraiser for Trump in February. I don't think it's going too far to think that you could say the biggest motivation for Oracle and for Ellison is just the political capital of saying, oh look, we came in here and we're helping the government by being the partner. Dan Ives, the analyst with Wedbush, I just spoke to him on the phone about the deal. And he said, to his mind, Oracle will be behaving like a big brother here, just kind of a steward of the app in the US and making sure that there's no backdoor to Beijing. But it doesn't own anything. It certainly doesn't really help Oracle's business to have this partnership with Oracle, with TikTok, but there's the political capital. I think that's what you have to assume is the real motivation here. And interestingly, we should mention that Reuters still reporting that Walmart in some way, shape, or form would like to get in on the deal. Maybe that means approaching Oracle and saying, we'll do an investment and you let us in as a partner too. But I guess this sounds like the end of it from Microsoft's perspective.
Well, and Dan, to your point about the Reuters reporting, that originally came from Caixin, which is a Chinese publication. Then Bloomberg started reporting it, then now Reuters picking it up. But essentially, there is some sort of e-commerce relationship. And to your point, partnership is the best way to phrase this because it is still very nebulous and very vague as to what the sort of equity share would even look like. But I was on this program 2-3 weeks ago talking about how I think Walmart actually is a very good fit in many ways. And I think our own Brian Sazi did write a piece about this as well, talking about the very specific, cash balance that Walmart has, the ability to make it sort of a seamless experience for tweens to think that shopping at Walmart is cool again. There was this period of time where those $10 jeans were trending on Walmart, specifically with the TikTok audience. So just thinking about the different tie-ups that TikTok could have, precisely because Oracle does not have the consumer-facing side, I think could be a really sort of interesting creative conglomerate here. I do want to point out, in addition to Oracle's political capital, let's keep in mind that Oracle had teamed up with Sequoia and General Atlantic to potentially have a trifecta sort of deal. Both General Atlantic and Sequoia have board seats on ByteDance. They have a very strong relationship with the Trump administration. So the ability to sort of come at it from 3 angles, it's not just on Larry Ellison or Safra Katz's shoulders, is also a huge boon potentially to this going through. I want to read a statement that TikTok did share with Yahoo Finance. They do say, we can confirm that we've submitted a proposal to the Treasury Department which we believe would resolve the administration's security concerns. Let's keep in mind, guys, today is September 14th. The so-called deadline for this was supposed to be tomorrow, September 15th. Over the weekend, Trump did not remember the actual deadline for the deal that he had supposedly been pressuring. So that's a whole different issue that I'm not quite sure the accountability component is there. And then one final point that I want to add is that the South China Morning Post did report over the weekend that TikTok's algorithm is simply not for sale. What that means is the crown jewel, the point of TikTok, the reason that TikTok is so valuable is because of it's insanely accurate algorithm, right? You can fall into a hole for several hours because the content is so tailor-made, so curated to your own interests and your own dabbling. So the fact that that's not up for grabs and that's the bottom line of this deal and all these negotiations maybe proves that Microsoft was not willing to be flexible on that metric, perhaps. So lots of moving pieces here. Miles, to your earlier question, I think this is actually just the beginning. I don't anticipate that there will be anything in writing finalized or confirmed for weeks to come.
Melody Hom, you mentioned Brian Sazi, and on this program, when you mention someone's name, they do magically pop up in the hangout. Brian Sazi, welcome to the program.
Thanks for having me today.
Melody mentioned the Walmart tie-in with TikTok. I know you wrote about that, thought about that. You see this news cross from Oracle earlier today. Just kind of your view on where this stands.
No, Melody hit the home run on that. She's absolutely right. For Walmart, it's all about going digital, ever digital, with Walmart CEO Doug McMillon. He has acquired growth. He's acquired online retailers. He's moved to same-day delivery. You saw our story from Julie LaRoche this morning. Now they're testing on drones. The bottom line is this asset, even some kind of tie-up, would give them a competitive advantage. You don't see a Target. You don't see a Kroger. Ultimately, I think they will turn this, if they do get involved, into a digital shopping center. It's where everything's going. And if they miss out on TikTok, look for talks to start up with Snapchat. It's essentially the same model to a certain degree. Different, certainly TikTok and Snapchat, but why not Snapchat? Why not make a play for Snapchat? Why not make a play for Twitter? I think it puts those companies in play.
All right, so in your view, then, I guess Walmart's next natural acquisition of sorts, they went kind of the route of these vertically integrated brands, which have had quite a few challenges. Dan Roberts has written about that a lot. You view social media as a new frontier for them, I guess.
It's all about data. Data right now for Walmart is the lifeblood. It's not a new $2 steak they sell in the freezer section. It's all good. That is what it is. It's not opening up new stores. It's taking the large amounts of capital they have on the balance sheet and access low-cost credit and finding data and learning more about its consumers and targeting more things to its consumers. I think that's where they're going to go.
And then, guys, I'll give Sazi this on why Walmart makes sense in a very simple element. Forget everything else. How about having influencers do sponsored videos and TikToks involving Walmart? I mean, imagine every influencer on TikTok doing their stupid dances in the parking lot of a Walmart. And then imagine the great affiliate links that Walmart can get to its e-commerce site.
Yes, the little.
And watch me and you, Dan, tape these guys and men and female inside the stores doing these TikTok videos.
Yeah, I was gonna say soon there'll be a watermark on all the TikTok videos, not just with your handle, but with filmed at Walmart in X place, and that'll be, of course, part of a great new, beautiful sponsorship integration that everybody will certainly love. All right. Well, speaking of someone who does create content on TikTok, blast from the past, of course, certainly Melody Hom makes us millennials feel old. Paris Hilton getting in to the TikTok game. I feel like Paris Hilton is she's like an avatar of when we were little kids. She was a big thing, and now we're old people, and she's trying to reinvent herself. I guess TikTok part of that process.
I mean, we've talked about this so much on the Final Round, the nostalgia play, right? Whether it is Disney content, whether it is The Simple Life, and, Sazi, of course, is still in this hangout, and I was talking to him earlier today just about how The Simple Life aired in 2003. It aired from 2003 to 2007 when Paris was 22 years old. She's now 39, and she's very bullish on TikTok. She actually started a trend called That's Hot, surprise, surprise, and over 1 billion views were logged in the first 24 hours. Essentially, what she's trying to do is sort of break her own caricature, because we know that she was known for that high-pitched voice, for being a little ditzy, for being that blonde girl, being the hotel heiress. But in many ways, she thinks that TikTok is the way to rupture that, right? To be able to show the behind the scenes, to show that not everything is glamorous, and sort of poke fun at yourself in a more creative and organic way. I did ask her specifically about why she loved TikTok so much. Here's what she had to say. You know, you mentioned TikTok. I know you participated in Triller's virtual music fest. You're on TikTok. You actually just launched a new challenge called That's Hot.
Yes.
I think there were over 1 billion views in the first 24 hours that you started that campaign. And I'm sure you're seeing a bunch of fascinating, funny, amazing people posting using that hashtag. Why is TikTok the most exciting avenue for creation right now? What makes you so excited about the platform?
I just love the platform. I love the editing. I love all just the different things that you could do. I love all the challenges, the music. I just think it's so creative and fun. And if someone loves to dance or they want to do comedy or beauty, you basically could do anything. And it's just, the innovation is amazing. And it's just more fun than any of the other platforms. You just have a good time with it.
Yeah, so as you can tell, Paris Hilton actually doesn't have that big of a following on TikTok. She has 3 million followers. Charlie D'Amelio has about 80 million followers at this point in time. As we know, that sort of online cachet and clout has been translated, right? This is not just within the TikTok universe. So Paris Hilton rightfully is kind of getting at those tweens, perhaps those 20-somethings who are nostalgic for that period of time, for the early ages of reality TV. And speaking of reality TV, I did ask her about Keeping Up with the Kardashians. If we recall, Kim Kardashian West was her assistant for those early years. Paris Hilton basically made her famous. And I asked what she thought about the show ending, and she said, you know what? They've built such amazing business empires, so it doesn't really make sense for them to have to program the show anymore, especially because that was basically just an avenue for them to keep marketing their ongoing products.
All right, Melody Hom, thanks for that. You can catch Melody's full interview, of course, with Paris Hilton here on Yahoo Finance. All right, coming up after this break, we're going to talk to Miami Mayor Francis Suarez about what's going on down in Miami. We've seen cases dropping sharply in the city and in the county around. We'll talk about everything going on with COVID in that region of the country coming up here in just 2 minutes. All right, welcome back to the final round here on Yahoo Finance. Miles Udland with you in New York. Well, certainly we have covered the progression of the virus through the country over the summer here in New York City. Of course, things were most acutely intense back in March and April. But during the summer, Florida was really the hotspot in the country, and no county hit harder in Florida than Miami-Dade. And we are joined now by Miami Mayor Francis Suarez. Once again, Mayor Suarez, thanks so much for joining the program. So let's just start with, maybe from your vantage point, an update on the COVID situation in the city of Miami. Things have improved markedly over the last couple of weeks, but still, I would say, a fairly high state of diligence down there in the city.
Yeah, there is a very high state of diligence. I mean, just to give you a perspective, when we closed down in April, May, March, April, actually, we were at about 533 cases. We got to a high point of 3,500 cases, so it was about a 700% increase. We had our hospital system had 2,300 COVID patients. We're now down to below 600 COVID patients. Yesterday, we had 250 cases. So that is obviously less than 1/10 of what we had at our peak. We clamped down. We implemented a mask in public rule. We had a curfew. Indoor dining was closed. And all of those things together helped us get to that point. And now, little by little, we're keeping the mask in public rule, but we're starting to ease some of the restrictions. Like, we've already opened up indoor dining a couple of weeks ago. We haven't seen the numbers go up at all. So they've actually continued to go down. And today we're increasing the curfew from 10 p.m. to 11 p.m.
And talk a little bit about, I guess the role that you feel like you play as the mayor of the city inside of a large county that has plans it wants to do versus the plans that you want to do. We see it here in New York, right? If I drive 10 minutes to New Jersey, there's things that I can do there that I can't do in New York City yet. How has that kind of been for you? Just trying to keep everyone as safe as possible, but also understand that I think 6 months in, there are a lot of different programs in place, and people individually have a lot of different expectations for what they'd like to do, what they can and can't do, so on and so forth.
Yeah, I think after this is all said and done, and hopefully COVID will not last forever, I think we're going to have to sort of look at the playbook. And we kind of designed this playbook as it was all happening. And so you saw all these incongruities, like you said, between cities and counties and states. Luckily, we were at liberty to do a lot of the things that we wanted to do from a restriction perspective. So we were one of the first cities that canceled large events. I was the first city to implement a mask in public rule. We were one of the first cities to implement a stay-at-home order. You have to recognize the fact that every city is different, right? Some cities are denser than others. Obviously, you can't treat Manhattan and New York the same as you treat, a smaller city in Florida. So I think we have to really think about how we coordinate going forward. I think the coordination got better. Has gotten better in this, whatever you want to call this, whether it's a second wave or the second part of the first wave, because we had to. But there was a lot of frustration. I mean, Broward County, which is the county just to the north of us, had indoor dining and a later curfew throughout the entire time. So people who were in the north part of the county could just drive, 5 blocks into another county and have dinner inside and have dinner later. So it was frustrating to our business owners who felt that some of that stuff was unjustified.
Mayor Dan Roberts here. So you guys are opening up bars, breweries today. Where do you stand on the outlook for sports events in person? Because it's interesting. We just saw the NFL start its season, and in week 1 over in Jacksonville, which I know is not Miami, that was the only team in week 1 to have fans in the stands. They had some reduced capacity. And then, of course, the other Florida team in Tampa, no fans in the stands. What do you see happening over the next few weeks for Miami in terms of any in-person sports events, especially we've got college starting up now?
So the Dolphins and the ownership group of the Dolphins, Ross, have applied for and been given the ability to have up to 13,000 fans in the stadium. They've probably set the standard for how a stadium should deal with COVID in terms of creating a variety of different touchless systems to be able to safely have fans in there. So the reason why you didn't see one this weekend is because the Dolphins played in New England, unfortunately, because that didn't go too well for us. But thanks, Stan, for rubbing it in. I appreciate it. But listen, it was, aside from that, it's exciting, I think, for people to think that things are returning to some semblance of normalcy. And I think, obviously sports coming online, you have all the major sports that are playing right now. The Miami Heat is looking really, really good. We're, again, going up against one of those New England teams in Boston tomorrow night. So hopefully we'll do a little better against them than the Dolphins did against New England. But yes, in Miami, the Dolphins have been given conditional approval, and the Miami Hurricanes that play at that stadium to have up to 13,000 fans.
Hey, Mayor Suarez, it's Shauna. I have a question just about state and local governments because the budgets there have just been devastated because of the coronavirus pandemic. And I know you issued a statement today urging Congress and the administration to help. But how dire is it? How critical is it that you do get the additional COVID-19 relief? And what do you want? What do you think needs to be included in that legislation?
I'll give you a perspective of how dire it is. My first year as mayor, we grew 8.5%. My second year, we grew 10.5%. Last year, we grew 6.5%. We went from a $20 million surplus in this budget to a $25 million deficit in this budget. And in next year's budget, which begins October 1st, we have a looming $33 million deficit. So you got, $57 or $58 million in deficits just in really a year and a half. And so we're urging Congress to please pass a CARES Act 2.0. We had an issue with CARES Act 1.0 because if you're a city with less than 500,000 in population, we have 468, according to the census, 468,000. You don't get a direct payment from the federal government, so you're relying on counties that didn't waterfall the money. So, that was the first problem. The second problem is we have a tremendous amount of restrictions on what we can spend the money on. One of the things that both the Senate and the House version of CARES Act 2.0 have in both versions, which I'm happy they both have it, is the ability to pay what they call revenue shortfalls, which is basically deficits. And that would prevent us from having to cut, or not give raises to our firefighters, our police officers, all those frontline workers who, by the way, are the professionals who are at the most risk of contracting COVID. So, I think for me, that's what I'd love to see happen. Obviously, if we got another $250 billion of spending, that would be phenomenal because we actually need the money. Or if they fix CARES 1.0 and let it waterfall to the cities, that would be another way to fix it.
And then Mayor Suarez, finally, when you think about another issue that's top of mind for Miami residents, it's of course schooling, right? So as I understand it, Miami-Dade public schools could potentially open for in-person classes by the end of this month. What are the specific metrics you're looking at to make sure this can actually happen? When will you officially decide that?
One of the things that had to happen, and it happened late last week, was we had to go into phase 2. And so the governor declared the state of Florida in phase 2, which opens the possibility, the prospect of our school system opening up. We've had a lot of difficulties. The school system has had a tremendous amount of difficulties with virtual learning, particularly the public school system, but really it's been the public school and the private school system. I mean, it's been very, very difficult. I have a 6-year-old, and I'm very blessed to have, a lot of technological resources. My wife and I are able to be home a lot. And even with all that, it's been extremely difficult for us. So, the fact that parents right now don't have a choice as to whether or not they can send their children to school, I know has been very frustrating. So there's 8 different metrics that the school board is looking at. And right now, all 8 of them have been met. So I suspect that, that there's going to be an announcement soon, moving up the date from October 5th, which was the original date, probably moving it up a week or two to allow for in-person class soon.
All right, Miami Mayor Francis Suarez, Mayor, always appreciate you taking the time to join us. Thanks so much for being in touch.
Anytime, Miles. Thanks all of you.
All right, thank you. Coming up on the other side of this break, we'll take a look at the markets, plus another weekend at the box office, slowly reopening. The numbers still pretty disappointing. We'll get into all that here coming up in just 2 minutes. Final round here on Yahoo Finance. Let's go to Jared Blickery for a look at where the market stands right now with about 25 minutes to go in today's trading session. Jared.
Yeah, we still have real estate and tech in the forefront today. And just looking at a 2-month chart of the various indexes, the Dow is within last week's range. So really just kind of consolidating. We've watched volume and range taper off over the last few days, especially volume. And in the NASDAQ, not much of a different story, still in last week's range. Importantly still, though, it did close below the 50-day moving average, which we highlighted Friday, and it's above now. Maybe a false breakdown, but we'll have to see what happens into the close and also as we get into this options expiration week. S&P 500, similar story here. So let's check out the dollar because that has been range bound as well. And let's see if we can get a chart that doesn't seem to want to participate here, but we have been in a multi-month range looking for a breakout, and it's frustrated traders both to the downside and the upside. Still a crowded trade, but if we look at what's happened versus the Chinese yuan, this is a one-year low, so that is signaling that yuan doesn't care about heightened U.S.-China tensions. Now let's take a look at the NASDAQ 100 heat map. We got Apple up over 2.5%, Amazon now in the red, down to about 0.4%. Microsoft, which had paired all of its gains earlier, is back up to 1%. Alphabet and Facebook basically treading water. One standout here is Tesla, once again, up 11% over the last 5 days, almost break even, pairing those losses that it had a week ago. Miles.
All right, Jared Blickery, we'll check in with you after the closing bell. All right, well, if we were to build a short list of the companies that defined the pandemic, no list would go without mentioning Peloton. That stock down around $20 per share at the low in March. Right now, the stock is trading around $80 a share, and that's even off of the company's or the stock's highs. And Yahoo Finance's Brian Sazzi joins us now to talk a bit, Sazzi, about your recent conversation with the company's CEO and co-founder, John Foley, about I guess what's been kind of the year you couldn't have imagined, not just because of the pandemic and all that, but Peloton goes from being what it thinks is a strong player in a growing category with a great brand offering to everyone has to stay home. And now it's by far the biggest fitness trend. Tell us a bit about that conversation and just kind of where I guess you think Foley's head is at right now.
Well, part of his head is cooking bacon and eggs with his 2 daughters and his wife, Jill, who is the VP of apparel at Peloton. But besides that, he's thinking about longer term planning and where the brand might go. And to be fair, he has some really big goals for over the next 15 years. Take a listen.
Yeah, so we have I call it a BHAG, a big, hairy, audacious goal of having 100 million members, 100 million subscribers, and a net promoter score of 100. To our knowledge, there's not a company in the world that has a 100 net promoter score, and certainly 100 million subscribers gets us in that rarefied air of some of the FANG stocks. And we think that Peloton has the opportunity to be one of those special companies. And we have thousands of people at Peloton who are marching in that direction every day, and doesn't look like we're slowing down anytime soon.
And guys, that is correct. That is the BHAG goal by John Foley and his team at Peloton. Now, to be fair here, Peloton ended the most recent quarter with 3.1 million subscribers. Also, let's keep in mind, Netflix exited its second quarter with nearly 200 million. So there is some, they have a long way to go to hit that $100 million mark. But if they can grow about a 26% compound annual growth rate in terms of subscribers the next 15 years, he has a shot at hitting that goal. So it's not completely out of the realm of possibilities, especially considering we've all changed how we work out because of the pandemic.
Well, and Sazzi, I guess, in thinking about that goal, that would sound to me like that sort of vision is that while, the bikes are great and that's obviously going to be a core part of their business, I would suspect that Foley in that outline would see maybe 2-to-1, almost a 3-to-1 ratio of people who are just subscribers to Peloton versus people who have a bike and are also subscribers to Peloton.
Yeah, right, Miles. It's a total mix of people using the app and not having the bike, or on the bike, they have a treadmill and they also have the app and they're engrossed in this content. But part of that goal is ultimately making their products more accessible. And you saw the first step with that about 2 weeks ago where they're coming out with a cheaper tread. They dropped the price on the bike. And I think for them moving forward, key to that goal in driving a higher stock price, more revenue, and ultimately profits is driving these Apple-like hardware upgrade cycles. This is their first crack at it. Let's see how it goes.
And just finally, how's your personal Pelotoning been going through the pandemic?
I'm in the best shape of my life, full and fair disclosure. I'm up to about 30 to 31 workouts a month. My gym is closed. I'm using the app a lot of strength-based workouts. On the weekend, I'm about up to 6 workouts on Saturday and Sunday, and it's great. Love the platform, full disclosure.
Do you think you're ever going to go back to a regular gym? Or you can't?
Not as much as you would think. Am I thinking about potentially supplementing it? I was going 5 times a week. Maybe I go once or twice a week, but I realize I don't need to be walking around with my pecs showing and these short cutoff shirts, walking around the gym and getting sick. I feel great, so I'm going to stick with it.
I won't. I'll cut that part out for Chris Rondeau. I know you don't want to make him upset.
No, he's Jack. Please don't tell him that. Please.
We don't need Chris Rondeau saying, "Salzy, I'm going to come find you" when I hear you talking bad.
No, he's ripped. No, I don't want to mess with Chris Rondeau.
All right, Brian Salzy, thanks so much. Again, you can catch Brian's full interview with Peloton CEO and co-founder John Foley right here on Yahoo Finance. All right, let's turn our attention now to what's going on at the box office. Slowly reopening here in the U.S. Tenet, they're now up to $7 million in box office sales in the U.S. and Canada. That's a drop of about 30% from the prior week. Mulan really stumbled with its opening over in China. And Dan Roberts, I know that you love going to the movies. No one wants to see the movies rebound more than you do, but it feels like it's a combination of maybe a couple films falling a little flatter than maybe audiences wanted in terms of the movie itself. And also it just seems like people in the US and North America just do not want to go back to theaters right now.
Yeah, I agree. The numbers are not promising. It's hard to find a reason to dismiss this data and say, no, it's okay because XYZ. There's a lot of interesting kind of lessons we can learn from this data. First of all, as you mentioned, Tenet, steep drop off in week 2 in US theaters. Now, of course, it's not open in NYC or LA. Those are 2 huge markets. And we can also mention that at least Tenet globally has made back its budget. It has now made more than $200 million at the box office globally. But boy, in the US, there was a steep drop off week 2, and it really made less than 30 million here in the US. Now, let's also talk about Mulan in China. We can't really make much with Mulan US numbers because it was on Disney+, but Mulan coming out in China, and due to a number of controversies, and I know Melody has reported on this more than I, not just the Hong Kong police sympathizing tweet from the lead a year ago, but other problems with the credits, crediting certain Chinese companies at the end of the movie. But due to those controversies, only about 23 million in China. And we talked about, well, how will we be able to compare how Tenet does to how Mulan does? Because the 2 studios, Disney and Warner Bros., are taking divergent approaches. And we even had the producer of Mulan on this program warning everyone ahead of time, it won't be apples to apples. You can't really compare us to Tenet. Well, there is one way to compare them. We can just look at the China box office numbers, and Tenet did better at the Chinese box office, about 30 million versus 23 million from Mulan. Still pretty close, but Tenet did better. And again, even though you can say that Tenet has dropped off steeply in week 2, I imagine, and soon we'll get some, massaged Disney Plus numbers from Disney that they say are good. But I would imagine that behind closed doors, Warner Brothers executives are feeling a little bit more happy about how Tenet has done than Disney executives are feeling about how Mulan has done. But as you said, Miles, not very encouraging for whether people are ready to go back to the movie theater. Overall, it seems like they're not here in the US.
And Dan, success in this case is all relative, right? So to your point, maybe objectively, Tenet executives would say, this sucks. But because of all the backlash that Mulan has been facing and because of how poorly it did in China, I think it can be seen as a win by many measures just because it hasn't been embroiled in a lot of political chatter in the way that Mulan has. And I do want to point out that even leading up to this, earlier this summer, there were boycotts and protests. Yes, they were small, happening across Korea, Taiwan, all over China, all over Hong Kong, and various other Southeast Asian countries protesting Mulan leading up to this film coming out. So we sort of knew that it wasn't going to be received positively, but I think unfortunately Disney really totally wrecked the execution of this film. And so as much as we can say it is a China thing, I do feel like even for the Asian American audience watching in the United States, they were very disappointed with how Mulan was portrayed. And then a final thing here, the big picture takeaway for me is that so much of the last couple of years has been, will this movie succeed in China? That became the number 1, if not number 2 question for a lot of these studios executives' minds. I do feel like there will have to be a recalibration. This may be a moment for that as we see, whether we're talking about TikTok, whether we're talking about US-China relations, the soft power and the sort of ability to share cultures has seemed to reach a breaking point to a certain extent. So I can imagine that there will be a bit more trepidation and a bit more cautiousness as these executives try to traverse and figure out if they should really be marketing things to a Chinese audience or they should really double down on the Western world.
And guys, can we just add here one fascinating thing to me? For months to come or even years, these two movies will always be linked together. I mean, in many ways, because of the way they were released, totally separate from the content of the movies, the symbolism of these two films. You know, the New Yorker review mentioned that Tenet bore the weight of the whole movie theater industry's hopes. And that was true. And it's also interesting that the Tenet ads you're now seeing run during live sports, they say at the end, big movies are back in theaters. And it's sort of like, well, your big movie is, but, you know, don't speak for the whole industry.
Well, I know what Mulan is about. I still actually don't know what Tenet is about. So maybe I'll go figure that out at some point. Hopefully, I'd love to see the movie. Christopher Nolan, great. But again, not really something that seems to be happening here in the U.S. in big numbers. All right, coming up on the other side of this break, we're going to talk about everything going on in the markets right now. Omar Aguilar of Charles Schwab will join us for that conversation coming up here in just 2 minutes. All right, welcome back to the final round here on Yahoo Finance. Miles Allen with you in New York. Let's turn our attention now to the markets and really what happened over the last couple of weeks with that short, brief, but pretty steep correction in the S&P and the NASDAQ. For more on that, we're joined by Omar Aguilar. He's the Senior Vice President and CIO for Equities and Multi-Asset over at Charles Schwab. Omar, thanks so much for joining the program. So let's start with how you were thinking about that period we saw in the last couple of weeks. And I guess I would ask, are we still in a corrective phase in your view?
Well, we're still in the process of higher volatility levels, and we should expect higher levels of volatility for the remaining of this year. It is not a surprise that we saw the activity that we saw last week, particularly from the leaders of the market so far, which is mostly technology. It is very common to just get to that point where, after a very optimistic view in the summer with all the conditions getting to just an incredible rally, that all of a sudden people start to rethink twice about the reasons why they have those positions. In other cases, because you have the possibility of all the uncertain conditions that we have going into the rest of this year. What is interesting is that, the way that people are processing information seems to be shaping up the volatility of the day. Days like today, when you have deals, when you have promising vaccines, when you have a little bit of a calm economic data, all of a sudden triggers again a rebound in the market. So we're going to see a little bit more of that traditional high levels of volatility that are typical of a bull market. I would probably say that corrections like the ones we saw last week are very typical, especially when you see the trends going in through the rest of the year.
Well, so then I guess the natural follow-up to that would be, if you look at the broader phase of this market, maybe sort of what began in March and April, it sounds like you're comfortable calling that maybe a new bull market of sorts.
Well, it is clearly well defined as a bull market, even technically speaking, with the run that we saw since the bottom, in March. Now, I think what we have to be careful, though, is that the gap between the market and the economy gets bigger and bigger. While we see the economy is starting to recover and we're on the wood pace to recover, the market is always way ahead of what the economic data may suggest. And in a certain way, that's something that we need to just be careful and watch. The majority of recessions, usually, end and the market is ahead of the economic recovery. Now, that usually in most of the cases, even in the one we saw in 2008, it starts by fixing the source of the recession. Back then was a financial crisis. Well, right now, we still haven't figured out the original source of these recessions, which was the health crisis and the coronavirus. So I think a lot of what the gap is and the pace for the economic data to catch up with the speed of the market, it will have to be when we get a serious path forward for the coronavirus crisis.
And then you mentioned, earlier that given the performance in some of those sectors that have really driven this rally, it would make sense that we'd see maybe some cooling off as we saw the last couple of weeks. But when you think about sector styles, factors that you like right now, are these still the areas of the market that seem most attractive in this environment?
Yes, it is. We be very, very clear here at Schwab that the rotation towards value, which is really typical once you see a solid recovery in economic data, has not yet started. And a lot of that has to do with the fact that, if you see the leaders so far, when you have growth and you need to have EPS growth, when you see top line growth, especially for those big winners, we continue to see that high quality growth companies continue to drive the market forward. That has not changed, and it's going to be hard to change as we actually see, the solution to this. And if you look at those top line growing companies, those are the ones that tend to have the benefits of the working from home, of the working out from home. All those companies that have adopted to the new conditions of the market clearly have actually the opportunity to raise their EPS and continue to have the top line growth on top of the fact they're generating tons of cash flow. So it is very hard to imagine at what time we're going to get the rotation into the more cyclical names, especially because we need some sort of a change in the structure of that coronavirus or that recession source.
All right, Omar Aguilar with Charles Schwab. Thanks so much for taking the time. It was great to get your thoughts.
Thank you.
All right, coming up on the other side of this break, we're going to do a quick check of the market before we get to the closing bell here on this Monday. We're back with that right after this. About 3 minutes to go in today's trading session. We're looking at gains across the board. NASDAQ leading the way among the majors. Russell 2000 in just 2 minutes.
Welcome back to the final round here on Yahoo Finance. I'm Shonda Smith. Stocks broadly higher as we start a new trading week. All three of the major averages up more than 1%. Remember, the NASDAQ coming off its worst week in 6 months. And taking a look at the gains today, we have the Dow on track to close up just around 350 points. The S&P up just around 1%. And the NASDAQ is today's big winner, back above 11,000 and up nearly 2%. That does it for the trading day today. Again, all three of the major averages recording gains. The Dow up 350 points, S&P up just around 1.3%, and the NASDAQ back above 11,000, closing up nearly 2% today. Some deal activity and also some news on the coronavirus vaccine front, helping to boost investor sentiment. Taking a look at some of the big gainers today in the Dow, American Express and Boeing. Those two stocks are some of the big contributors to the index's gains today. We also saw solid gains from Apple, that stock up just around 3%. United Health was also a big outperformer. Taking a look at some of the sector action, all 11 of the S&P sectors in the green today. Real estate, technology, and healthcare are among the outperformers. The reopening trade is something that also stands out to us here as we take a look at some of the winners today. A lot of those names catching a bid. Airlines broadly higher. Cruise lines also adding to gains. Hotel chains, taking a look at Marriott, for example, that stock up just around 5%. Hyatt up just around 7%. And taking a look at the S&P leaders, Kohl's and Tapestry, those two stocks are the leaders today in the S&P, with Kohl's up 9.5% and Tapestry up just around 8%. But of course, some of the big stories today that we're following is some of that deal making. NVIDIA buying ARM for $40 billion. Oracle and TikTok, more of a partnership, I guess, is what we can call it at this point. We'll dig into that a little bit later in the show. And then also on the pharma side of things in that space, we had Gilead buying Immunomedics. And of course, that stock, Immunomedics, nearly doubling today, and Gilead up just around 2.5%. But I want to bring in my co-host for the next 60 minutes, Miles Udlin. We also have Yahoo Finance Editor-in-Chief Andy Serwer, as well as Emily McCormick and Jared Blickery joining us today. And Miles, solid gains here to start the new trading week, but what stands out to you in today's action?
Well, I think we've got to start with Apple just because I can see in the corner of my screen here the NASDAQ 100 heat map, and we see that Apple's is really kind of pulling away from the rest of the FANGs. Today, the stock is up 3%, while we have the FANG group, lagging behind the market overall, and this coming on a day when we did see tech in such a leadership role. And I do think that the import that Apple has to the market on an individual basis is a slight change in character relative to the way that group had been more of a bellwether group. And I think just overall, looking at the market right now, and I know we're going to get into it with a couple of our guests here over the next hour about whether that correction we saw in the last week or so is the correction for this phase, what's coming up as we get towards the election. But over the weekend, when you have David Kostin and Mike Wilson of Goldman and Morgan Stanley, respectively, coming out and saying, we still like 3,600 on the S&P, meaning we still like record highs for the S&P as we get towards the end of the year. I think that is a kind of a heat check, right? Because we could have had strategists after a 7% correction say, there's a change in character. Like we're looking at 2,900 now. Like we think things are getting worse, but the backdrop that most strategists have been keying off of, and one maybe we haven't talked enough about is what happened in second quarter earnings season. We had 80 some odd % of companies that offered guidance coming in better than expectations. Granted, there was a lowered bar coming into the most recent earnings season, but it was cleared and then some by most every company. And analysts right now are looking at a better than feared, I think is the right way to say it, outlook, and it pretty much backs up the bull case up and down the street. And so to have such a consensus view that we can have a 7% sell-off and there's still not much to fear in terms of the overall narrative underwriting this sort of bull run, I think is notable to take stock of, giving how messy the market got for a couple of days there.
It certainly is notable because I think over the last, 9, 10, 11 trading days, there's been lots of questions just in terms of how big of a drop we could see. We know that it was very drastic. It was very quick. I think it spooked a lot of investors out there. But then, of course, the question is, where do we go from here? Have we already seen the worst of it, or do we have another bigger pullback out ahead of us? And Andy Serwer, I'd love to get your thoughts on that, because going off of what Miles just said, Goldman coming out on Friday saying that they're still optimistic about the path of the market. UBS today saying that there's opportunity here to enter the market at better levels. And maybe the volatility of the past week and a half is exactly what we needed. Maybe this helps reassure us just in terms of where we currently are today.
Well, I think there's a case to be made for optimism based on today's trading, Shauna. And I'd like to take you back, Shauna Smith, to 12 months ago. I mean, because half of today's action, you could almost imagine a non-COVID world. Let me explain. A lot of enthusiasm about Apple. Apple Day tomorrow. Gee, that sounds reminiscent of a time, a more innocent, less diseased time in the world, right? So that's sort of what propelled the market. And of course, Merger Monday. And it was a big Merger Monday with some very significant deals. I mean, the Gilead deal is huge. And I'm particularly intrigued by the NVIDIA transaction. And ARM is such an interesting company and has always been a leader in this business. But rarely do you see a deal of this magnitude where the buyer's stock goes up the way NVIDIA's did today, up almost 6%. What is it, a $40 billion deal, biggest in the history of chips. And so, this suggests to me that, with all the problems that SoftBank has been going through, you might have had a slightly motivated seller and NVIDIA might have gotten a fairly good price. So there's that. Now, the other 50% is a little bit more typical of what we've been seeing for months and months and months, which is, you had the vaccine trade picking up with AstraZeneca, seeing that their trial is going to get back. And that's what spurred the back to work trade, I should say, back to work trade as well. And I think Amex in particular is, beneficiary of that. And it's interesting, if you correlate the vaccine trade and the back to work trade, there's a pretty good R squared there. But if you take the first half of my little diatribe, right, it speaks to the Shauna Smith case for optimism.
It exactly does, because when you see a day like today, when there are so many big deals happening, that corporate deal making, I think, is certainly adding to that investor sentiment, investor optimism that we are seeing play out in the market today. But Andy, you mentioned it, and we want to dig a little bit deeper into that ARM NVIDIA deal that we did get out today. It was a $40 billion acquisition by NVIDIA of ARM, buying it from SoftBank. And for more on this, we have James Wang. He's an analyst at ARK Invest. And James, I'd love to just get your thoughts, first of all, just on your take, your thoughts on this deal. Does it make sense? Do you think NVIDIA got a good deal for ARM from SoftBank? And why are we seeing shares pop almost 6% today of NVIDIA?
You know, when I first heard about this deal, when it was still rumors, I thought it was actually a terrible deal. I thought it didn't make any sense. The big problem with M&A is that it's great for the banks, but not so good for the companies, especially when it's a horizontal company like ARM being integrated with a vertical company like NVIDIA is a conflict of interest between its customers. And then as we thought more about it, it actually started making more and more sense to us. And it really is a case of you have to look at the semiconductor industry as a whole. What is happening is we're entering the twilight era of Moore's Law, and customers need to build their own custom solutions to get more performance. They can't just go to Intel every year or two and get a free upgrade. So in an era where everyone needs to build custom solutions and they need accelerator solutions, which NVIDIA excels at, this is the perfect marriage. ARM has the largest install base of developers in the world, and NVIDIA has the world's best accelerator and AI technologies in the world, and they can really help their business for each other, especially in the data center.
Well, James, I wanted to ask you just about the regulatory and the competitive concerns here, because I think that that is right to bring up. And I think that is a question that a lot of people are asking today. Do you think that this is something that will ultimately be approved, that maybe ARM will still be able to be this neutral supplier out there, and some of those anti-competitive concerns that have been raised because of this deal are maybe overstated at this point?
I think it is a very tricky regulatory environment for this deal. NVIDIA's last acquisition was an Israeli interconnect company called Mellanox, and that was held up for a long time. I think they had most of the trouble from China. This deal requires a clearance from 4 countries, US, UK, China, and it's, I think, far more complicated because it is a UK-based company and Japan, of course. So I think it's probably a 50-50 at this point. Jensen, the CEO of NVIDIA, made a very interesting point on the call saying that because this company is based in the UK, it will not fall under US kind of trade barriers and trade regulations. We'll see if that's true long term. But I think this will be definitely a complicated deal to approve. And they gave an 18 months guidance to get this done.
Hi, James. This is Emily. I want to ask a little bit about the open letter that we got from ARM's co-founder, Herman Hauser, talking to UK's Prime Minister Boris Johnson about his concerns with this deal, that it might ultimately have, as you were talking about, some issues on the regulatory side, on the trade front side, just in terms of whether ARM might actually be able to continue building out its R&D in the UK, as opposed to NVIDIA, which is, of course, a US company based in California.
Yeah, I read the letter as well. It raised the point that if ARM gets acquired, basically the technology that ARM provides, which is inside every smartphone, inside consoles, would basically fall under US regulatory environment. So if the Trump administration or the next administration says, we're not going to export this stuff anymore, we're going to ban it, say for China, that could be a huge ding for the business. Jensen did address this on the call today with investors, and he said that it would not fall under this kind of jurisdiction because the rulings are written as the technologies relative to their country of origin. In this case, it's the UK. So he argues it wouldn't be under US interference. Now, we don't know if the US regulatory bodies will necessarily agree with that or what that will look like post-Brexit closure at the end of this year. So it is a little dicey. But that said, ARM was already already acquired by a Japanese company. And that is not, any closer to the UK, I think, in an ideological compass. SoftBank has not turned ARM into a superstar in the few years it had held the stock, the company, but it has invested a good amount, which has helped them get into the data center. And we've seen Amazon roll out data center CPUs based on ARM. I think NVIDIA will have more success helping ARM succeed. I think ultimately for the UK's interest, ARM's success is what's most important. Whichever company can help them scale and get into even more markets, get even more AI content, I think is going to be beneficial for the UK. NVIDIA has dedicated and committed to dollars to expand the R&D effort based out of Cambridge. NVIDIA has a lot of experience building out UK semiconductor talent through its Icera acquisition a few years before. So I think they will be good for ARM in the long run.
Yeah, some great insight there, James. But one comment you made almost as an aside, I wanted to follow up on, which is the twilight of Moore's law. Yeah. So that, I mean, you're talking about Gordon Moore and doubling the computer power and chips, but that sounds like the twilight of Intel.
Yes.
Is that what you're saying?
Well, Moore's law is bigger than just Intel.
Right, I know that, but I mean, and the legacy chip makers, essentially. Yeah.
Well, Moore's law affects every company that builds semiconductors, because the whole reason why the world of atoms is the world of bits have moved faster than the world of atoms is because we've had this free lunch every 2 years of doubling transistor count. We are still getting some scaling in transistor count, but the traditional faster performance guaranteed from Intel is definitely no longer true. Intel's been stuck on the same manufacturing capacity for 5 years now, basically. So if this deal goes through, and if NVIDIA is able to standardize and turbocharge ARM's platform and fuse it with its own CUDA and AI technology, NVIDIA could definitely be the world's most dominant semiconductor company and truly show that its market cap is worth more than Intel, which the market had basically signaled and anticipated earlier this year.
NVIDIA stock up another 5% today on this news. But James Wang, great to get your perspective of ARK Invest. We'll have you back soon. Thanks so much for joining us.
Thank you.
Well, there's no shortage of M&A news today. Another big story that we're following, Oracle confirming a partnership, I guess you can call it, with TikTok owner ByteDance. They're going to become, in their language, a trusted technology provider. They confirmed in a statement this morning that it's part of a proposal submitted by ByteDance to the Treasury Department over the weekend, where it's going to serve as this trusted technology provider. And Angie Serwer, this isn't the outcome, I guess you can say. It's not the outright sale. It's not what we were initially expecting. It's not what the Trump administration said it initially wanted. So the big question that everyone wants to know the answer to, and it's hard, I think, to decisively say at this point, is whether or not this solves the national security concerns that were front and center as to why this needed to be sold in the first place.
No, it doesn't. I mean, look, Shauna, nothing is what it seems with this deal and all the swirl that surrounds it. You've got a situation now where it looks like there's a partnership between a Chinese consumer technology company and an enterprise software company that heretofore had no experience with consumer tech at all, and had myriad opportunities to do so, by the way. I mean, they're sitting there, Oracle's right there in Redwood Shores, surrounded by, EA is right next door. I mean, they've been around and they've got $50 billion of cash plus on their balance sheet. And all of a sudden, whoa, this thing's available. And I know they've got the data, but what do Larry Ellison and Safra Katz need with, 16 and 17-year-old teenagers that people are saying, oh, they need their data for what? So they can do more database management, these teenagers? I mean, I totally don't get it at all. Oh, it is the case that Larry Ellison and Safra Katz are two of the biggest, really only supporters of Donald Trump's in Silicon Valley. There's also that point too. So you explain this thing to me, and by the way, of course, Microsoft does have a ton of expertise and firepower in the consumer tech space, but they lost. So I have no idea.
Well, Andy, I mean, isn't it just clear, though, that we all in the business media have been had? I mean, that last point is it. That's the whole story. Like, everyone's chasing this thing around, taking it at face value.
Right.
There's nothing there. It's just some sort of, it's a make nice, a giveaway. It's just Republicans who like each other doing a thing. Everything else is just fake. And I guess you kind of look back and you say, boy, we all wasted a lot of horsepower on this in the last month.
Yeah, I mean, it's very, there's a lot of stuff we're not seeing. It doesn't make any sense. I still don't know whether it's going to happen. I keep hearing the Chinese are not happy with anything. So it's a lot of, as Miles, you would say, it's a lot of fun to talk about. And it is, and I enjoy talking about it too. But as far as, understanding any real trends, now Oracle stock was up on the news. And so that's another give me there, Miles, right? I mean, announce a deal that may or may not happen that doesn't make any sense, and your stock goes up, and you figure it out.
Yeah, stock was up 4.5%, near that all-time high that it hit last week. But Miles, you mentioned this in the meeting, and I agreed with you, and I want to bring this up again, just in terms of, did Kevin Mayer make the wrong call? We know he stepped down as CEO a couple of weeks ago. He was only on the job for 3 months. Lots of questions out there about why he made that decision when he did. Was there something that he knew that we didn't know? But now when you take a look at the recent developments, maybe he made the wrong call. Maybe he should. Maybe this is exactly what he wanted, because he would be able, it looks like from this deal, he would still be running TikTok by himself.
Yeah, I think right. I think on that basis, yeah, if he left TikTok, as he said, because basically it was going to be, some kind of political football that he didn't want to deal with, which one is a little naive of him to have joined without. Anyway, I think maybe he made the wrong decision on that basis. However, yes, maybe he could be the CEO of a publicly traded company, which is clearly what he wanted when he took that job, since he knew he wasn't going to get that role over at Disney. I feel like our recent conversation just sort of outlined why no one would want that job, because
Bingo.
the company's stuck in the middle of all this other mess. So if you want to run a truly independent public company, you're not going to find one over at TikTok.
Yeah, you're certainly not. And it's a tough task. So maybe nobody would want that job. And I think you guys are right there to call that. But again, Oracle shares, interesting here when you take a look at the stock's reaction, like Andy said, with the stock up just over 4% today. All right, we're going to take a quick break here on the final round, but when we come back, more on today's broader market action with the Dow, S&P, and NASDAQ all closing up over 1%. Is this the start of a bigger rally, or are we due for another correction? We're going to have more on that right after the break. Activity that we got today, NVIDIA and ARM, we also had Gilead and Immunomedics, Verizon, our parent company, buying TrackPhone, also that news with Oracle and TikTok. But Just in terms of taking a step back and what this tells us about the market at this point, are you encouraged by this? And what do you think it says about where we are and the current levels that we're trading at?
Well, it certainly was a pretty active morning. Coming off the correction last week, going into September 30, which is a quarter end, a lot of window dressing tends to happen the last few days of the quarter. But, it was a healthy correction last week and hopefully a broader market, expansion. When you look at the macro landscape, low cost of capital, likely improving economic recovery in the coming months, although it could be slow and choppy. It's not, and the lack of return in other places like bonds, for example, equity still makes sense, especially in areas that have been beaten down, probably more the cyclical type names, more bent, materials, financials, transports, those sorts of things, than maybe some of the tech winners. So there may be some rotation there, but it still is a reasonably decent environment for continued stock market moves from here. Now, there are a lot of uncertainties. The election coming up, whether we get a cure, a vaccine, an antiviral, or anything for COVID, whether the economic recovery is more choppy and non-existent than we perceive. So I wouldn't say it's risk-free, but there's always uncertainty out there. And I think because of the landscape with monetary and fiscal policy, it's a healthy one for stock market moves.
Hey, Michael, could we really see ourselves soon, like this fall, going from a situation where we only had a narrow group that outperforms, which is the FANGs and the stay-at-homes, right, to a narrow group that doesn't perform, which is to say cruise ships, hotels, and, Delta and UAL or something like that?
Oh, I think absolutely. I mean, we're in uncharted waters here. And while, we do get some, the old saying, history, doesn't exactly replicate, but it rhymes, I think is very true. There's a lot of factors here we've seen before in other corrections, other recessions, et cetera. But we've never had a situation where we voluntarily shut down the economy for this long and have had to bring it back up to speed. And so there are winners. I mean, the tech stocks are going up for a reason. It's not just speculation. There's tons of profit. There's revenue growth. And it's aligned with a sort of belief system on how people are going to live coming out of COVID. So there's a reason for it. But having said that, it is very consolidated. I mean, most of the equity gains are in a couple dozen names. And so you would expect, if you do get economic recovery, to broaden out. But within that, that would be normal. But within that, you're going to have, in this belief system of how people are going to behave going forward post-COVID, some industries are going to have trouble. Live entertainment, sports events or concerts, cruise ships, as you mentioned, those might suffer a lot more than broader cyclicals maybe when consumer spending and disposable income increase. So yeah, I think that's a very valid point and something investors should keep in mind as they pick through all these names going forward.
Michael, I want to stick on that point with tech shares because I was reading a note from DataTrek last week, and one of their points stuck with me. And that's that when we look ahead next year, the next 6 months, in terms of comps for sales, earnings growth for tech, that might actually be difficult to match because you have consumers already having invested in that work from home hardware, that cloud computing capacity now. So does that pull forward in tech investment this year present a downside risk going forward? And does that mean that we've already seen peak tech outperformance for this cycle?
Possibly. There's no question valuations in some names are incredibly high, even companies with great business models and business plans, and some that are likely going to get some competition as other firms move in and try to take some of that share or some space. So I think that's a very valid concern where you've sort of front-loaded some of that growth and some of that equity performance during this pandemic phase. And then those companies come down, they come back to earth in terms of a PE compression or something coming back to normal. I mean, some of the ranges are just crazy in terms of valuation. It's a $500 cup of coffee in some cases, and it just doesn't make any sense. But there's a lot of new investors coming into the market. Those are what's working. And in that way, this is very similar to other bull markets, late stage bull markets, think 99, 2000. Where you have a lot of froth coming in, a lot of new investors buying what goes up, and so that aspect of this COVID rally is very, very normal, and we've seen that before. And that has tended to moderate over time. So I think that's a very fair point and likely for some names going forward. Yeah.
All right, Michael Cugino of Permanent Portfolio Family of Funds. Thanks for joining us today.
Thanks, guys.
Coming up here on the final round, shares of Nikola reversing course, jumping 11% today as the company fires back against fraud claims. We're going to have more on that when we come back. Welcome back to the final round. Nikola shares rebounding today, up just around 11%, clawing back some of the losses from last week. Now, shares were down 24% Thursday and Friday on claims of fraud by a short seller firm. It was Hindenburg Research. Now, the accusation coming just a couple of days after GM said that it was taking an 11% stake in the company. And as for you have been following this story, and Nikola today refuting those claims. I know they released a 6-page document, but judging from the stock's reaction, it looks like investors at least were satisfied with what they heard.
Yes, because some investors had been wanting a more detailed rebuttal from that Friday statement, which Nikola had put out, basically saying that that Hindenburg report was a hit job, but it wasn't enough detail. So this really delved into some of the big accusations. And let me show you one of the quotes from that statement. It said, the report from Hindenburg, an activist short seller financially motivated to manipulate the market and profit from a manufactured decline in Nikola's stock price, contains a number of false and misleading statements regarding the company's operations and multi-year groundbreaking R&D efforts. Now, some of the big claims include this one, that the short seller had alleged that the 2016 Nikola One truck was not a real truck and was in fact a pusher. Now, Nikola says that the gearbox was functional, the batteries were functional, the inverters were functional, the power steering and suspension were functional. It did say, though, that as Nikola pivoted to the next generation of trucks, it decided not to invest additional resources into completing the process to make the Nikola One drive on its own propulsion. And it also addressed the video that the short seller had said was filmed of the truck, the Nikola One, rolling down a big hill. So Nikola said Nikola never stated its truck was driving under its own propulsion in the video, although the truck was designed to do just that. Nikola said that this was a third-party video. It was done several years ago, and that the video described the truck as in motion, that it never described it as under its own propulsion or powertrain driven, and that investors at the time, when Nikola was a private company, knew exactly the capabilities of this truck. It also went on to talk about some other claims, including something which Nikola said was mischaracterized by the short seller, which were some comments from a Bosch employee. Bosch is one of the partners of Nikola, and Bosch had stated that specific instances in the report, quoting a Bosch employee, were taken out of context. But certainly investors were more pleased with this rebuttal, which was a bit more detailed than the statement that came out last Friday. Shauna.
Yeah, Ness, it certainly was a little bit more detailed, but it's also interesting when you think about GM's role in this, because Mary Barra was asked about this, the CEO of GM today, and she said that GM did their due diligence. And I think that was a big question on investors' mind over the last couple of days, and just whether or not that was the case. I think a lot of people thought that it was the case, but to hear her reaffirm that, I think is helping. But I'm just curious what you think just in terms of how much does this help the argument that Nikola is legitimate, that it kind of puts to rest some of those rumors and some of those thoughts out there?
You know, every time I write a piece, I hear from some of the people on Twitter, and some of them being investors of Nikola. And I will say that the investors who are invested in Nikola really want to believe in the story. And as far as the stock and the company itself, you know, Dan Ives came out and said this is still a stock that is a prove me story type of stock. So I think that part of what you're seeing today was certainly a positive reaction to the statement that Nikola came out with, also to the statements that you just referred to of Mary Barra, but there's still something to be seen here as far as long term. The EV space is a very, very difficult space, as we know. So I think that investors are still in a wait and see mode. This doesn't bode that well. Citron Research also came out with a tweet last Friday, basically basically supporting the Hindenburg research report, saying congratulations basically to Hindenburg, and that Citron would put up half of any lawsuit costs because Nikola has basically said that they have a law firm to see if they can about legal action that they may take or legal recourse, and that they're going to the SEC with this short seller report. So it remains to a wait and see kind of story.
All right, Ines, thank you. Well, it's a busy week. The Fed meeting kicking off tomorrow. It's the last meeting for the Fed ahead of the presidential election. Brian Chung, our Fed expert, is here with what we can expect. And Brian, I think markets are hoping the Fed helps calm some of those nerves, some of the jitters that we saw creep into the market this week. But what should we expect to hear over the next 2 days?
Well, Shauna, the Fed's been very clear that they're not even thinking about raising rates. So likely nothing surprising in that FOMC meeting that starts tomorrow and then wraps up on Wednesday, but figured I'd present the things to watch for in a different format for this time. So let's make it like a Letterman top 10, except I'll do top 5 because otherwise I'll put people to sleep. But here are the 5 questions that I would have for Fed Chairman Jerome Powell on Wednesday. First of all, where's the forward guidance, right? The Fed says it's not thinking about raising rates, but what would it take for the Fed to just start thinking about it, right? Markets want it, so are we going to get it in that press conference? Coming in at number 4, the Fed has repeatedly said over the last few months that we need more fiscal policy. You can check the transcripts for literally any Fed speaker over the past few weeks, but as we know, those phase 4 discussions in DC are going absolutely nowhere. So what's Powell going to say? Is he going to push again, or is he just going to throw his hands up? Third, the yield curve. So here's a stat for you. The 10-year yield has gone up 17 basis points since the Fed's last meeting. The 30-year at its peak, 25 basis points. So borrowing costs over the longer term are going higher, but that could be bad if the Fed wants to pull forward economic activity. So could the Fed use its balance sheet here, maybe tilt QE towards the longer end of the curve, or maybe they even consider yield curve control yet again, something worth watching there. Number 2, reading the dot plots, of course, we're going to get projections for where the federal funds rate might be through 2023. So I've got an idea for where it might be, probably 0. But there could be some out-of-the-box members say penciling in a hike. That was the case for 2 of the 17 members in the June FOMC, so worth watching there. And then clocking in at number 1, we've got jobs. So here's a fact for you. The job market has recovered faster in this crisis than it did in the last crisis, but here's another fact. We're still 11.5 million jobs away from pre-pandemic levels. So if the Fed is going to prioritize the shortfalls of employment from the maximum level, as it said in its Jackson Hole change, what does that mean for the Fed policy going forward? Powell's explanation will be very key to answering those questions. Again, press conference at 2:30, statement at 2 p.m. on Wednesday. We'll have the full coverage of that right here on Yahoo Finance.
Brian, I like how you laid all that out. I hope some of our competitors aren't watching and stealing some of your questions that you have lined up on Wednesday, but it's great. It was very straightforward. We appreciate it. Over the next 2 days, we will be closely watching, and of course, hopefully you'll get your question in on Wednesday. But Brian Chung, thanks for breaking that down for us. All right, well, coming up, we'll get a reading on the housing market following a blockbuster summer. Will the momentum last for the rest of the year? That's the question a lot of people want to know. We're going to discuss straight ahead. Welcome back to the final round here on Yahoo Finance. The housing market has been a real bright spot for the economy over the last several months. We recently got numbers from Zillow. Home prices are up by nearly 9% in the month of August. Available housing inventory down 30% from a year ago. So for more on this, we want to bring in Jeff Taylor. He's co-founder and managing partner of Digital Risk. And Jeff, just first, what are your thoughts just in terms of the skyrocketing demand that we've seen over the last several months at a time when the economy has been struggling to gain some footing? The housing market has continued to really outperform in almost every aspect of how it's measured. And then also whether or not this momentum is going to stick and we're going to see these types of numbers throughout the end of the year.
Yeah, it truly has been amazing to look at the housing market. I mean, this year we're heading towards a $3 trillion residential mortgage market. That's the second biggest in the last 25 years, only behind 2003. And look, the recent activity that we've seen, even though it's been 60% refinance and 40% purchase, is mainly driven by the fact that interest rates have lowered so much, and we have record all-time interest rates. And I see that market only getting hotter as the rest of this year goes in and all the way through 2021. So a great market to either refinance and also to potentially buy a house and buy a new house, especially if you can find one though with the tight housing supply right now.
Oh, I got all kinds of questions, Jeff, but I'm going to go with the refi one because my understanding was refi rates were not going down, right? That the banks were saying, we don't want that business. We only want you a new mortgage. Hasn't that been the case?
Yeah. So that's the business actually that we're in. We're the largest mortgage fulfillment company in the country. So I'll give you perspective. It's not that banks don't want the business. It's a supply to capacity demand, right? So mortgages still take 45 to 60 days to get through the process. So they simply don't have the capacity to be able to process as many loans as quickly as they would. So rates are kept higher
to sort of, in many aspects, to meet the capacity they can fulfill them in. So as capacity gets into the system, you will continue to see rates drop over the course of the next 12 months. And that's where there's still going to be a lot of opportunity. But a lot of people don't realize that. It's not that they don't want to drop rates. It's that they don't have the capacity to fulfill the mortgage requests right now, on the refis especially.
Right, refi especially. Go ahead, Emily. Sorry.
Jeff, just taking a look at the housing market here, I know we've been seeing this movement towards suburbs away from metropolitan areas because of this trend towards working from home. Are there any areas that are getting hot right now that surprised you?
I'm not so much that it surprised me, but we're still seeing about 1,000 people a day moving to Florida. You're looking at that Phoenix is still extremely hot. And I think that your point is great as far as really the kind of work from home. And there, kind of pivot and go to home builders for a second. People in big cities are paying very high rent, like $2,000 a month in many cases. So now you take a $2,000 rent, you make it an $1,800 mortgage, right? Because interest rates are so low. And now they can go out and design their new house, right? They can design that new high-tech office space. They can design that new study area for the children, depending upon what age they are, for homeschooling. I mean, that's a tremendous incentive. And then you see the home builders out there are incredibly aggressive right now. And you see anywhere from a 3 to 6% incentive, many of them offering buyers to build new houses.
Jeff, I want to ask you just about the foreclosure moratorium, because obviously it's designed to keep people in their homes, and it's done so. That's very important at a time like this. But to what extent do you think this has inflated the housing market over the last couple of months?
It's a great question. And actually, I really don't think it has. And so here's my logic behind this. Going into the pandemic, the total U.S. housing market was about $33 trillion in size, with $18.7 trillion in home equity. So we had all-time home equity levels. So basically, people, if the foreclosure moratorium has stopped, people have equity in those houses. They would probably sell those houses if their financial profile changed as much and they had to leave, versus 2008, where they didn't have any home equity. They didn't put much money down, so they would just walk away from the houses, from the homes. So while I think that all the policy changes in place are good for consumers, in no way, but I think that's really affecting the housing supply market, because it was historically tight before the pandemic and continues to be there right now.
That's interesting, Jeff, because I've read some pieces just in terms of the fact that maybe that could jeopardize this V-shaped recovery that we've seen in housing. And I know you also think that we have seen this V-shaped recovery. So you're not concerned about that at all, just in terms of when the foreclosure moratorium ends and we have these monthly payments stacking up, these protections we know can't last forever, but you don't think in any way this will jeopardize what we're seeing in the housing market?
So let me go a little broader to the economy. I think the economic recovery is more of a W, right? I think that's more of a W. The housing market was already 9 months ago. I mean, the inventory was still unbelievably tight, and rates were getting lower. If I look broader at the housing market, I think that's going to be incredibly strong for the next 18 months, 24 months going forward. But I think the economy, here's the unknown part, right? The first 6 months of the pandemic, the unemployment is what it looked like, the service industries, restaurants, hotels, airlines. That next 6 months probably starts to creep into Fortune 500 companies having the right size their working staffs a lot. So that's going to be more of a white collar, I would say. On the unemployment, there's a lot of those people are much more homeowners than the first case, which is more on the renters. So how that all plays out going into next year is still sort of TBD. But again, because inventory is so tight in the U.S. and rates are so low, I'm still looking for maybe at 21 home price appreciation flat to 1% up.
All right, Jeff Taylor, always great to have you on, co-founder and managing partner of Digital Risk. We'll have you back soon. Thanks so much for coming.
Thank you for having me.
All right, coming up next here on the final round, gyms and fitness studios are reopening, but the industry is still trying to figure out a way to get their clients back. We're going to talk to Barry CEO Joey Gonzalez about what his company is doing straight ahead. Welcome back to the final round here on Yahoo Finance. Dow closing up 327 points. S&P and NASDAQ also adding to gains. Jared Blakely has a closer look at what he was focusing on from today's market action. Jared?
Sean, I thought we'd take a look at some of the big mega cap tech stocks and a longer term chart just to see how we fall out right today. So on the NASDAQ 100, we're looking at the Wi-Fi Interactive here. Let's call that up. We have the 50-day moving average in blue, and you can see we closed right at it Friday, and we are now closing above it today. That's a NASDAQ 100. Now, it's a little bit different from the NASDAQ Composite, where we dipped below that 50-day moving average and closed below it on Friday. But Apple, you can see, still well above it here. Amazon, at or right below it. So we do have two closes below it, and that could signal further declines here, especially as we've now taken this low out from last week. And then Microsoft, we are below it, but consolidating in a range, probably for a breakout here. We'll have to see which direction this goes in. Alphabet, firmly below now, similar to Amazon. And then Facebook. We haven't talked a lot about that stock recently, been kind of out of the limelight, but that is above the 50-day. Tesla, we got a nice bounce off of it last week, and now we are solidly above, had the best day in a couple of weeks here for Tesla. And then NVIDIA, the chip maker today, having a great day after the announcement of its merger or proposed merger with ARM, and we can see that made a new weekly high. And then Adobe, rounding out here, that's above. PayPal, just a little bit below. And then Netflix, that has been trending down, and that's not the best chart formation to have here. It kind of looks like a quasi double top in the making. But that's where we stand, and we're going to be watching how things shake out for the rest of the week. It is options expiration, and so that has a big part to play here, especially as there's been heightened attention, all the call options from a lot of these large tech names here.
Could add some volatility here in the market. Jared, thank you. Let's turn to the fitness industry. The $94 billion fitness industry is doing everything it can to survive the pandemic. So here with a little bit more on this, we have Joey Gonzalez. He's the CEO of Barry's. And Joey, the fitness industry, it's been one of the hardest hit sectors of the pandemic. So talk to us first just about some of the changes that you've made in order to survive the last couple of months, and really just how challenging it's been as a CEO of Barry's, as one of these boutique fitness companies during this time.
Yeah, it's certainly been challenging. And, you know, one of our core values at Barry's is innovation, and we've certainly been leveraging that over the past 5 months. We have innovated everything from the actual Red Room experience, because we have, you know, less than 10 studios across the US that are open today out of 43. But the difficult thing about that is every city has different mandates that you must abide by. So the way that we're operating in Boston is actually very different than how we're operating in Houston. So we try to sort of embrace all of those mandates and still make Barry's a fun experience. So that's one way that we're innovating. Another is that we've launched what we call Barry's Outdoors, which is exactly what it sounds like. We've taken the Red Room outdoors, specifically in markets where we're not allowed to operate in our Red Rooms. So here in California, we have a lot of outdoors that we've launched. Both our lift concept, which is just a weightlifting experience, around 50 minutes, and our original treadmill weights concept, which we launched last week in the Beverly Center. And then probably our greatest innovation has been our Barry's at Home platform, which has, you know, we started back in April, and it's brought the Red Room into people's homes. And we've been able to luckily maintain that connection with our community, especially those that are in cities where we're not able to operate at all.
Joey, in terms of your workforce, and especially with your fitness instructors, what has hiring or rehiring trends at Barry's looked like with some of these new offerings now?
So we haven't had any rehiring trends thus far. Barry's went from, we had 1,400 employees, and we're now somewhere around 300. So it's been, you know, quite a struggle for us, having to say goodbye to people that we love and consider family. But we have made the most of those that are still with us. And there are occasionally some moments where we'll hire, you know, part-time staff to help us run operations outdoors, for example, like with our facilities teams.
Joe, you mentioned, I think that you said less than 10 or right around 10 studios are open at this time. I'm curious just in terms of, are people rushing back? What's been the reception, I guess, from clients just in terms of their willingness to come back and work out inside the studios?
Yeah, it definitely varies from city to city. Our outdoor concepts are so popular that I actually had to buy a membership this month because I can't get in. So there's a huge demand, I think, for that product, more so than any other we have right now in the system.
And then you mentioned the at-home workouts, and I think that that's an interesting trend that we're seeing in this fitness industry because we all know the threat from those remote workouts, specifically Peloton. I mean, it's a company that's valued right around $23 billion at this point. So what's your take just in terms of this trend from working at home, and then how much interest are you getting on your platform from your at-home workouts in terms of even in places where you have reopened your studios?
Yeah, so it is interesting. I mean, back in March, April, most of May, we had a situation where that was the only option for anybody, right? And so the demand for that product was higher than it will probably ever be again. What we have seen over the past few months is as gyms and boutique fitness concepts start to open up, there is a consumer that races back to have those in-person experiences. I think where we're going to see a lot of growth is the hybrid customer, somebody who, 2 days a week may stay at home because it's more convenient, but prefers to spend the other, 3 or 4 doing a class in person or some variation of that. So we've been really focused on, from a strategic standpoint, creating a viable omnichannel business where we can present to our customers an at-home product of which we can be really proud. So we're launching our version 2 of Berries at Home in Q1 of 2021. And hopefully at the same time, we'll be opening up all of our currently closed studios, as well as another 5 to 7 that we had planned to launch this year.
Well, Joey Gonzalez, CEO of Berries, we wish you all the best. I know me personally and a lot of people that we know are anxious to get back into the studio. So thanks so much for taking the time, and we will follow up with you soon.
See ya.
All right, we're going to take a quick break here on the final round, but when we come back, we'll take one more look at the markets. And then, of course, what we're watching as we turn our focus to tomorrow's opening bell. We're back with that in just 2 minutes. Welcome back to the final round here on Yahoo Finance, taking one more look at how we closed today. All 3 of the major averages closing up over 1%, Dow adding 327 points, S&P up 1.3%, and NASDAQ up nearly 2%. Andy, real quick, just in terms of what are you watching as we turn our focus to the rest of the week?
Fed, Apple, Google hearings tomorrow too, also on the radar in the Senate.
Yeah, certainly a lot to keep an eye on. Again, Apple, they had their big, highly anticipated event tomorrow. A lot of the focus will be on the new Apple Watch. That is what will be expected. But Apple shares today, one of the leaders in the tech sector, closing up just around 3%. All right, well, that does it for us today. Thanks so much for tuning in to the final round. We'll see you back here, same time tomorrow. Have a great night.